Hello students, welcome back to another session of economics. To be more precise, from today on we'll be dealing with economics for finance, okay? Like we have completed your business economics chapters in a span of 1 hour, we are going to do the same in the case of economics for finance. So I'm going to take you through all the chapters of economics for finance. So what you have to do is you have to, stay put, you have to maintain a notes, you have to write down whatever we are teaching. So that will do the job for you. And with this knowledge, you will be confidently able to solve the MCQs. Okay. So with no delay, let us start the chapter. So the first chapter that we are going to start with is national income accounting. Okay. So we'll discuss about the key terminologies first. So in your key terminologies, the first terminology that you see is gross versus net. The first terminology that you see is gross versus net. Students, whenever you are encountering the term net, remember that it is used in two instances. Whenever you are encountering the term net, it is used in two instances. One is gross minus depreciation. The second is receipts minus payments. The second is receipts minus payments. So whenever you are seeing the term net, it is used in two instances. One is gross minus depreciation. The other is receipts minus payments. Okay. So what do you mean by gross minus depreciation? In that, what do you mean by depreciation? Depreciation is nothing but wear and tear. See, whenever you are using an asset, it is prone to what? It is prone to getting, obsolete. It is, wear and tear will keep happening. It will lose its value, right? It is not that whenever you buy an asset, it will have the same value till the end of the life. So when you minus the depreciation from gross, you will be getting the net value. Clear? So if you have to see the terms here, net is equal to gross minus depreciation. So you will be discussing the concepts of national income accounting in the later topic. Then I will be taking you through GDP, GNP, GNDI. All this I will be discussing in the coming topics. Okay. So let us see this. Depreciation is subtracted because capital wears out or depreciates. It is used in the production process. So whenever you are using the capital in the production process, it is subject to depreciation. Even asset obsolescence and complete destruction are considered by NDP or NNP. So people, whenever you are calculating depreciation, it also includes complete asset destruction as well, right? And in other case where you will be using net terminologies, you will be using net when we are talking about receipts minus payments. What do you mean by receipts? Whatever you are receiving, and payments is something that whatever outgoing is payment, incoming is receipt, right? So what are the things here? Example 1, net indirect taxes. So what do you mean by net? Receipts minus payment. So whatever the government is receiving, whatever the government is paying. Whatever the government is receiving is receipt. Whatever the government is paying is subsidies. If you take the government balances, taxes is something that the government is receiving. Subsidies is something that the government is paying to the people, right? So if you take indirect taxes minus subsidies, that is called as net indirect taxes. Next, what is this net factor income from abroad? But whenever you hear the term net, it is nothing but receipts minus payment. So what do you mean by factor income from abroad? Net factor income from abroad. That is nothing but receipts minus payment, right? Factor income from abroad minus factor income to abroad. See, whenever our people are working abroad, whatever money they are earning there, they will be remitting that back to India, right? So factor income from abroad. And whenever the foreigners are here in India, whatever money they are earning here, there is a possibility that they will send that to their home country. So it is factor income to abroad. So from abroad is we are receiving, to abroad is we are sending. So what is net factor income from abroad? Factor income from abroad, which is receipts, minus factor income to abroad, which is payments, right? Next, net exports. Again, net is nothing but receipts minus payments. See, whenever you export something, you're receiving money. Whenever you're importing something, you're paying money, right? So exports minus imports is nothing but net exports. What is this NCTROW? Okay, it is net current transfers from rest of the world. What is it? Net current transfers from rest of the world. See, what do you mean by transfer payments? It is one-way traffic. There is only incoming, but there is no outgoing. Okay. So what are transfer payments? It is only incoming, but there is no outgoing. So sometimes what happens is, you can take the recent example of Turkey, right? There has been an earthquake and many countries kind of donated money for the welfare of the people of the Turkey. So this is transfer payment. There is no productive activity, but still they have received money, right? So that is nothing but as transfer payments. So whenever the country is in trouble, it kind of receives money from abroad, okay? So they are called transfer payments received from abroad. And like other countries are helping us, we will also keep helping other countries, right? So whatever transfer payments you are making to other countries, it is transfer payments to abroad. Whatever payments you are receiving is transfer payments from abroad. So what is net? Receipts minus payments. So whatever you are receiving minus whatever you are paying. So as we have come across the word called as transfer payments, let me tell you students, there are three types of transfer payments. First of all, what are transfer payments? They are one-way traffic. There is only incoming, but there is no outgoing, right? So what are the three types of transfer payments? The transfer payments from government. What is it? Transfer payments from government, like unemployment benefits, pensions, all these are transfer payments from government, right? Next, interest on public debt. See, whatever interest payments that you are making on debt, it's considered to be transfer payments because it is not kind of, generating any economic activity as such. Next, transfer payments from rest of the world. Okay, transfer payments from rest of the world. See, whatever you are paying these interest payments on public debt, they are considered of revenue nature, right? They are not giving any benefit for you. See, whenever you take a loan, you kind of start paying this interest payments. Whenever you are paying the interest, are you getting anything in return? You are not getting anything in return, right? You are just paying the money, you are losing that out. There is no, benefit being generated from that interest payment. So interest on public debt is considered to be a transfer payment. The last thing that I talked about was transfer payments from rest of the world, right? Transfer payments from rest of the world is something that you're receiving from abroad, from other countries, right? So what are the three types? Transfer payments from government, interest on public debt, transfer payments from rest of the world, right? These are the things I wanted to discuss. The next key thing is domestic versus national. What is the next thing? Domestic versus national. See, you keep hearing the terminologies GDP, GNP, right? You keep hearing these terminologies called as GDP and GNP. See, whenever I am saying domestic, I am considering only the territory of my country. For example, I am saying domestic, right? So, whenever I am considering the boundaries of my country, it is called as domestic. If you add NFIA to domestic, it will become national. If you add NFIA to domestic, it will become national. See, the meaning of national is I want all my citizens' income to be included, whether they are staying in the country or whether they are staying anywhere else. If they are staying anywhere else and they are earning money, they are going to remit that money back to India, right? So it is my people's income. So whenever you are saying national, you are not worried about the boundaries, but you are only considered about the nationals of your country, the citizens of your country. But whenever you are saying domestic, you are only worried about the territory. You're only worried about the territory. Whenever the production activity takes place in your own territory, that is included in domestic. But in national, we are not including everybody's income. See, foreigners, even though they make the production process in India, there is a possibility that they will remit their money back to their own country. So I will not be including that income. But my citizens, when they are staying outside the country, even though they are earning it outside, they are my citizens. So they'll be remitting that money back to India. So I'll be including that in the national. So what is the difference, students? In domestic, you are worried about the territory. So whenever the production activity takes place between the boundaries of the country, within the boundaries of the country, whether made by a national, whether not made by a national, like a foreigner has done it, you still include that because it is in your territory. Domestic plus net factor income from abroad will give you your national. Domestic plus NFIA will give you your national. The difference between national and domestic is nothing but net factor income from abroad. What do you mean by net? Net is nothing but receipts minus payments. So the formula is factor income from abroad minus factor income to abroad. Next, national is equal to domestic plus NFIA. Next, domestic is equal to national minus NFIA. Simple math. You take the value that side. That's all. Next, NFIA is aggregate amount the country's citizens and companies earn abroad. So, what are they saying here? Countries, citizens and companies earning abroad. For example, if our companies are setting up branches abroad, the profits, whatever they are earning there, will be remitted back to the home country, right? So, they're taking companies, they're also taking individuals who are earning income abroad, which will be, sent back to the home country minus aggregate amount of foreign citizens and overseas company earn in that country. In India, if any foreign citizens or overseas companies are making money, they will be sending that money back to their own country. So that has to be deducted. right? Next, net factor income from abroad, another formula. See, these are nothing but different ways of expressing your net factor income from abroad. Factor income earned by domestic factors of production employed in the rest of the world minus factor income earned by the factors of production rest of the world employed in the domestic country. See, factors of production is what? Those who are included in the production process are nothing but factors of production. So, if the factors of production are earning something abroad, that will be bought back, so add it. And other countries' factors of production, if they are earning something in India, that will be sent back, so deduct that. Next, NFIA can also be written as, see, whenever you are seeing the net term, it is receipts minus payments. So, whenever you are encountering the term net, it indicates that receipts minus payment. Net compensation to employees. You all know that our people will be going to abroad to work, right? So, whatever compensation they are receiving, that is nothing but compensation to employees, nothing but wages, salaries, all that is compensation to employees. Next, you people not only go abroad to work, but there is also a possibility that you will be investing abroad, right? You will be investing money abroad, you will be buying properties abroad, right? So, net income from property and entrepreneurship. So, whenever you are investing money abroad, whatever money you have to receive, whatever money income you have to receive from the investments there is what? Receipt. And whenever other people invest in our country, they will be receiving some payments that will be paying them, right? That is payment. So, it has to be deducted. So, net income from property and entrepreneurship and net retained earnings. To understand this retained earnings, let us understand another terminology called as profits. Corporate profits. Okay. Corporate profits are made by business houses, right? This corporate profits has three terminologies included in it, which are corporate taxes. See, whenever a corporate house makes profits, it kind of pays its taxes out of the profits. A part of the profits is paid as dividends to the households. You all know that whenever you are buying shares of some company, you become a shareholder and you will be receiving something called as dividend, right? So, dividend are a part of corporate profits, and some portion you kind of keep it as retained earnings. That is, you will not be using it, but you will be keeping it aside for future purposes. So, retained earnings is nothing but the money that you are holding to yourself without paying as taxes or dividends, right? This is retained earnings. So, what do you mean by net retained earnings? Whatever retained earnings our companies have, that is our money. Whatever retained earnings other companies, foreigners have, that is their money. So, net retained earnings. It is also receipts minus payments, right? So, what are the elements included in corporate profits? It is corporate taxes, dividends and retained earnings. So, what is the formula for net factor income from abroad, students? Net compensation to employees plus net retained earnings plus net income from property and entrepreneurship. You not only give your labor, but also you kind of make some investments, right? So, whatever money you are receiving, add that. Whatever you are paying to other people, you just deduct that amount. Next, another important terminology that we have to take into consideration is resident versus national. Okay. See, whoever is having predominant economic interest is considered to be a resident. Okay. But whenever you are coming to national, you are not considering the boundary here. You are only saying that that particular person may have an economic interest within the country or outside the country. See, I am saying Indian national, right? He can have an economic interest within the country or outside the country. I'm not bothered like where he is having the economic interest. I'm only bothering about whether he is my citizen or not. So, the term resident in terms of domestic refers to unit having predominant economic interest in a country's economic territory for 1 year or more, irrespective of the nationality. That is what I am telling. If a foreigner is coming here, he is making some, he's indulging in some productive activity, he is called as a resident. He's having a predominant economic interest for more than 1 year. But when it comes to national, I'm not worried about like whether he's having predominant economic interest in my country or outside. I'm only worried whether he's my citizen or not. The term national is a broader concept compared to domestic, because you are not worried about the territory in your national, right? So it is a broader concept when compared to your resident or your domestic, right? Next. The next thing that you will be learning is indirect taxes. You keep hearing these terms called as direct taxes and indirect taxes, right? Whenever the burden of taxation can be shifted, that is called as an indirect tax. Whenever the burden of taxation cannot be shifted, that is your direct tax. Under your indirect taxes, you have product taxes, production taxes. You have product taxes and production taxes. See, during the production process, if anything is imposed, that is production taxes. After the production process is completed, the final product is made, then any imposition of tax is nothing but product tax. So you have got product tax and production taxes, right, everybody? Next, let us discuss some concepts called as factor price, basic price and market price. We are going to keep it very, very simple. Whenever you are saying factor price, it is nothing but the summation of the cost of production. So you have 4 factors of production: land, labor, capital, entrepreneur. So whatever your factor payments are for these 4 factors of production, if you sum them up, that is your factor price. For this factor price, if you are adding production taxes and deducting production subsidies, always remember students, taxes are to be added, subsidies are to be deducted, okay? That is your basic price. So in basic price, you are only talking about production taxes, production subsidies. But in your market price, you take both. You take both production taxes and production subsidies. So market price is nothing but basic price plus product taxes minus product subsidies. So what is it? Basic price plus product taxes minus product subsidies. So this is your market price. In basic price, you are only considering production taxes, production subsidies. In market price, you take into consideration both production related taxes and product related taxes, production related subsidies and product related subsidies. That is it. Okay. So can I write it as market price is equal to factor price plus net indirect taxes. This indirect taxes includes both production related and product related as well. So this was a small concept that you have to remember. So market price is equal to factor cost plus NIT. NIT includes indirect taxes minus subsidies. Whenever I am saying indirect taxes, it includes production taxes, product taxes as well. And when you are talking about basic price, you are only considering what? Production taxes, production subsidies. Okay. So that is what you have to remember. In basic price, you are only talking about production tax, production subsidies. So this is a small concept. Do remember, students. The next thing is national income. See, whenever you say national income, it is nothing but the final value of all the goods and services produced within the domestic territory, and if you add NFIA to it, it will become national income, right? In India, your national income is measured at NNP at factor cost. Our national income other name is NNP at factor cost. This we will be discussing in detail when we are talking about your concepts of national income accounting, okay? So here we are going to discuss some memory based question for you. So please pay some close attention. So what is the introduction? Nobel Prize winning economists Simon Kuznets and Richard Stone introduced national income accounting as macroeconomic accounts from production stage to disposal stage. See, you have got 3 stages, right? First thing is you have to produce. Next thing is what? Next thing you have to distribute, and the other thing is the final consumption. So what are the 3 stages? First stage is production, second stage is distribution, and the third stage is final disposal, right? So these are the 3 stages. And who introduced this national income accounting? Simon Kuznets and Richard Stone. Next, in national income account, what we do is we first define the concepts. See, in the later topics I told you, right, we will be discussing the various concepts of national income accounting, and then we will construct the measures corresponding to these concepts. The second is help us understand how the various transactions are interrelated. See, I have discussed 3 stages, right? Your production stage, your distribution stage, and your consumption stage. All these 3 stages are interrelated, right? So we are going to understand how these are interrelated. Next, give us an idea about the working of the economy. So you will be able to understand the contribution of various sectors, what is the value of goods and services produced in an economy. So you're going to understand, you're going to get an idea with regard to economy or what is happening in your economy. Next, helps us to meet the needs of the government. See, why is the data required for the business analysts or the government to formulate policies? Obviously, when private people want to invest somewhere, they have to get, get their hands on some data, right? Like what is the position of Indian economy? How much is it making? Which sector is growing? Which sector is not growing? And the government will get to know where do we have to focus, which sector has to be given, privileges. All that can be understood only we have the data availability, right? Next. So measurement of national income accounting. So who does this job? Who does the measurement of national income? See, at the central level, you have an organization called as Central Statistical Organization, and this CSO comes under Ministry of Statistics and Program Implementation. In short, it is called as MOSPI. I guess you all know about it. So at the central level, who does the compiling of national income? It is done by Central Statistical Organization, and your CSO comes under whom? It comes under MOSPI, Ministry of Statistics and Program Implementation. At the state level, who does the job? It is done by State Directorate of Economics and Statistics. State domestic product. Okay. Regional accounts. What do you mean by regional accounts? See, example is your net state domestic product. Okay. So it is nothing but your net state domestic product. Whenever I say that GDP, it is the GDP of the entire nation. Whenever I say state GDP, that is considered to be regional accounts. Like what is the GDP of Andhra Pradesh? What is the GDP? What is the state GDP of Karnataka? So this is regional accounting, right? Next, who does this? It is done by State Directorate of Economics and Statistics. Do remember this. Next, state income or net state domestic product. Money value or the volume of all the goods and services produced in the state within a year without duplication. That is, you should not re-record the transaction. That kind of overstates your income, right? So whenever you are talking about the income of one particular state, it is the NSDP or the net state domestic product. State level estimates are prepared by whom? State Directorates in Economic Statistics. We have just seen that. Next, CSO assists the states. See, CSO is on the top. State level accounts are prepared by the state directorates, but whenever these state directorates are in requirement of some, techniques or how to do it, your CSO kind of provides an assistance for that, right? So these are the things you have to remember with regard to your measurement of national income in India, okay? And you also encounter another term here called as supra-regional sectors. What are they? Supra-regional sectors. See, whenever the service is spanning across the area, whenever it is not restricted to one particular area, but it is spanning across the areas, it is called as supra-regional sector, okay? So, in preparation of the state income estimate, certain activities like railway, communication, banking, you know that these services are not restricted to one particular area, right? They span across the areas. So, cut across the state boundaries, and their economic contribution cannot be assigned to one particular state. When one particular service is not restricted to one particular area, you cannot restrict to that particular state, right? It is spanning across the boundaries. So, what is done is all this income, whatever is being collected is, sent to the center, and then center will allocate the money to the states. The center will allocate the money to the states in the required proportion. So what is the formula for per capita income, students? It is national income divided by population. What is the formula? National income divided by population. Here the things that you have to remember is at the center level, who compiles the data? CSO. At the state level, you have the state directorates. These state directorates are assisted by the CSO if there is any requirement. And please remember this term called as supra-regional sector. That is those sectors, like those kind of operations whose operations span across the areas. They are not limited to a specific boundary or specific area. Next, let us discuss what is called as gross domestic product. Your gross domestic product is also called as GVA or nominal GDP or GDP at market price or GVA at market price. Most students have this question that what is the difference between GDP and GVA? Okay, so GDP is nothing but what the final value of all the goods and services produced. But GVA kind of gives you a picture of what is the contribution of each sector. So this is production side, this is consumption side, okay. GDP kind of gives a picture from the consumption side. GVA gives a picture from the production side, like what is the contribution of primary sector, what is the value addition made by the secondary sector, what is the value addition made by the tertiary sector. So GVA is talking about the supply side. GDP is talking about the demand side. That is the difference between GVA and GDP, but both are used synonymously, okay. Next, so what is the formula for GDP at market price? Do remember this. It is value of output minus intermediate consumption. And whenever I say value of output, it includes sales plus change in stock. What is sales plus change in stock? Sales plus closing stock minus opening stock. What is change in stock? Closing stock minus opening stock. That is, I am only considering what is the amount of output that is produced in this particular year. I don't want what is produced in the previous year. You know that whenever something is not sold, it is carried forward to the next year as what? In this year, it will become your closing stock. In the next period, it will become your opening stock. So what am I doing here? I am deducting my opening stock because this is related to the previous year. I only want the current year information, like whatever that I have produced in the current year. So it is sales plus change in stock minus intermediate consumption. See, whatever you are using in the production process to produce that final good, that is your intermediate consumption, that is deducted. In your GDP, you are only taking the final value of goods and services. Those goods which are used in the production process, that is not taken into consideration. So, value of output minus intermediate consumption. When somebody asks you why you are deducting, because you are only taking the final value of goods and services, you don't want any duplication to happen. So, intermediate consumption you are ignoring. So, in intermediate consumption, we are talking about the raw material or inventories that are used in the production process, right? And this intermediate consumption, as you are only taking into consideration the inventories or raw materials that are being used in the production process, you don't consider depreciation intermediate consumption, okay? Depreciation is related to what? Assets, okay? That is not taken in intermediate consumption. In intermediate consumption, I am only talking about the inventory that is being used in the production process. Depreciation is calculated on what? It is calculated on fixed assets, okay? That treatment is different. So, don't include depreciation. Don't tell me that, madam, see, depreciation is what? You are using the asset. So, the machine is depreciated. It is also wear and tear. As this is also used in the production process, we will include this also. No, that treatment is different. So, for the formula of GDP is GDP at market prices, value of output minus intermediate consumption. What is value of output? Sales plus change in stock. What is change in stock? Closing stock minus opening stock, right? Next, let us discuss another concept called as nominal GDP and real GDP. In economics, you have called as concepts called as nominal GDP and real GDP, okay? So, what is real GDP? Whenever you are deducting inflation from your nominal GDP, that is your real. Okay, in economics, whenever you encounter terms called as real, it indicates that they are not including the component of inflation in them, right? So, for example, I'll take 2 years, 2021 and 2022. Okay, 2021 and 2022. And let me take that price quantity, okay? So what happened here was the prices in 2021 were some 100 rupees and the quantity that you produced was 1000 units. The prices in 2022 were, let us say, 150 rupees and the quantity that you produced was 1000, okay? So how will you calculate the GDP? Now, the final value of goods and service, right? How will you get the final value? Price multiplied by quantity. So, what is the value of your GDP in 2021? It is what? 1 lakh. What is the value of GDP in 2021? It is 1 lakh. What is the value of GDP in 2022? 1 lakh 50,000. Now, I want to know whether the value of GDP in 2022, which I am encountering to be 1 lakh 50,000, it is a nominal increase or real increase. What do you mean by nominal increase? If any increase in the GDP takes place due to rise in the prices, it is called as nominal increase. But if the increase takes place due to increase in the production activity, that is called as real increase. If you see with your naked eye, you can understand that in 2021 also my production was 1000. In 2022 also my production was 1000. So is there any real increase that you are seeing here? There is no real increase. See, whatever increase that you are seeing from 1 lakh to 1 lakh 50,000, it is due to increase in the prices. It is due to increase in the prices. So as there is no real increase, I cannot call it as rise in the real GDP, but I will only call it as rise in the nominal GDP. Now, what I will do is I will calculate real GDP for 2022. Whenever I multiply current year prices with the production, it is nothing but nominal GDP. Whenever I multiply my current year production with the base year price, what is your base year? I am taking 2021 to be my base year. Students, always remember that whenever you are calculating real GDP, you consider base prices because you don't want to take into consideration the component of inflation, because that is not giving you the real picture if in reality the number of goods and services you have produced has increased or decreased, right? So what I did was, the 2021 price that you are seeing here is my base price. So what I will do, I will multiply my current year production with the base price. What is my base price? It is 100. So 100 multiplied by 1000 is 1 lakh. What is my nominal GDP? It is 1 lakh. What is my real GDP? It is 1 lakh. So what does this indicate? There is no increment. There is no increment in the production. So that is the reason why your real GDP is constant. So it is indicating that you have not produced any additional goods and services, right? So let us write another formula. You have a concept called as GDP deflator. You have a concept called as GDP deflator. So what is the formula of GDP deflator? See, GDP deflator kind of eliminates the inflation component. See, what is the meaning of deflator? You're kind of, reducing the impact of something, right? You're deflating something. You're reducing the value of something. So the formula is nominal GDP by real GDP, right? So how do you calculate nominal GDP? Let us take like this. P1 is the current year price. Q1 is the current year quantity. P0 is the base year price. Q0 is the base year quantity. Okay. So how do you calculate your nominal GDP? Current quantity Q1 multiplied by current price. How do you calculate real GDP? Current year quantity. This is real GDP of 2022, nominal GDP of 2022, real GDP of 2022. How do you calculate real GDP? Real GDP is calculated at base prices. Real GDP is calculated at base year prices, right? So it is Q1 multiplied by P0. So your current year quantity, you are multiplying with the base year prices to understand if there is any increment in the output or not. So what will happen to Q1? It will get cancelled. What will you get? P1 by P0 into 100. Okay, this is into 100. Just write down P1 by P0 into 100. See, P1 by P0 into 100 is measuring what? It is measuring inflation. What is it called as price index? I hope you all are aware about it. P1 by P0 is nothing but your price index. So you are comparing P1 with the base year price. P1 is the current year price. P1 is compared with the base year price, and it will tell you the amount of inflation that is there in the economy. So this is nothing but your price index as well. GDP deflator is also called your price index, right? So this is talking about the amount of inflation. Next. So let us see the concept. Real GDP or GDP at constant prices. This constant prices is also called as base price. Constant prices are also called as base price. Sum of the quantities of final goods times the constant prices. Constant prices is nothing but the base year price. In our example, 2021 is the base year price. So I am multiplying my current production with the base year price to know the value of real GDP. Excuse me. To measure the change in the production over time, it must eliminate the effect of increasing prices. So if you want to really know the impact, whether you want to know really the GDP has increased or decreased, you have to eliminate the impact of prices, right? You have to eliminate the component of inflation. So what is the formula for GDP deflator? It is nominal GDP by real GDP into 100. So what did they explain about GDP deflator? The calculation of real GDP gives us a useful measure of inflation known as GDP deflator. That is, it measures the change in the prices. People, I have written the formula earlier also. So what is it doing? It is also called as price index because it is measuring the amount of inflation. GDP deflator also used to deflate or take the inflation out of GDP. So GDP deflator can be expressed as nominal GDP by real GDP. So what is your nominal GDP? P1 multiplied by Q1. What is your real GDP? P0 multiplied by Q1 into 100. So it will sum up to be P1 by P0 into 100. So it is nothing but your price index. So they have written it here. Price index. Price index is nothing but your GDP deflator, people. Don't get confused. So how can you write your nominal GDP? Nominal GDP is nothing but your GDP deflator or price index multiplied by real GDP. That's it. This formula you can, interchange, and then you can do a number of things with it. You can calculate nominal GDP using it. You can calculate real GDP using it. Your wish. Now, what they did in your exam was they have given the GDP deflator of 2 years. They have given the GDP deflator of 2 years, GDP deflator of year 1, GDP deflator of year 2. Now they are asking you to calculate the inflation rate. What did they do? They have given the GDP deflator of 2 years, and now they are asking you to calculate what? They are asking you to calculate the inflation rate. So what is the formula? You all know that it is nothing but new value minus old value divided by old value into 100. Inflation and rate is nothing but, see, compared to year 1, in year 2, was there any increment in the prices? So that is the inflation rate, right? Rise in the general price level. So how do you do that? GDP deflator in year 2 minus GDP deflator in year 1 divided by GDP deflator in year 1 into 100. That is the formula for inflation rate. When will you use this? When they have given you the GDP deflator of 2 years, you are going to use this formula, right? Next, let us understand GDP at factor cost. Students, what I am going to do right now for you is, before going to these concepts, let me write down something for you and make these things easy. We are actually, discussing the concepts of national income accounting, right? So let me write down some key terminologies for you again. So when do you say the value is net? It is gross minus depreciation. It is gross minus depreciation, okay? Market price is nothing but factor cost plus NIT. Factor cost is nothing but market price minus NIT. Are you understanding what am I doing? Yes. So these are the things. Domestic plus NFIA is equal to national. Domestic plus NFIA is equal to national. These three things you have to remember to play with the concepts of national income accounting. So what did I write down first? I have given you GDP at market price. I have given you GDP at market price. Now what am I doing is, I am asking you to convert this into NDP at market price. I am asking you to convert this into NDP at market price. Now what you have to do is, you have to compare the letters here, okay? Gross, net. So there is a difference here. You have to adjust G for G so that it can become net. Yes, remember that. Domestic, domestic, same. No adjustment required. Market price, no adjustment required. So how will you get NDP at market price from GDP at market price? You have to deduct depreciation. So GDP at market price minus depreciation is equal to NDP at market price. You all know that gross minus depreciation is nothing but net. Let us do another thing. Suppose you are given GDP at market price and you are asked to convert this into NNP at factor cost. You are asked to convert this into NNP at factor cost. So what is the difference? Here it is gross, here it is net. So from gross, if you have to get net, what should you do? You have to deduct depreciation. Here it is domestic, here it is national. So from domestic, if you have to get national, what should you do? You should add NFIA. Next, here it is market price, here it is factor cost. So from market price, if you have to get factor cost, what will you do? You will deduct minus net indirect taxes. So this is your formula. So what did we do here? We have compared the letters. We learned 3 basic formulae, and from that we are playing with concepts of national income accounting, right? So let us see the next concept. What did they give for you? Yeah, they are talking about GDP at factor cost. Earlier, what did you talk about? You spoke about GDP at market price. So if you want GDP at factor cost from GDP at market price, how will you do it? Market price, factor cost. The remaining all are same. So from market price, if you have to get factor cost, you have to minus net indirect taxes. Yes, this is one formula. This is one formula. Another formula that you can write down is, I'm just writing this down for you. You just say if it is correct or not. What I can write is NDP at factor cost plus depreciation. Can I write it this way? Is equal to GDP at factor cost, right? So if for net, if you add depreciation, that will become gross. So if I write down NDP at factor cost plus depreciation, that is nothing but GDP at factor cost. So what is the meaning of NDP at factor cost? NDP at factor cost is nothing but the factor payments that you are making for factors of production. NDP at factor cost is nothing but the factor payments that you are making for factors of production, right? So what are your different factors of production? Land, labor, capital, entrepreneur. For labor, what will you be paying? You will be compensating them for their skill, right? So it is nothing but compensation to the employees. Whenever I am saying compensation to the employees, that includes salaries, wages, it includes what? It includes cash in kind and also cash. Okay, so you can also give it in terms of some benefits, allowances, that also can be considered as compensation to the employees. Okay, next, operating surplus. The meaning of operating surplus is rent plus interest plus profit. What is the meaning of operating surplus? It is rent plus interest plus profit. Rent is paid to whom? Land is paid rent. Interest is paid to capital. Entrepreneur is paid profit. So I have taken all the 4 factors of production: land, labor, capital, entrepreneur. For labor, you are paying what? Wages and salaries. That is nothing but compensation to employees. And for land, you are paying rent. For capital, you are paying interest. And for entrepreneur, you are paying profit. So all rent plus interest plus profit together, these 3 words are called as operating surplus. You are introduced with another term called as mixed income of the self-employed. You are introduced with another term called as mixed income of the self-employed. Who are self-employed? Entrepreneurs, like who are doing their own business without work, who are not working under somebody else, are self-employed. See, the problem with the self-employed is they are using their own resources in the business. They may be using their own land, they may be using their own manpower, everything. But are they being paid wages, rent like that separately? No. They are only paid something called as what? Profit. If they get profit, they will get it. So the problem what we encountered was we are unable to differentiate what is the amount of rent, what is the amount of wage, what is the amount of interest in the case of self-employed people. That is the reason we have introduced the category of mixed income of self-employed. So whoever is, finding their own occupation without working under somebody else, we categorize them under mixed income of self-employed. So compensation to the employees plus operating profit plus mixed income of the self-employed. Till here, you call it as NDP at factor cost. Okay, compensation to the employees plus rent plus interest plus profit plus mixed income of the self-employed. All these are nothing but factor payments, right? So all the factor payments together, they are called as NDP at factor cost. So NDP at factor cost is nothing but the summation of the factor payments. So if you add depreciation for that, it will become GDP at factor cost. It will become what? It will become GDP at factor cost, right? So the next concept that you see here is GNP at market price. See, above what did we get? We got GDP at factor cost, right? So if you want to convert GDP at factor cost into GNP at market price, how will you do it? You have GDP at factor cost. You are planning to convert that into GNP at market price. You are planning to convert that into GNP at market price. Gross, they are same. If you have to convert domestic to national, you have to add NFIA. Next, if you have to convert factor cost to market price, you have to add net indirect taxes, right? This is one way you can do. What is the other way? GNP at market price is equal to GDP at market price plus NFIA, net factor income from abroad. Gross, similar. National, you have to, you have from domestic, you need to get national. So what did you add? NFIA you have added. Market price is similar, right? So this is how you convert. Please remember the 3 mantras, that is gross minus depreciation is net. Next, indirect taxes minus subsidies is net indirect taxes, that you all know. But factor cost plus NIT will give you your market price. Another thing that we discussed was domestic plus NFIA is equal to national. If you remember these things, these 3 things, you will be able to do the what? Conversions. Next, the market value of what is GNP? The market value of all final goods and services produced within the domestic territory. It is adjusted for what? It is adjusted for net factor income from abroad. So GNP is the total income earned by the nation's permanent residents. So we are only talking about nationals here. We are not talking about, foreign residents. Next, GNP differs from GDP by including the income that our citizens earn abroad. So what am I talking about? Whenever I say national, I am considering my citizens. See, I am not taking into consideration the income that is earned by foreigners. I will deduct that income. I will add, see, my nationals can be staying anywhere in the world. So anywhere they are staying, that money I will take into consideration because they are my citizens. Next. So let us see this. If NFI is positive, what will happen? So you have 2 concepts, right? You have GDP, you have GNP, right? GDP plus NFIA is nothing but your gross national product, right? So for example, if NFIA is positive, when will NFIA be positive? If your receipts are more than the payments, NFIA will be positive. If your receipts are less than the payments, NFIA will be negative. So if NFIA is positive, then what will happen? Your GNP will be greater than your GDP. What will happen if your GNP will be greater than your GDP? What will happen if NFI is negative? Your GDP will be greater than your GNP. Your GDP will be greater than your GNP. Next concept is NDP at market price. How will you derive? This is your GDP at market price. If you minus depreciation, that will give you your net value. So gross minus depreciation is nothing but net domestic product at market price. Next, NDP at factor cost. So how will you derive that? You have NDP at market price. If you want factor cost, you have to deduct net indirect taxes. People, what is the formula of NDP at factor cost that we learned? NDP at factor cost is nothing but what? Compensation to the employees plus operating surplus plus mixed income of the self-employed. That is the formula for NDP at factor cost, right? So do you remember that? If you add NDP at factor cost, if you add NDP at market price and if you deduct net indirect taxes, you will be getting your NDP at factor cost. If I have to repeat this for you, this is a direct formula which we have learned earlier, right? NDP at factor cost is what? Factor payments that are being made to the factors of production, which are your land, labor, capital, entrepreneur, right? So which is compensation to the employees, rent plus interest plus profit. All these three terminologies together will be called as operating surplus plus mixed income of the self-employed. That is NDP at factor cost still there. That is a direct formula. But what is the other way you can write NDP at factor cost? It is nothing but NDP at market price minus net indirect taxes. People, from market price, if you deduct net indirect taxes, it will become what? It will become factor cost. Next, NNP at market price. So it can be written as GNP at market price minus depreciation. Gross minus depreciation is net. Yes. So that is what they have done here as well. Next, NNP at factor cost or national income. Very, very important. Your national income is also referred to as your NNP at factor cost. So for example, I have given you GDP at market price. I am asking you to convert this into NNP at factor cost. Please pay close attention here. Here it is gross. I want net. What is it that I want? I want net. So what will you do? You will deduct depreciation. Next, here you are having domestic, but what do I want? I want a national. So what will you add? You will add NFIA, net factor income from abroad. Here what do you have? You have market price. What is that I want? I want factor cost. So you have to deduct net indirect taxes. This is how you do it, right? So net national product at factor cost or your national income. It is the factor income accruing to the normal residents of the country during a year. It is the sum of the domestic factor income and NFIA. What is domestic factor income? It is NDP at factor cost. What is domestic factor income? It is NDP at factor cost. If you are adding NFIA to this, it will become NNP at factor cost, right? Next, generated within the country plus factor income from abroad in an accounting year. It includes earned income only. Very, very important. See, whenever you are calculating your national income, you don't take into consideration transfer payments, my dear. In the beginning, while we started the lecture, I discussed something called as transfer payments, right? It is one-way traffic. There is only incoming. You are not doing any productive activity, but still you are receiving money. That is what unearned income. That is your unearned income. So I don't take into consideration unearned income while I am calculating my national income, right? So while calculating your national income, please do consider only your earned income. That is something you are earning for productive activity. Something that is not earned out of productive activity is considered to be transfer payment. It is not included in the national income. Next, you have your concept called as personal income, private income, which is very, very important. Most students, I don't know why, but they feel confused with this private income and personal income. Don't worry, in your lecture we will solve that for you. We'll have a discussion on your private income, personal income. We will be also doing some problems so that you will not have any future confusion. Okay, so what we will do is we'll start discussing your private income, personal income. Friends, welcome back. So in the last session we have completed the concepts of national income, right? So if you want a brief revision on the concepts of national income accounting, I told you to remember those three mantras. What are those three mantras? I told you that whenever you are hearing the term net, it indicates that it is gross minus depreciation. It is gross minus depreciation. And whenever you are hearing the term national, it is nothing but domestic plus NFI. Whenever you are hearing the term national, it is nothing but domestic plus NFI. What is NFI, students? It is net factor income from abroad. That is factor income from abroad minus factor income to abroad. What does that mean? It means receipts minus payments. Okay. And what else do you have to remember? You have to remember that factor cost plus net indirect taxes is equal to market price. What are net indirect taxes? It is nothing but indirect taxes minus subsidies. Clear, everybody? So if you remember these three things, you can do the concepts of national income accounting. Now, if we have to continue our discussion, we need to discuss about your personal income and private income. You all know that in national income accounting, we do not consider transfer payments. Now, what are transfer payments? To help you revise the thing, transfer payments are nothing but one-way traffic. Okay, they are not, given out of some productive activity. For example, you can take your scholarships, you can take the unemployment benefits. All these come under your transfer payments, donations, etc. So we have three types of transfer payments, right? What are the three types of transfer payments, may I know? They are transfer payments from government, transfer payments from rest of the world, and interest on public debt. What are the three types of transfer payments? Transfer payments from government, transfer payments from rest of the world, and interest on public debt. Okay, so this interest on public debt is a revenue expenditure. Okay, it is not yielding you any result, which is why it is considered to be a transfer payment. So whenever you are doing the national income accounting, whenever you are discussing the concepts of national income accounting, we have not taken these three things into consideration, right? So what you have to do right now is, while you're calculating your personal income or private income, you need to include transfer payments. That is, all these three transfer payments have to be taken into consideration. And we all know that there are three agents, which are households, business firms, and the government. These three constitute our economic agents, right? Whenever you are talking about the income of households and business firms excluding the government, it is called as private income. It is called as private income. Okay, and whenever you are only talking about the income of the households excluding business firms and government, it is called as personal income. So in personal income, you only have the household's income and the transfer payments, but in private income, you have the household's income and business firm's income, which is excluding the government income. Okay, so these are the things you have to remember coming to your personal or private income. What we will do right now is, we'll first have a look at your private income and then we will proceed to your personal income. So let us see the points. Yes. So yeah, first we'll have a look at your private income, students, then I'll take you to the personal income, because private income is households plus business firms, right? So after calculating private income, if you just deduct business firms, that will be getting you your personal income. So let us see your private income. Where is it? Yeah. So what is private income? It is nothing but it is a measure of income, both factor income and transfer income. Do you see this? That is what I have been trying to tell you. While calculating your personal income or private income, you have to take transfer payments into consideration. And how many types are there? Three types of transfer payments have to be taken into consideration, right? Which accrues to private sector. What do you mean by private sector? It includes households and business firms. So what is the formula for private income? It is the factor income from NDP accruing to the private sector. Again, private sector includes households plus business firms, plus net factor income from abroad. Why are they doing this? See, till here what did you get? You got NDP at factor cost. Now if you have to transform NDP into NNP, that is, domestic has to be transformed into national. Domestic has to be transformed into national. How will you get national? National is equal to domestic plus NFIA. National is equal to domestic plus NFIA. So, you have to add the net factor income from abroad. National debt interest or interest on public debt is one and the same. So, what is this? It is transfer payments. Transfer payments from government and transfer payments from rest of the world. That is what I have been trying to tell you. So what did you do in your private income calculation? You took the income that is accruing only to the private sector, that is your households and business firms. As it is NDP at factor cost, you wanted to transform it as NNP at factor cost because we want national, right? So you have added NFIA. For that, you have added all the three types of transfer payments, that is interest on public debt, transfer payments from government and transfer payments from rest of the world. What is the other formula for your private income? It is nothing but national income minus. See, whenever I am saying national income, it is nothing but NNP at factor cost. Whenever I am saying NNP at factor cost, it is including all the three economic agents. It is including all the economic agents, that is households, business firms and government. Now, it is your responsibility as you are calculating private income, you have to deduct the government income. So, whatever money income that is accruing to the government sector, that has to be deducted. Government income also includes the non-departmental enterprises. What does it include? Savings of the non-departmental enterprises. Okay, so non-departmental enterprises are nothing but those which not come under a certain department or a particular department. Example, you can take this ONGC, you can also take the RBI. So whatever savings that are being accrued to the non-departmental enterprises, that is also government income. You know that RBI is a fully owned government body. So whatever savings that RBI does, whatever money income that RBI has, like it is given in the form of dividends to government of India. So that also has to be taken into consideration. And while calculating your private income, you have to deduct that. You have to deduct that, right? So it is national income minus income from domestic product accruing to government sector. So accruing to government sector also includes savings of non-departmental enterprises. People, you will be encountering this term while you are doing the problem. So please take a note of it. So what is the savings of non-departmental enterprises? Even they have to be deducted from your national income while you are calculating your private income. And in your national income calculation, did you take into consideration transfer payments? You have not taken into consideration transfer payments. Transfer payments are again three types. So all the three types of transfer payments have to be added, right? This is the formula for your private income. And what else can be done for the calculation of private income? It is nothing but personal income plus corporate tax plus undistributed profits. How did we arrive at this? Okay, let me just help you out with this. I already told you that whenever you are talking about personal income, it is only taking into consideration households. So whatever income that is being accrued to households plus transfer payments is nothing but your personal income, right? So you remember corporate profits? Corporate profits. This is something that is accruing to the business firms, right? Corporate profits include three things. Corporate profits includes three things. What are those three things? One, you can pay corporate taxes. Corporate taxes. Next, dividend is paid out of it. Next, something is called as retained earnings or undistributed profits. Okay, what are the three components? They are corporate taxes, dividend, retained earnings or undistributed profit. Okay, so out of the corporate profits, whatever you are earning, some is paid as corporate taxes, some is paid as dividend and some is put aside as retained earnings. Now what is the only thing that is going to household in all these three things? It is only the dividend that is going to the households. It is only the dividend that is going to the households, right? So these two things, which are corporate taxes and undistributed profits or retained earnings, are not taken into consideration while you are calculating your personal income, right? So these two things are a part of what? Corporate profits. Corporate profits belongs to whom? Business firms. So when you calculate your personal income, for that, if you add this corporate taxes and undistributed profits, that will become your private income. Okay, so that will become your private income. Transfer payments you already included while you are calculating the personal income, so you don't have to include them again. So whatever you have deducted from the private income, as it is not a part of your personal income, that if you add back, it will become your private income. So I hope you understood. So the key things that you have to remember about your private income is that it is being accrued to households and business firms. In national income accounting, you are not taking transfer payments into consideration. So you have to add transfer payments while you are calculating your personal income and private income, right? Next, let us discuss your personal income. Okay. Yeah. So this is your personal income. Income received by household sector. What are they saying? The income accruing to the household sector is considered as your personal income, including non-profit institutions serving households. You know, the NGOs, they kind of perform some functions for the households. So whenever they are rendering some services to the households, that also has to be taken into consideration while calculating your personal income, right? Next, it forms the basis for consumption expenditure and is derived from national income. So how are you deriving your personal income? You are deriving that from your national income. So in your national income, you have your business firms, you have your households, you have the government. If you eliminate your business firms and government, you will be left with whom? Households. If you add transfer payments to that, what it will become? It will become your personal income. So personal income is nothing but national income plus income received but not earned minus income earned but not received. See, the simple meaning of this is, while calculating personal income, you are only focusing on the households. While calculating personal income, you are only focusing on the households, right? While calculating national income, you only take into consideration those activities which are productive in nature, okay, which are productive in nature. You do not take into consideration transfer payments. For example, the households are working somewhere and they have received the salary. But do they receive the entire salary? No, right? Some portion is cut in the form of PF or whatever it is. So some portion is cut. Whatever portion they are not receiving, I am not taking that as a consideration for calculation of personal income. I am only taking into consideration whatever I am receiving in my hand. That only has to be taken into consideration while calculating personal income. So even though you earned that income, but still if you are not receiving it, I am not going to take it into consideration while calculating personal income. So I only take into consideration those things which are actually touching my hand, which are actually, you know, in which I'm actually getting. So if you take unemployment benefits, for example, you are not doing anything, but still you are receiving the money. As you are receiving the money, even though you have not worked hard for it, I am taking into consideration while calculating the personal income. Okay. So income received but not earned is what? Transfer payments. Example, your scholarships, pensions, your, you know, unemployment benefits, all that can be taken as an example for your income received but not earned. What is income earned but not received? See, you worked a lot for the organization, but the organization is, you know, retaining some money and paying the remaining to you. So whatever retained earnings are there, I have told you, right, corporate profits is split into corporate taxes, dividends and retained earnings. Retained earnings, are you getting that money? It is not, you know, given to you. It is retained with the company. It is held by the company. As you are not getting that, will you include that while calculating the personal income? No, you will not take that into consideration while calculating personal income. So retained earnings are not taken. Indirect business taxes. See, corporate taxes are they being given to, I mean, are they giving that to you? No, you are not receiving those corporate taxes, right? So that also we don't take into consideration. Corporate income taxes and contribution of the employers to social security. So any social security contributions like your provident fund contribution, that is also not taken into consideration while calculating your personal income, because even though you earned that money, you are not still receiving it, right? While calculating personal income, I only take the money that has been received, right? So personal income is national income minus undistributed profits is nothing but your retained earnings. As households are not receiving that, I am going to deduct that. Next, net interest payment made by the households. See, whenever you are encountering the term net, it includes receipts minus payments. Whenever you are encountering the term net, it means receipts minus payments. See, households make some interest payments, household receives some interest payments. So the net amount is kind of, you know, taken into consideration. Here they said minus. What is the meaning that you're deducting things? That is, whatever is outgoing is more when compared to whatever is incoming. So receipts minus payments, right? If payments are more than receipts, the value will be negative. If receipts are more than payments, the value will be positive, right? Minus corporate taxes. This is not something that is, going to households. So I will deduct this. Transfer payments, all the three types. Transfer payments from government, interest on public debt, and transfer payments from rest of the world. All these three things have to be taken into consideration, right? So interest on debt anyway is kind of taken into consideration in this point. Net interest payment made by the household is nothing but interest receipts by the households minus interest payments by the households. So whatever remaining transfer payments are there, they have to be taken into consideration here, right? So both firms and government, they are giving some money, right? So that has to be taken into consideration. Next, so they have explained the net interest payment made by households to firms and government. Households receive interest payments from firms and governments. They also make interest payments to firms and governments. So I told you, right, it is receipts minus payments. Now let us continue with something called as disposable income. See, whenever you hear the term disposable income, it indicates that you are adjusting with taxes. So you calculated personal income, right? So if you minus taxes, personal income minus taxes is nothing but disposable income. What is it? Personal income minus taxes is nothing but disposable income. That is, which is readily there with you to spend. So disposable personal income is derived by subtracting direct taxes paid by individuals and other compulsory payments made to the government from the personal income. That is, it is minus personal income taxes. So whatever money you are left with right now, they can be used for consumption purpose or they can be saved. So it is disposable personal income is equal to C plus S. Like some money can be used for consumption purpose and the remaining can be saved, right? Next. What is net national disposable income? Let us see this. What is net national disposable income? So, it is the net amount of goods and services the domestic economy has at its disposal. See people, whenever I am saying net national disposable income, I am talking about at a national level, right? So, here it is net national income, right? So, this is NNP at market price. Always remember that you have to calculate your disposable income at a market price. You have to calculate your disposable income at a market price. So whenever I am saying this, that is the reason they kind of added the taxes, right? So net national disposable income is net national income plus transfers from rest of the world. So you have three types of transfer payments, right? Transfer payments from government, interest on public debt, and transfer payments from rest of the world. Remember? Yes. So when I write C plus I plus G, this is what the income earned by the economic agents. For this, if you add the transfer payments, then what will you get? You will be getting your disposable income. For this, if you, you have to adjust for taxes as well, net taxes. What do you mean by net taxes? The taxes that you are receiving minus taxes that you are paying. What do you mean by net taxes? The taxes that you are receiving minus taxes that you are paying, right? So if you adjust that with the taxes, then you will be getting your disposable income at a national level. Now, I have only taken transfer payments from rest of the world, right? I have not taken interest on public debt. I have not taken transfer payments from government. Why so? Because, see, government, if it is giving some money to the people or rather to the households, for example, government made some transfer payment of 500. So it is minus 500 for the government. And households are receiving that 500, so it is plus 500. So what will happen? It will set off. It will set off, right? Now interest on public debt. Government is paying, households are receiving. So there it is minus, here it is plus. So it is being set off between your government and households. For that very reason, in the transfer payments, which are of three types, I am only taking into consideration transfer payments from rest of the world. Transfer payments from rest of the world. The remaining are being set off. For that very reason, I am not taking that into consideration. Okay. So what is net national disposable income? Net national income plus net taxes on income and wealth receivable from abroad. I told you, right? Whichever net is receipts minus payments. So you have some obligations. You also have to receive some payments. That is, you have to pay some money. You have to receive some money, right? Next, plus net social contribution and benefits receivable from abroad. This is nothing but your current transfers from rest of the world. It is nothing but current transfers from rest of the world. Clear everybody? Next, what do you mean by gross? Here it is net, right? So after you calculate your net national disposable income, if you add depreciation to that, it will become what? Gross. If you add depreciation to that, it will become gross. See, the other name of depreciation is nothing but consumption of fixed capital. The other name for depreciation is nothing but consumption of fixed capital. Do remember that. So net national disposable income plus consumption of fixed capital, what will you be getting? You will be getting the gross national disposable income. Clear, everybody? Yes, I hope it is clear till here. Let us continue with the next thing. Okay. So we have already completed your private income. So what is your per capita income? Per capita income is nothing but national income divided by population. What is the meaning of per capita income? It is national income divided by total population. So on an average, how much each individual is earning, that you will be getting under your per capita income, right? So next you have your circular flow of income. In your circular flow of income, you have three phases. One is the production phase, second distribution phase, and disposition phase. Okay, final consumption. This is nothing but the final consumption. So in production phase, what do you do? Firms produce goods and services with the help of factor services. What are your factor services? The factors of production, which are land, labor, capital, and entrepreneur. In distribution phase, what will you do? You will disburse the factor payments. For land, you will be giving rent. For labor, you will be giving wages. For capital, you will be giving interest. And for entrepreneur, we will be paying profits, right? And what is disposition phase? After receiving these income, whatever money you are spending for consumption purpose is nothing but the disposition phase. That is, income received by different factors is spent on consumption of goods and services and investment goods, right? So these are the three phases that you have to remember. Next, you have different methods. Okay, in national income accounting, you have different methods. Okay, so first method that you will be learning is value added method. The second method is your income method, and the third method is your expenditure method. So as you have three phases, right, in your circular flow of income, you have three phases. You will be relating the three methods to these three phases. So in your production phase, which method you kind of notice is your value added method. See, even though you have different methods for your national income accounting, you cannot use all the methods in all the, all sectors, okay? Based on the availability of information, you keep changing the methods. So while you're in your production phase, actually value added method is something that requires data, relevant to that, right? So what is the meaning of value addition? Whenever you're, taking up the production process, whenever you're, making the final product, it passes through different stages of production. At each stage, some value addition is happening, right? So you are going to take into consideration the value addition that is made at each stage of production. For example, there is a farmer who is producing wheat, okay? From wheat to end result, that is a baker is selling bread, okay? Till there, what is the value addition that has happened? If you take that into consideration, the value addition at each stage, right? So he has produced wheat. The wheat is bought by a mill owner and he's, making wheat flour. That wheat flour is, bought by some, baker, and he's making bread out of it. And this bread is bought by, a sandwich making company. So it is making sandwiches out of it. So what is happening here? At every stage, some value addition is happening, right? So if you add up all the value addition that is happening, that is your value added method. So what are we doing here in value added method? You don't take into consideration the intermediate consumption. So what is your intermediate consumption? While you are undergoing the production process, you are using some intermediate goods. They cannot be called as final goods. They are being used in the production process, okay? So you are only going to take into consideration the final value, which is the reason you are going to eliminate that intermediate consumption. So you have a formula under your value added method, that is nothing but GVA at market price or GDP at market price. In the earlier session, while we are talking about concepts of national income accounting, I already told you that it is GVA or GDP, okay? When you're talking about supply side, it is GVA. When you're talking about demand side, it is GDP. So what is the formula under your value added method? It is value of output minus intermediate consumption. Okay, intermediate consumption matlab I am talking about the inventories that have been used in the production process. Okay, I am talking about inventories or raw materials that have been used in the production process. What do you mean by value of output? It is sales plus change in stock. What do you mean by value of output? It is sales plus change in stock. What do you mean by change in stock? It is closing stock minus opening stock. What do you mean by change in stock? It is closing stock minus opening stock. Okay, everybody. So what is the formula? You just have to revise. GVA at market price is also GDP at market price. It is nothing but value of output minus intermediate consumption. Intermediate consumption is nothing but the raw material that has been used in the production process. Okay, that I am kind of not taking into consideration. So it is value of output is nothing but sales plus change in stock, right? Sales plus change in stock. In that, what is the meaning of change in stock? It is closing stock minus opening stock. It is closing stock minus opening stock. So the sum of the net values added by all the producing sectors is nothing but your value added method. Is nothing but your value added method, right? So what do you get here? You get GVA at market price. You get GVA at market price. But you know that your national income is measured at NNP at factor cost. Your national income is measured at NNP at factor cost. Now what did you get? You got GDP at a market price. You got GDP at a market price. Students, you also have to remember different methods give different concepts. So under your value added method and expenditure method, you will be getting GDP at market price. Under your income method, you will be getting NDP at factor cost. Please remember this. Under your value added method and expenditure method, you will be getting GDP at market price. Under your income method, you will be getting NDP at factor cost. Okay. So this GDP at market price, you have to transform that into NNP at factor cost. This GDP at market price, you have to transform that into NNP at factor cost. So how will you transform gross to net? It is GDP at market price, right? We have to transform this only, no? So you have to transform gross to net. How will you get net? Gross minus depreciation. Domestic has to be transformed into national. Domestic plus NFIA will give you national. Market price has to be transformed into factor cost. So you have to deduct net indirect taxes. So you have to deduct the net indirect taxes. This is how you will transform your GDP at market price into NNP at factor cost. Okay, next. So what are the inclusions, exclusions and applicability? That also will take into consideration. On account of production of fixed assets. See people, what happens here is sometimes you do things for self-consumption. Even though you are using it for self-consumption, the production has been made, right? The production has been made. So that is the reason self-consumption has also been taken into consideration. Self-consumption also has to be taken into consideration. So how should you take that into consideration? You have to calculate the imputed value. Like what if, like whatever you are using for self-consumption, like what is the value of that service outside if it is actually sold out, something like that. You have to calculate the imputed value and you have to include that. Okay, next, production for self-consumption, that is what here they had talked about fixed assets. Suppose you are a manufacturing firm and you kind of made these machines, but some machines you used for your own purpose, but still you made those machines, right? Even though you used it for your own consumption, you made them, right? So they have to be taken into consideration. You are a farmer, you produced wheat, 1000 kgs of wheat you have produced. In that 200 kgs you have given that in your own family. Even though you have used it for your own self consumption, as you have produced it, that has to be taken into consideration, right? Next, imputed rent of self occupied houses. See, you have your own house, so you don't have to pay rent for that, but you're actually availing the service, no? Like you're having your own house, you're staying in the house, you're taking the benefit, right? So what if the same house, if you had to take it on rent, how much money you had to pay on rent, that also has to be taken into consideration. So it comes under services. Okay, next, production boundary and applicability is what? Agriculture. I told you, right? You have your primary sector, secondary sector, tertiary sector, right? So actually in a primary sector, what you do is that you use your value added method. In your primary sector, you can take the agriculture, right? So in that you use which method? You use value added method. And in your secondary sector, manufacturing sector, you use which method? You use income method. And the final, like tertiary sector, you kind of use which method? You use your expenditure method. You use your expenditure method. See how we have decided that this method has to be used here. It is based on the data availability. I told you, right? If you have to use value added method, you need to have the information with regard to the value addition that is made at each stage of production. So you find that in this. So that is the reason this method is applied here. The next phase is what? It is distribution phase. So here which method are we talking about? We are talking about your income method. See, what we do in your income method is that you have your 4 factors of production, right? So what are the factor payments made to 4 factors of production? That we sum up. And I already told you that in income method, what do you get? You get NDP at factor cost. Students, you already learned this NDP at factor cost in your concepts of national income accounting. So what is the formula of NDP at factor cost? It is the compensation to the employees plus operating surplus. What is the meaning of operating surplus? Rent plus interest plus profit. And we also bought out a new thing called as mixed income of self-employed. Because in the case of self-employed people, I am unable to distinguish what is rent, what is interest, what is profit. I am unable to do that. Okay. For that very reason, I bought out something called as mixed income of self-employed. And if you add all this, you will get NDP at factor cost. When I say NDP, it is net, right? If I have to get gross, what will I do? I will add depreciation to it. I will add depreciation to it. So actually in your income method, what is that you will get? You will get NDP at factor cost. It is nothing but the summation of the factor incomes, factor payments made to different factors of production. Land, labor, capital, entrepreneur. Okay. Compensation to the employees is nothing but the wages and salaries. In wages and salaries, you also have to take cash in kind, like whatever, services you are giving in kind, that also have to be taken into consideration. Clear, everybody? For example, for military people, they keep, giving uniforms, right? So that also have to be the services in kind, like kind is what? Service, no? So cash in kind is also taken into consideration. So what is the formula that you see and what is the meaning? First of all, it is the total factor incomes generated in the production of goods and services, right? So what do you see here? Compensation of employees. Next, operating surplus. What is the meaning of operating surplus? Rent plus interest plus profit. All three together are called as operating surplus. Mixed income of the self-employed, and they added depreciation here. So your NDP at factor cost will become your GDP at factor cost. But how do you measure your national income? It is NNP at factor cost. How do you measure your national income? It is NNP at factor cost. So what do you have to do right now? You have to transform your NDP at factor cost into NNP at factor cost. So you have NDP at factor cost, right? So this I have to turn it into NNP at factor cost. So NN both are same. Factor cost, factor cost. The only difference is domestic, national. So if you have to transform the domestic into national, what do you have to do? You have to add NFIA. You have to add NFIA, right? So it is NNP at factor cost is equal to GDP at factor cost minus depreciation. Here they have taken GDP at factor cost, but I told you take NDP at factor cost. Why so much of hard work? Take NDP at factor cost plus NFIA is nothing but NNP at factor cost. I told you, right, your profits have 3 elements, which are corporate taxes, dividends, retained earnings. Retained earnings is nothing but your undistributed profits. Retained earnings is nothing but your undistributed profits. Clear, everybody? Okay. So what are the inclusions that we have to take? Incomes from primary factors of production. So your factors of production are your land, labor, capital, entrepreneur, right? So all the incomes that are earning, we are taking that into consideration. Labor and capital, mixed income of the self-employed. We did include that. Yes, labor is given, compensation, capital, interest, mixed income of the self-employed. We actually included as separate element, right? Next, commission and brokerage. People, here you have to pay very good attention because I'm going to tell you something very, very important. You keep hearing the transaction, that sale of second-hand goods and financial instruments, all that you keep hearing, right? So whenever I'm saying that there is sale of financial instruments, suppose I'm having shares, I'm having a shares of a company, okay, company X shares I'm holding. So if there is a sale of these shares, I am transferring these shares to some other person, okay? So additional productive capacity, is anything being created? No. Until now shares were in my hand. Now from my hand they have been transferred to somewhere else. That's it. So whenever you're talking about these financial instruments, there is only transfer of this wealth. So you cannot take that into consideration as creation of additional productive capacity. And the same goes for second-hand car market, right? So last year a car has been manufactured, and that production of that car has been included in that year GDP. So last year it has been manufactured, and whenever it has been manufactured, that year it has been taken into consideration. Now there was a sale of this car. So second hand car, right? Already this car's accounting has been done whenever it has been produced. Again, you should not take that into consideration. That will result in double counting. That will result in double counting. So always remember, sale of second hand goods should not be taken into consideration. And these, financial instruments, there is only transfer of wealth here. There is no creation of additional productive capacity. But what should we include here is, while this brokerage and commission you keep hearing, right? For me to conduct this sale of sale of goods like second hand goods, whatever is there, I will contact a broker. And he's kind of giving me some service. So for him, what I'm going to pay, I'm going to pay some brokerage fee. That will be taken into consideration because he is giving a service, right? He's giving service, he's rendering the service. So whatever service he is being rendering to me, for that whatever money, whatever brokerage he is receiving, that has to be taken into consideration while your national income accounting is done. Okay. But the sale of goods, second hand goods, should not be taken into consideration. Whatever brokerage service is being paid, that has to be taken into consideration. Right? So commission and brokerage of sale of second hand goods. I'm not taking into consideration the sale of second hand goods. I'm only taking into consideration the commission or brokerage that is paid, for taking care of that transaction. Next, imputed service. What is this imputed service? Self-consumption. So if anything is done for self-consumption, that is also taken into consideration, right? Next, exclusions. So I already told you that transfer payments are not taken into consideration while you're doing national income accounting. Always remember, students, I'm only taking into consideration productive activities. So I'm not taking into consideration this one-way traffic, transfer payments, whatever they're not taken into consideration while you're doing your national income accounting. Next, income from the sale of second-hand goods. Illegal incomes. Why will they be taken into consideration? Not at all. So illegal income, capital gains. Why are you not taking capital gains into consideration? You hold a land and then someday you are selling it and then it is giving you some gains. So that is not taken into consideration. Additional productive capacity is not being created, right? So students, one hint that you can take is that whenever you feel that additional productive capacity is not being created, that is not taken into national income accounting. So you don't take capital gains, windfall profits, sudden profits, okay? Some lottery or betting has been done and suddenly you have earned some money. That is also not taken into consideration. Payments out of past saving. So whatever past savings you have done, so payments out of that also is not taken into consideration. Next, interest paid by the government on public debt, because this is considered to be transfer payments. Interest on public debt is nothing but a transfer payments, right? Next, by one firm to other on the consumption loans. I told you, right? Interest payments are considered to be revenue in nature. So they are only, they are only considered as a headache. So they are considered as transfer payments. So they are not taken into consideration in national income accounting because they are not generating any additional productive capacity. Clear, everybody? And when it comes to income method, you apply that in your manufacturing sector. Next, let us talk about your expenditure method. Very, very simple, people. The formula for your expenditure method is C plus I plus G plus X minus M. What is the formula for expenditure method? C plus I plus G plus X minus M. That is consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports. So you kind of take into consideration the expenditure that is made by the economic agents. For that, you add your net exports. What do you mean by net exports? Net exports is nothing but exports minus imports, right? So whenever I am taking your consumption expenditure, I'm talking about your households. Okay. So let us see the formula, whatever they have given here. Let me elaborate that for you. So they have given, I told you, remember, different methods will give you different concepts of national income accounting. So in your income method, you got NDP at factor cost. In your expenditure and your value added method, you will be getting GDP at market price, right? So what is this? Final consumption expenditure. In this final consumption expenditure, you have private final consumption expenditure and public final consumption expenditure. Okay, you have private final consumption expenditure and public final consumption expenditure. This public final consumption expenditure is nothing but expenditure on goods and services by the government. Expenditure on goods and services by the government. Private final consumption expenditure is the expenditure on goods and services by the households. What is it? Expenditure on goods and services by the households. Next, what is this gross domestic capital formation? They are talking about investment. Investment, that is increasing the productive capacity. Whenever they are talking about the gross domestic capital formation, they are talking about the investment that is increasing the productive capacity. Okay, and it includes both fixed assets and inventories. It includes both fixed assets and inventories. Whenever I am talking about gross domestic capital formation, I am including fixed assets and inventories as well, because both of them increase the productive capacity of a country, right? And in this, I also include one more term called as, whenever I am investing in valuable assets. So whenever I am procuring valuable assets, that is also called the gross domestic capital formation. For example, I'm, getting some valuable jewelry, I'm getting some valuable paintings, that is also taken into consideration, right? Next. So, but here we got what? We got GDP at market price. Your national income is measured at NNP at factor cost. So it is your responsibility to transform GDP at market price into NNP at factor cost. Remember the three mantras? You have to remember the formula for net. You have to remember how you will get factor cost. You have to remember how you will get national. National is nothing but domestic plus NFIA. Your net is nothing but gross minus depreciation. And how will you get your factor cost? It is market price minus net indirect taxes. Market price minus net indirect taxes, right? So these are your methods. What are these methods? Value added method, income method, expenditure method. Clear everybody? Yes. Next. So they have given a note with regard to your product method, a note on your income method, and yeah. So what they have done was they have explained the elements of your different methods. That's it, nothing more. But what we will do is we'll just go through this also, okay, so that it will give you more clarity. And next is your, a briefing on your expenditure method. These things we have already discussed, but we will do it again for your understanding, okay. This is just an overview of the chapter, so this is not very important, but if you understand these three methods, you are actually done with your national income accounting chapter, okay. So here they have just discussed what is the usefulness and what are the hassles, like some areas where that are left out from the national income accounting just because they cannot be measured. So what are those things? They have just given a brief overview, okay. So let us just start with your explanation part. Let us start with your note 1. So what is your product method? People don't get confused. Product method is also called your value added method. Product method is nothing but your value added method. Okay, everybody. So producing firms are classified into three sectors. So what are the three sectors? Primary sector, secondary sector and tertiary sector. So again, these sectors are classified into what? Subsectors. Again, your primary sector is classified into subsectors, your secondary sector, and same goes for your tertiary sector. So sectors: primary, secondary, tertiary, each sector into subsectors. Again, subsector is also classified into some commodity groups. Again, subsector is also classified into commodity groups. Okay. So we can take your primary sector as agriculture is there, fishing is there, and their mining is there. So you classified them into subsectors. Under agriculture, you can classify commodity groups, right? You have got millets, you have got pulses. So again, you will classify them into commodity groups. So if total purchases are given, then imports are included in the intermediate consumption. Okay, this is kind of important for you while solving your problems. Please pay close attention. What is the formula under your gross value added method? It is value of output minus intermediate consumption. What is value of output? It is sales plus change in stock, right? It is sales plus change in stock. What do you mean by intermediate consumption? Anything that is used in the production process, the inventories, raw materials are your intermediate consumption. Now, whatever raw materials you are using in the production process, it is not a mandate that they are acquired only in India, right? There is a possibility for you to import that, right? So whatever purchases you are making for the production process, if they give you in the exam that they are only talking about domestic purchases, it is your responsibility that you add imports for that, So So whenever they are talking about intermediate consumption, it includes domestic purchases and imports as well, because whenever you are indulging in the production process, it is not a mandate that whatever raw materials you are procuring, they are only from India. They can also be from abroad, that you will be importing. Okay. Next, whenever I say sales, you not only indulge in domestic sale activity, but also you kind of export goods and services, right? So when I say sales, so you need to include domestic sales and exports as well. So in the question, if they have just given you domestic sales, it is your responsibility to include exports in it as well. Okay. So these are the points we wanted to tell you. Next, under your income method, whenever I am saying compensation to employees, I told you, right, you also kind of take into consideration the service aspect as well. Cash in kind. So wages are there, salaries is there, dearness allowance. What do you mean by dearness allowance? Whenever the inflation is increasing, that is the prices are rising. So what companies do is to match with the rising prices, they increase the salaries by a percentage. Okay, that is your dearness allowance. Next, your commission, bonus, employer's contribution to PF, imputed value of the compensation in kind. What is this? Compensation in kind. I told you, I gave you an example of the military uniforms, right? So they are given uniforms. So this is nothing but compensation in kind. Even though they are not being compensated for their services in cash, they are being offered some services, right? Next, what are your non-labor incomes? One is the rent, royalty, interest on loans for productive services, dividends, undistributed profits of the corporations before taxes, profits of unincorporated enterprises and government enterprises. So these are your non-labor incomes. We have just written rent plus interest plus profit, right? So what they have done is they have elaborated that. So whenever you are calculating your national income, what you do is that you do not deduct taxes, okay? Undistributed profits before corporation before taxes, like before elimination of taxes, you take into consideration. Clear, everybody? Next, mixed income is difficult to separate labor income from capital income. I already told you, right? In some cases, if you are a self-employed person, I cannot tell you whatever money you are taking after, the operations of the business, you are taking some money home. So what is the wage portion? What is the interest portion? I am unable to, separate it. So that is the reason we introduce a new category called as mixed income of self-employed. Clear, everybody? So what I want you to focus on, which area is that? I want to focus here, okay, undistributed profits of corporations before taxes. So always remember that I'm talking about, whenever I'm talking about non-labor income and I'm talking about profits, right? In that profits, I'm talking about the profits before paying the taxes, okay? So that you have to take into consideration. That is the reason while I was discussing your national disposable income, I told you that this whatever business firms, economic agents you have, governments, households and business firms. So national disposable income is I'm taking into consideration all these three people, right? So when I'm taking into consideration all these three people, so I am not actually, deducting the taxes for, corporate profits. I am actually taking corporate profits before the deduction of your corporate taxes. Okay. Next, so who are the examples for self-employed people? Lawyers, engineers, traders, and subsistence production and small commodity production is dominant in agriculture, trade, transport of underdeveloped countries, including India. See, India is like a developing country, right? So, there are other underdeveloped countries like Africa and such, but India is kind of a developing nation, but we are yet to become developed nation. That will be, that will be happening very soon. We see signs of that happening because there are many aspects that are being corrected in the economy. We are actually moving in a positive scenario, towards a positive scenario. Okay. Next, so let us see the aspects that we have to focus on your expenditure method. So what is the formula for your expenditure method? It is final consumption expenditure plus gross domestic capital formation plus net exports. They have just given you final consumption expenditure, right? In that final consumption expenditure, you have your private final consumption expenditure and government final consumption expenditure. So what do you mean by final consumption expenditure by private? I'm talking about households here. So final goods and services produced in the accounting period, primary products are produced for own consumption by the household. So always remember that self-consumption is also taken into consideration. Madam, how will you take self-consumption into consideration? Please calculate the imputed value. Please calculate the imputed value. Next, payment for domestic services, the net expenditure on foreign financial assets. So what do you mean by net expenditure here? It is brokerage. They're talking about brokerage. They're talking about what? Brokerage and commission. Okay. Next, government final consumption expenditure is, you know that government keeps incurring expenditure on your education, health as such. So that is taken into consideration. Transfer payments are excluded. While calculating your national income, students, please do remember that you only have to take into consideration the productive activities. You should not take into consideration the transfer payments. Next, gross domestic capital formation. What do you mean by that? It is investment. Whatever is adding to the productive capacity of the nation, that is taken into consideration. It might be inventory investment or fixed asset investment, right? Next, gross domestic capital formation includes machinery and equipment, own production, that is, this is self-consumption. I told you, right? Self-consumption also has to be taken into consideration. Next, expenditure on construction, land and residential buildings constructed by households. So whenever you are doing this residential investment, that is also taken into consideration. Next, expenditure on acquisition of valuables such as jewelry and work of art. So what are the things that you include in your gross domestic capital formation? Anything that increases the productive capacity. So these residential investments, what are the investment activities by households, whatever residential investments, and when it comes to business firms, the plant and equipment, whatever they are buying. Also the inventory investment also has to be taken into consideration, and any valuables, that is also taken into consideration, right? So next, in India, when national income of a country is measured separately using this method, we get three-dimensional view of the economy. We are unable to estimate national income wholly by one method. So what is the reason that you are unable to use one method here? See, the only reason is that data availability. See, based on the availability of data, we are kind of using the methods. So for all the sectors, it is impossible to use one common method. So this was your national income accounting. But what my suggestion would be is, if you do some problems, you will be having a clear picture of this chapter. So what we will do right now is, we'll proceed with your problems. We'll start solving few problems which will give you in-depth clarity with regard to the chapter, and you will actually feel comfortable. Okay, I have listened to the lecture. Okay, I gained something. I am able to do some problems. Mostly students encounter problem with personal income calculation and private income calculation. So we are going to address that issue in this session. So what we will do right now is, we will solve some problems pertaining to your different methods. That is your expenditure method, income method, and also your value added method. First, we'll start with your value added method. So if we have to revise the formula of your value added method, it is value of output minus intermediate consumption. So what is your value added method? You are taking into consideration the value addition made at different stages of production, right? So what you do here, as you can see in the question, you have the value of output in the primary sector, intermediate consumption of the primary sector. So how will you get the value addition that happened in the primary sector? It is value of output in primary sector minus intermediate consumption of primary sector. In the same way, they have given for secondary sector and tertiary sector. So in your value added method, you take the value addition made at different sectors, you sum them to get the value addition made in the entire economy, right? So what will you do here? Value of output in the primary sector minus intermediate consumption of the primary sector, value of output in the secondary sector minus intermediate consumption of the secondary sector, plus value of output of the tertiary sector minus intermediate consumption of the tertiary sector. Clear, everybody? So always remember that in your national income accounting, the reason why I am not taking intermediate consumption is, I am only taking into consideration the final value of goods and services. See, directly you can take the final value, that is not an issue. But if you kind of add the value addition made at each stage of production, that will also give me the final value of the good. If you add the value addition made at each stage, that will give me the final value. So that is the reason I am eliminating the intermediate consumption. And do you remember, intermediate consumption includes domestic purchases plus imports. Value of output is nothing but sales plus changing stock. And sales includes domestic sales plus exports. So that is all you have to remember. Your national income is measured in terms of NNP at factor cost. So, but in your expenditure method and your value added method, what will you get? You get GDP at market price. So you have to transform that into NNP at factor cost. How will you do that? The three mantras, do you remember? The gross you have to transform into net. So how will you transform gross into net? You will deduct depreciation. Domestic you have to transform into national. You will add NFIA. Market price you have to transform into factor cost. You have to deduct the net indirect taxes. By that you will get the answer under your what? Value added method. So the formula that you have to remember for value added method is value of output minus intermediate consumption. Okay. So this was one. I hope you all understood. What we will do right now is that we will solve your income method. So what is the formula for your income method? It is compensation to the employees plus operating surplus. What is operating surplus? Rent plus interest plus profit, and it is mixed income of the self-employed. If you do that, you will get NDP at factor cost. Okay, all the things that I am telling you right now, if you add them up, you will get NDP at factor cost. But what do we want? We want NNP at factor cost. So for transforming domestic into national, you will add net factor income from abroad. Okay, so compensation to the employees plus mixed income of the self-employed, and next plus operating surplus is rent plus interest plus profit. If you add all these three, you will get operating surplus. So if you add all these three, compensation to the employees plus operating surplus plus mixed income, you will get NDP at factor cost. Okay, for this, if you add NFIA, you will get NNP at factor cost. People, these are irrelevant items. Okay, they are given just to confuse you. Okay, always remember that which method gives you which concept. Okay, income method will give you NDP at factor cost. So you only have to worry about NFIA to get your NNP at factor cost. Okay, everybody? Yes. Next, another method that you have is your expenditure method. What is the formula for your expenditure method? C plus I plus G plus X minus M. Okay. So, private final consumption expenditure is of households. You have to take this into consideration. Net import, it seems. So, if net export comes, it is exports minus imports. Exports is bigger. So, you have to add. If it is net imports, you have to deduct this. Okay. Next, public final expenditure is of government. So, you have to take this into consideration. Gross domestic capital formation, but they are only talking about fixed capital formation. So if there is inventories, that also you have to add. So this you have to take into consideration. People, remember that gross domestic capital formation includes any addition that is made to the productive capacity. It can be in the form of fixed assets, it can be in the form of inventories. As they specifically mentioned that it is regarding fixed assets, inventories you have to take into consideration. So where do you have inventories? Change in stock, that is your inventory. Okay, this also have to be added. Next, what else? Net acquisition of valuables have to be taken under what? Gross domestic capital formation. So under gross domestic capital formation, you have to take the addition to fixed assets, you have to take the addition of inventories, you have to take the valuables, you also have to take the valuables. Okay, so these are the things you have to consider. So what is the solution? It is government's final consumption expenditure, which is nothing but public, plus private final consumption expenditure. People, public final consumption expenditure plus private final consumption expenditure is nothing but final consumption expenditure. Public final consumption expenditure plus private final consumption expenditure is nothing but what? It is your final consumption expenditure. Yes, gross domestic capital formation is nothing but fixed capital formation plus change in stock plus net acquisition of valuables. So this will give you what? Plus net exports. Here there are net imports. Now you have to minus that. You have to minus that. And next, what will you get because of that? You will be getting your GDP at market price. But you want NNP at factor cost. So if you want net, you have to deduct depreciation. If you want national, you have to add an FIA. If you want factor cost, you have to deduct net indirect taxes. So we have seen three examples for your three methods. Now what we are going to do is we are going to solve some problems with regard to your personal income and private income so that you will not be having any queries. Okay. So let me start with your, okay. Yeah. Let us do this problem, or let us, yeah. Okay. So let us do this problem. Okay. So what is the information that they have given? They are asking us to calculate the national income. National income is nothing but NNP at factor cost. What is national income? NNP at factor cost. How do you get that? What is that they have given here? NNP at market price. People, NNP at a market price. If you minus net indirect taxes, will you get NNP at factor cost? Obviously, you will get NNP at factor cost, right? So what is NNP at market price? It is 1891. So do you have any net indirect taxes in the table? They have given indirect taxes and subsidies. See, net indirect taxes is nothing but indirect taxes minus subsidies. So what is your net indirect taxes? It is 175 minus 30. It is 145. So net indirect taxes is 145. So what is the NNP at market price? 1891 minus 145 will give you 1746, which is your national income. So let us see the options if they have that. So 1746 is your national income. So we have got your national income to be 1746. This was simple, right? Now we got your national income. In national income, do we take transfer payments into consideration? We do not take transfer payments into consideration. Transfer payments, how many types are there? Transfer payments from government, interest on public debt, transfer payments from rest of the world, right? So while calculating your private income and personal income, transfer payments have to be added. Transfer payments have to be added, right? So let us see here. The first we'll calculate the private income. What was the next question? Did they ask us? Yeah. First we'll calculate the personal income. They are not asked private income. We'll do that later. Let us calculate the personal income. So in your national income, I have got 3 agents: households, business firms, government. So while calculating personal income, I am only bothered about whom? I am only bothered about households. So I'll eliminate the remaining. So in national income, I had all the 3. So I have to eliminate business firms and government. What is this? Income from property and entrepreneurship accruing to government. Should I minus this? Obviously, I have to minus this, because for personal income, do I require government? I don't require government. So people, whenever you are reading the table, whichever is required, put a plus. Whichever is not required, put a minus. So this is minus. Indirect taxes, subsidies are already adjusted. They are not required for us right now. Next, savings of non-departmental enterprises is of government. So as you're calculating personal income, government is not taking into consideration. So this is minus. Interest on public debt is a transfer payment. While calculating personal income, we have to take transfer payments into consideration. So this is plus. Current transfers from government, transfer payments plus. Next, current transfers from rest of the world, transfer payments plus. Savings of private corporate sector. This is nothing but undistributed profits. People are retained earnings or undistributed profits being given to the households? No, they are not given to the households. So this has to be minus. Corporate profits, are they going to households? They are not going to households. So minus. They are not going to households. So it is a minus. Okay, everybody? Yes? Fine. So what we will do is we will solve it. So initially what we got? 1746, right? So 1746 minus 45 minus 10 plus 15 plus 35. What else? Plus 20 minus 25. So it is minus 25 again. It is around, so somewhere it went wrong. We'll do this again. So what was it? We'll do this again. So the calculation part. So 1746. But if we are right, there is no option for that. We will just verify it. Okay. 1746 minus 45 minus 10 plus 15 plus 35, yeah, plus 20 minus 50. So the answer is 1711. The answer is 1711. So it is option C. Okay. So did you understand how we did the personal income? We kind of eliminated your business firms and government, and we added your transfer payment. That is how you do it. Next, let us calculate your private income. Okay. Let us see if they asked your private income at least in this question. No, they haven't. So let us do one private income question. Yeah, very good. Here they asked private income. The question is also looking big. Okay. So what is that they have given in the question for you? Factor income from NDP accruing to private sector. They made our job easy actually. So private sector includes only households and business firms. So they have not included government here. People always remember that whenever in the question they are giving you NDP that is accruing to private sector, that is not taking into consideration the government sector. Okay. Now for calculating private income, we already have the NDP that is accruing to private sector. We already have the NDP that is accruing to private sector. Now what do we have to do here? This is NDP. So you have to add NFIA to make it NNP. This is what NDP, but we want NNP, right? And in national income, do you include transfer payments? You don't. So you have to add all the types of transfer payments. So what is the NDP that is accruing to private sector? It is 300. Next, income from property and entrepreneurship. This is irrelevant because in private sector, there is no government. So you have no role to exclude it. Okay, your job is done actually. The question is very, very simple. Savings of non-departmental irrelevant for right now. Factor income from abroad. So what is this factor income from abroad? Matlab it has to be added. Okay. Consumption of fixed capital irrelevant because we are already talking about net value, right? So depreciation is taken. Depreciation is also called as consumption of fixed capital. Next, current transfers from rest of the world. It is a transfer payment. So please add it plus 15. Next, corporation taxes. It must be there because this is already included. Yeah. Whenever they say NDP accruing to private sector, they have taken all. This is already inclusive of it. Factor income to abroad. So please deduct factor income to abroad minus 30. Next, current transfers. Transfer payments have to be taken into consideration plus 40. Next, direct taxes. See, taxes are relevant when you are calculating disposable income. Here we are only calculating private income. National debt interest. It is a transfer payments. So plus 5. Savings of private corporate. Not relevant for right now. So how much did you get? You got 350. See, very simple trick, people. So whenever you are calculating private income, make sure that you are having households business sector. For that, what will you add? You will add transfer payments to that and your job is done. Your job is done. Okay. So these were the examples that I was wanting to talk to you. So I hope that you got some clarity with regard to the lesson. What my request would be is that for national income accounting, things will get easy for you if you are aware of the formulas. Okay. So if you are not aware of the formulas, it is very complicated for you. And there are not many formulas. Many students have this misconception. Okay. See, if you know one, you can derive the other. You just have to remember the 3 mantras. You just have to remember the formulas in your 3 different methods. That's it. Half job done. And for personal income and private income, you just have to know what has to be included, what should not be taken into consideration. And always remember that in your disposable personal and private income, you take transfer payments into consideration. Transfer payments are 3 types. You know that, right? So this is what you have to remember in this chapter. It is not at all tough. It is very, very easy. You just have to understand the approach for this chapter. Clear, everybody? I hope that you got some information. You enjoyed the lecture. I'll see you in the next one. Thank you so much. Hello everybody, welcome back to another session of Economics of Finance. In the previous session, we had a discussion with regard to national income accounting. So in this session, we'll proceed with Keynesian determination of national income. As you all know, one of the most interesting chapters that you have in Economics for Finance. So before, proceeding with the chapter, I would like to, talk a few words about Keynes, how he achieved his prominence. As we all know that till Great Depression, it was your classicals who were very prominent. Classical's ideology of full employment, supply creates its own demand, the wage and price flexibility. But what Keynes said was this is not actually working in real life scenario. But when Keynes came up with his ideology, people were not very accepting with regard to his ideology and kind of refuted him. So when after Great Depression happened, people realized that okay, Keynes was actually right. So then they started believing in Keynes. So the Great Depression has made Keynes achieve so much of popularity. So in this session, what we are going to do is we are going to discuss the chapter as I have told you. We are going to complete the entire chapter in a span of just 1.5 hours or something like that. So it will be very easy for your revision purposes as well. So in this chapter, you have got the Keynesian 2-sector model, 3-sector model, 4-sector model. But before discussing the 2-sector, 3-sector model and the 4-sector model, it is very important that we understand some key terminologies to understand this chapter. Okay, so let us start. So what do they have in the beginning here? John Maynard Keynes have become popular with his book. What is the name of the book? It is the General Theory of Employment, Interest and Money. What is the name of the book? General Theory of Employment, Interest and Money, right? Next, what are the different concepts that Keynes has introduced? Some of them are income consumption relationship. As we all know, there is a direct relationship between income and your consumption. Keynes has also talked about the multiplier, which we'll be discussing in this chapter. He's talked about liquidity preference again, which we'll be discussing in this chapter. Okay, so what do you mean by liquidity preference? To be very honest, this liquidity preference theory that was discussed by Keynes, you will actually be talking about more detail in your theories of money demand. So you have the liquidity preference theory, right? So what Keynes has to say about this liquidity preference? What he said was, when the interest rates fall below a range, people will expect the interest rates to rise further and a liquidity trap is formed. That is, people will be holding all the money and they'll not be spending anything. So liquidity trap is nothing but it is a situation where the interest rates fall so low that people hold the money to themselves, okay, which we'll be discussing when you talk about your Keynesian theory of liquidity preference in theories of money demand, which we'll be doing it in the later sessions, okay. Next, the importance of expectations in affecting consumption and investment. And Keynes also stated that your investment depends on the marginal efficiency of the capital, like how profitable it is for me to invest. And it kind of depends on the expectations of the investors. They may be optimistic or they may be pessimistic. So he said that rather than interest rate, it depends on the marginal efficiency of capital. But why Keynes has not given so much of importance to interest rate is that you do remember that Keynes came during your Great Depression. And during the Great Depression, even though the interest rates fell so low, the pessimism of the investors was not going and they are not reviving with optimism. Okay. For that very reason, investments were not so responsive to the interest rates. For that very reason, Keynes stated that your investments is a function of marginal efficiency of capital. Okay. Next, shifts in the demand and output due to shifts in the expectations. In our session, our sole focus will be on the 2-sector, 3-sector and the 4-sector model. Right, what are the key terminologies? What do you mean by equilibrium? See, equilibrium is a condition of steady state or a happy state. After reaching equilibrium, you don't want to move, right? So it is the point where your aggregate demand is equal to aggregate supply. Whenever I am saying aggregate demand is equal to aggregate supply, there are other ways you can, there are other terminologies that you can use to, say this. So what are the other terminologies? One is the quantity of output produced is equal to quantity demanded. Aggregate supply is equal to aggregate demand. Next, production plans of the firms is equal to expenditure plans of the households. What is the production plan of the firms? It is nothing but the aggregate supply. The expenditure plans of the households is related to aggregate demand. Next, aggregate income is nothing but aggregate supply. See, your aggregate supply is also known as the aggregate income is equal to the aggregate expenditure or your aggregate demand. So your aggregate demand is also referred to as your aggregate expenditure as well. Next, expected value by the firms is equal to realized value by the households. Even like this also you can express your aggregate demand and aggregate supply. The last one is leakages is equal to injections. Let us talk about what are leakages, what are injections. See, in your economy, what are considered to be leakages are your savings are considered to be leakages, taxes are considered to be leakages, imports are considered to be leakages. Why are they considered to be leakages? Because they reduce the income. They reduce the income. In which way? See, when savings are happening, you're not spending, right? When you're not spending, you're not creating demand. So what will happen to the aggregate demand? It will fall. Excuse me. When taxes are increasing, what will happen to the disposable income? It will decrease. See, what is the formula for a disposable income? It is personal income minus personal taxes. So when taxes are on an increase, what will happen to the disposable income? It will decrease. When disposable income is decreasing, what will happen to the spending again? That will decrease. When spending is decreasing, what will happen to the aggregate demand? Again, it will see a downfall, right? Next, imports. Imports means what? You are demanding foreign goods and services and you are generating income for that country from where you are importing. You are not generating any income for my country. See, imports are considered to be a leakage because you are not generating the economic activity of our country, but you are generating the economic activity of some other country. right? So savings, taxes and imports are considered to be leakages, that which is going out of the economy and which is reducing the aggregate demand. Now, which will increase your aggregate demand or which will increase your economic activity is considered to be injections. So investments are considered to be injections. So whatever savings are happening, if they are coming back into the economy in the form of investments, then you are said to be in equilibrium. Whatever taxes are being collected, as it is a leakage, if the taxes collected are coming back into the economy in the form of government expenditure, then it is considered to be injection. See, whenever you are importing something, if you are, trying to export goods and services, which is increasing our economic activity, then also you are said to be in equilibrium. So, investments, government expenditure, exports are considered to be injections. Leakages reduce the economic activity, injections increase the economic activity. So, if the reduction is equal to the increase, then you are said to be in equilibrium. If the reduction is equivalent to the increase, you are said to be in equilibrium. Clear? So these are the topics I wanted to talk on. Next, in the Keynesian sector models, equilibrium is explained in two topics, which is aggregate supply and aggregate demand, and the other is leakages are equal to your injections. Now let us also learn something called as ex post terms and ex ante terms. Whenever you hear ex post, it indicates actual. What is the meaning of ex post? It is actual. What is the meaning of ex ante? It is anticipated. What is the meaning of ex ante? It is anticipated. What is the meaning of ex post? It is actual, right? So ex post terms are actual or realized accounting values, which is nothing but actual GDP. For example, GDP is the final value of goods and services produced. In actual, how many goods are produced? That is your ex post. Okay. Whatever you're planning to, whatever you're anticipating, that is your ex ante terms, right? Ex ante. Anticipated or intended or planned accounting values. So what Keynes has considered is ex ante terms. So he has considered the planned terminologies, right? So planned investment, planned savings, potential GDP, all that. Okay. So example, people's plan to consume or planned investment. Clear? So what will you say if people say it is ex post? It is actual value. Ex ante is the anticipated value. Okay, something that you're planning to do. Next, equilibrium income versus potential income. See, potential income is something that you can produce if you utilize all the resources efficiently. See, this is your full employment level. Your potential income is your full employment level. That is, there is no underutilization or there is no overutilization. There is no excess capacity. That is your potential income. But Keynes has always said that it is not a mandate that your equilibrium income has always be equal to your potential income. For example, if I say YF is your potential level of income, YF is your potential level of income because this is the income that you are producing at the full employment level. Full employment meaning is there is no underutilization, there is no overutilization. But Keynes was saying that there is a possibility for involuntary unemployment as well. It is not that the economy will always be operating at the full employment level, which the classicals has said that the economy will be always be operating at full employment level. This is where Keynes refuted classical, saying that no, you are wrong, because in an economy there is a possibility for involuntary unemployment as well. Okay, so there can also be underutilization. Your economy need not operate at the full employment always. Okay, so whatever equilibrium income that you're seeing, what is the equilibrium where AD is equal to AS? That need not take place at the full employment level. It can also take place at a level that is less than the full employment level. So when it is less than the full employment level, it indicates that there is deficit demand. There is deficit demand. That is what happened during Great Depression, right? So the reason behind the occurrence of Great Depression is there is no proper demand, or there is no, the demand that is required. So there is deficiency in the demand, which has led to the Great Depression. That is why Keynes has asked that government must intervene to correct this failure. But classicals always promoted lazy sphere economy or capitalist economy or free market economy. They said that government need not interfere. If it takes care of these military operations, all that, it is fine, but government need not intervene in the market. But Keynes stated that your market cannot adjust itself always. So there is a requirement that government intervenes into the market sometimes to correct the failure. Okay, next. So they have given a table with regard to your leakages and injections. Let us see what they have written here. A leakage is an outflow or the withdrawal of income from the circular flow model. So whenever you see a leakage happening, it kind of decreases the economic activity. Whenever you see an injection happening, it increases the economic activity. Next, Savings, imports and taxes are your leakages. Next, investment, government expenditure and exports are your what? Injections. Investment, government expenditure and exports are your injections. Leakages arise due to what? What is the reason behind the leakages? See, do you remember in national income accounting we discussed that corporate profits include dividends, corporate taxes and your what? Undistributed profits. Undistributed profits or retained earnings. Your undistributed profits or retained earnings are a form of savings. So savings are considered to be a leakage because they are not entering into the economy or entering into the circular flow. If they enter into the circular flow, they will generate some economic activity. But if they are lying idle, there is of no use, right? So that is the reason whatever taxes you are collecting, if they are spent in the form of government expenditure, it is considered to be an injection. Clear? I hope I have made myself clear with regard to leakages and injections. Next, circular flow of income. This note point is really important. If leakages are greater than injections, what will happen to the national income? It will definitely increase, because if leakages kind of reduce the economic activity, right? So the things that are reducing the economic activity, if they are greater than the things that increase the economic activity, the end result will be a fall in the economic activity. If your injections are greater than leakages, that is, the activities that are increasing your economic activity are greater than the activities that are reducing the economic activity, then you will see a rise in your national income. Clear, everybody? Next, let us proceed to something called as circular flow of money. Okay, so what is the circular flow of money? So in this model, what we are going to do is we are kind of discussing the basic model where you will be having your firms and households. So you have three economic agents, right? Business firms, households and government. In this simple circular flow model, I am only taking into consideration firms and households. I am not taking government into consideration. So if I am not taking government into consideration, there is no taxes or there is no government expenditure. Clear, everybody? So your personal income is equal to your disposable income. See, if there is no government, there will be no taxes, right? So what will be your personal income? That will be equivalent to your disposable income. They are the things that you have to remember. And while discussing this simple circular flow model, you also have to remember some assumptions. Okay, so primarily how many players do you have? You have primarily two players in this model, which are households and business firms. Okay, and you are taking an assumption that your households are not saving anything, but they are spending the entire money. Your households are not saving anything, they are spending the entire money. You also take an assumption that there are no proper financial institutions. See, that is the reason why whatever the households are receiving, they are spending the entire money, right? So, and the companies are also not having any sort of retained earnings. See, retained earnings or undistributed profits is the savings of the companies, right? So, they are also not saving anything, okay? So only two primary players, which are your households and corporations, right? There are no corporate savings or retained earnings. Okay, there are no corporate savings or retained earnings. No government. As there is no government, there will be no taxes, and your personal income is equal to your disposable income. Economy is a closed economy. What do you mean by a closed economy? There is no foreign sector. That is, you're not having transactions outside the country. Okay, no foreign dealings are present. So you're a closed economy. What is the meaning of open economy? The presence of a foreign sector is, then it is called as an open economy. Okay, so let us see a small diagram here. As you can see, there are households and there are firms. Okay, so what households do in this model is that they supply the factors of production which are used by the business firms to produce the goods and services. What households are doing here? They are supplying the factors of production which are being used by the firms in the production of goods and services. Okay. Now what firms are in return doing for that? They are paying factor payments. Like, what are factor payments? For land you pay rent, for labor you pay wages, for capital you pay interest, and for entrepreneur you pay profit, right? So the factor payments are the money incomes that are earned by the households. So whatever factor payments that are receiving in the form of rent, wages and interest, they are in turn spending that on goods and services that are made by the firms. Okay, so in this way money is flowing between firms and households. First, the household has sent what? Factors of production to produce goods and services. In return, what did the firm send? They sent the factor payments. On behalf of, like, after receiving the factor payments, what did the households do? They use that money to spend on goods and services, right? So in this way, again, the firms received the money. And here you have to remember this assumption that households are not saving anything. Households are not saving anything. Okay. So households, they own all the factors of production and sell their factor services to earn factor incomes and are entirely spent. So there is no portion of savings here. So firms hire factors of production from households, produce and sell goods and services to households and do not save. So even the firms are not having any sort of retained earnings, undistributed profits or corporate savings. Okay. Circular broken lines. So as you can see here, you have a full-fledged line and you have broken lines, right? So these broken lines, whatever they are, you can see, they represent the factor and product flows, which are the real flows. Like I am sending factors of production to the firms, right? So it is considered as real flow. In return, I am receiving factor payments, right, in terms of money, that is called as money flow. Whatever I am receiving in terms of money is called as money flow. Whatever factors of production I am sending, whatever goods and services firms are sending, that are considered to be real flows, right? No injections or leakages from the system. I told you, right, if there are no savings, there will be no investments. If savings are there, leakage will be there, and that has to be corrected by injections in the form of investments. Next, equilibrium under the two sector model, very important. Please remember this condition. See, factor payments is equal to household's income. Whatever factor payments that is being made by the firms is nothing but my income. Okay, and my income is whose income? The firm's income, because I am spending the entire income in the form of expenditure, and that expenditure is nothing but the receipts of the firm, and the receipts of the firm is equivalent to whatever value of the output that they have produced. See, using my factor services, they have produced something, right? That output has a value. So that is equivalent to the total receipts of the firm. That is equivalent to the household expenditure. That is equivalent to the household income, and which is equivalent to the factor payment. So everything is equal here. Clear, everybody? Yes. Next thing is basic concepts and functions of the Keynesian two-sector model. Now we are going to start with the discussion with regard to two-sector model. See, in Keynesian two-sector model, you only have your households and business firms. Okay, in the Keynesian two-sector model, you only have your households and business firms. In the three-sector model, we add your government. In the four-sector model, we also add your foreign sector. In the four-sector model, we add your foreign sector. So what we are going to do right now is we are going to gain some knowledge with regard to these terminologies, like what is MPS, what is MPC, what are their values ranging from, what is APS, what is APC. So all that we are going to understand here. Clear, everybody? So let us start our discussion with regard to the two-sector model. Before that, let me write something down for you, okay? In the two-sector model, you have C plus I. In the three-sector model, you have C plus I plus G. In the four-sector model, you have C plus I plus G plus X minus M. These are the things that you have to remember, okay? So it is consumption expenditure plus investment expenditure is equal to two-sector model. Consumption expenditure plus investment expenditure plus government expenditure is equal to three-sector model. Consumption expenditure plus investment expenditure plus government expenditure plus exports minus imports. This is nothing but net exports is equal to the four-sector model. Clear? This is that simple. So this lesson is going to be very, very simple for you if you just listen to some basic terminologies, and we'll complete it for you. Fine. So what do we start with? Let us start with aggregate demand. Your aggregate demand is also called your aggregate expenditure. I told you, right, in your Keynesian world, we are talking about ex ante terms. So ex ante is planned. Ex ante is nothing but planned. Okay. So planned aggregate demand, planned expenditure. Clear, everybody? Yes. In a two-sector model, AD for final goods and services is the sum of ex ante aggregate demand for consumer goods and ex ante aggregate demand for investment goods. So aggregate demand is equal to consumption expenditure plus investment expenditure. So of the two components, consumption expenditure accounts for the highest portion of your GDP. Around 70% it is accounted by consumption expenditure. Right, everybody? Next, investment expenditure is assumed to be constant in the short run. This is also very, very important. According to Keynes, in the short run, your I is constant. And whenever something is constant in economics, you denote with I bar. You draw a bar on top of that to denote that it is constant. Okay. So in the short run, your investment expenditure is constant. So your, AD is equal to C plus I bar. AD is equal to C plus I bar. Okay. So it is consumption expenditure plus investment expenditure, which is constant in the short run. Why are we talking about short run? Because you are in Keynes world. In Keynesian world, you are only talking about short run, because Keynes only focused on short run, saying that in the long run we are all dead. But classical spoke about long run. Clear everybody? Yes. AD represents the realized value by the households or households plan to consume. So whatever households are planning to consume is nothing but your aggregate demand. And next, AD is the linear and positively sloped, because whenever your national income is increasing, your aggregate demand will also increase. That is, whenever Y is increasing, what will happen to aggregate demand? That will also increase. But there is something that you have to notice here, which I will help you here understand. Okay. So for your equilibrium, you need both aggregate supply, aggregate demand. Students, always remember that your aggregate supply line is a 45-degree line. Your aggregate supply line is a 45-degree line, and it is also called your reference line. It is also called your reference line. And your aggregate demand line is flatter when compared to your aggregate supply line. Your aggregate demand line is flatter when compared to your aggregate supply line. Okay. Your aggregate supply line is nothing but your income line. It is your income line. Your aggregate supply is also called as your aggregate income, right? And AD is nothing but C plus I bar, right everybody? Yes. So what do you observe here? Your aggregate supply line is a 45-degree line, but your aggregate demand line is a bit flatter, right? What is the reason that it is flatter? Because whenever the income is increasing, the consumption will also increase, but less than proportionately to the rise in your income. I'll repeat this again. So the reason why your aggregate demand is flatter is because your incomes are increasing, consumption will also increase, but the proportionate increase in the consumption is less than the proportionate increase in your income. For that very reason, your aggregate demand line is flatter. Clear everybody? Yes. So this is your aggregate demand or aggregate expenditure, right? So the difference between your Y and your aggregate expenditure is nothing but the savings in the economy. So what do you see here? At this particular point, like till the highlighted region, you see that your aggregate demand is greater than your aggregate supply. That is, your aggregate expenditure is greater than your aggregate income. Whenever your expenditure is greater than your income, we say that you are dissaving. We say that you are dissaving. And at this particular point, your aggregate demand is equal to aggregate supply. Your aggregate demand is equal to aggregate supply. Here the savings are 0. Here you are not dissaving or neither you are saving. Okay. So beyond this, if you go, your aggregate supply is greater than your aggregate demand. So your income is greater than your expenditure. So what are you doing in this region? You are saving. So in the beginning of the career, you are dissaving. In the middle, there are no savings. After a particular point of time, you are saving so as to accumulate wealth. Clear everybody? So in the beginning, it is dissaving. So when aggregate demand is greater than aggregate supply, you are dissaving. When aggregate demand is equal to aggregate supply, you are not saving anything. When aggregate supply is greater than aggregate demand, what is happening here? You are saving. Clear everybody? We'll proceed to the next one. So aggregate demand line is flatter than the 45-degree line. What is the reason? Even though the income is increasing, the proportionate increase in your consumption is less than the proportionate increase in your income. For that very reason, your aggregate demand line is flatter. Clear everybody? Yes. Next, aggregate supply is also referred to as your aggregate income, aggregate supply, or a planned aggregate supply. Okay. So what is your income equal to? You can either use for consumption or you can either use it for saving. What is your aggregate income to? You can either use it for consumption or you can either use it for your savings, right? Next, total supply of goods and services firms in an economy plan to sell during a specific period of time. So I told you, right, in the Keynesian world, you are using the terms ex ante terms. You're using the terms ex ante, that is planning to sell, right? Next, it is the expected value by the firms or the producer's plan to produce goods or services. Aggregate supply is equal to the national income of the economy, which is either consumed or saved. So what is your aggregate supply equal to? It is equal to your national income. So your national income is denoted by Y. It can either be used for consumption or it can either be used for savings purpose. See, after eliminating your consumption, the remaining portion is left for savings, right? Next, let us have a discussion with regard to the consumption saving function or the income consumption function or the income savings function. Okay. So what do you see here? Consumption function, level of C at each level of income. So your consumption function is nothing but, let us, do it in the notepad. I'd already told you that your aggregate demand in a two-sector model is nothing but C plus I. And in the short run, your investment is autonomous, it is independent of the income, and it is also constant. It is also constant. So let me denote it with I bar. Let me denote it with I bar. Okay. And your consumption equation is nothing but A plus BY. Your consumption equation is A plus BY. Okay. So in this consumption equation, you have two components. One is the autonomous component, the other is the induced component. So A is your autonomous component or independent component. What do you mean by autonomous or independent component? Autonomous or independent component is that irrespective of the income, your consumption will be equal to A. Irrespective of the level of income, your consumption will be equal to A. That is, if you put Y equal to 0, your consumption will be equal to A. If you put Y equal to 0, your consumption will be equal to A. Okay. So that very reason we call that as autonomous consumption or independent consumption. Now what is BY? BY is your induced consumption. That is that which is dependent on the level of income. What is BY? Induced consumption. That which is dependent on the level of your income. Clear everybody? So what do you call BY? Induced consumption. Okay. So in your C is equal to A plus BY, Y is the independent variable. C is the dependent variable. C is your consumption. Consumption is dependent on income. So you can write consumption as a function of your income, right? So C is your dependent variable and B is your slope, which is nothing but the marginal propensity to consume. What is B? It is marginal propensity to consume or your slope of the consumption function. What do you mean by marginal propensity to consume? It is nothing but delta C by delta Y. It is nothing but delta C by delta Y. So change in consumption due to change in the income. How much is your consumption changing if there is a 1 unit increase in the level of income? That is the slope, which is denoted by MPC delta C by delta Y. This is your consumption equation, right? So what we will do right now is we will see what they have written. So consumption function, C at each level of income, right? So this is your consumption function. The blue line that I am highlighting, this is your consumption function and this is your income line. The 45-degree line that you're seeing is your income line. It is also called your reference line. As I have already told you, your income can be spent on two purposes. You can either use it for consumption purpose or you can use it for savings purpose, right? Yes. So what do you see here? This is the gap between your consumption and income. In the beginning, as you can see, your consumption is greater than your what? Level of income. I'm sorry, denoted with Y. So your consumption is greater than the level of income. At this particular point, your consumption is equal to income. And after this particular point, your consumption is less than the level of income. So this region is the savings region and this region is your dis-savings region. So what they did is they have drawn the leakages lines as well. So what is the leakage happening here? It is the saving that is happening, which is called the leakage. Why is it called the leakage? Because savings kind of reduce the economic activity. If you have to stay in equilibrium, you have to kind of bring in the investments also. So in short run, investments are constant. They are autonomous as well, right? So how do you draw your investment line? Your investment line will be drawn as parallel to x-axis. Okay. So for example, they have also drawn, I am also drawing. So let me draw it here only. Why I draw it somewhere else? Yes. Okay. No, this is not something. How? Just give me a moment. Okay. So I don't think this will suit in this graph. I'll do it in another graph, which can, which I'll be using it to help you understand the equilibrium between investment and savings as well. I will do it separately for you. What I will do it now itself. Why later? Yeah. So let us all do it together. So here I am drawing the graph for your consumption, and consumption line is a bit flatter than your income line, right? This is your consumption line. C is equal to A plus BY, and this is your income line, right? Yes. Now let us draw your savings line. And your savings line will start from the negative axis. Can you please tell me why it is starting from the negative axis? Because in the beginning, what you see is you see dissavings. That is, in the beginning, as you see, your consumption is greater than income. So there is dissaving. That is why your savings line will start from the negative axis, right? Here your consumption is equal to savings. So savings will be equivalent to 0. So savings will be equivalent to 0. So your savings line will start from here. So in this particular region where your saving is happening, your saving is in the negative axis. Here your saving is 0, and after this point your savings is positive, right? So it will go to the positive axis. It will go to the positive axis, right? So this is your savings line. Clear everybody? Very good. Now what we will do is that we will also include something called as your investment, okay? And in your investment, it is independent of the level of income, right? Your aggregate demand is nothing but, I'm so sorry for my nose, I don't know why, but I have some allergy. So your aggregate demand is equal to C plus I. Your aggregate demand is equal to C plus I. I have drawn which line here? Your consumption line. If I add your investment also, that will become your AD line, right? So what I will do is I will also induce your investment line, and I will draw it here. Okay. So I have drawn your investment line as well. This is your C plus I. Your C has moved upwards, right, by a constant amount, which is your I. Your C has moved upward by a constant amount called as I. Okay. This is your C plus I. So I will also draw your injections and leakages in this graph. The graph that I am drawing right now is your injections and leakages graph. Leakage is your savings, injection is your investment. Okay. So I'll draw your investment here, which will be parallel to x-axis because it is independent of the level of income. My graph is parallel to x-axis because it is independent of the level of income. People, wherever your AD is equal to AS, your AD is equal to AS is this point, right? So whenever your aggregate demand is equal to aggregate supply, what do you see here? Your investment is equal to savings. That is, your leakages are equal to your injections. People, whenever you are in equilibrium, your leakages are equal to your injections as well. Okay, that also I just wanted to show you this. For the very reason I have drawn this graph. Clear everybody? Yes. Let us proceed to the next one. So what do they have to tell? Savings function is level of savings at each level of income. At 0 level of income, positive value of consumption. That is the reason I told you that it is your autonomous consumption. Independent of the level of income, you will have some consumption, which is your autonomous consumption. When income is low, C exceeds Y. Whenever your consumption is exceeding your income, you are dissaving. Whenever your consumption is equal to your income, your saving is 0. Whenever your income is greater than your consumption, you are saving. Clear everybody? Yes. So this is your consumption function or your consumption saving function, income consumption function. So let us proceed to the next concept, which is your aggregate demand and aggregate supply. So in a two-sector model, your aggregate demand is nothing but your C plus I, and your aggregate supply is denoted by Y, and your Y is equal to C plus S. Right, everybody? So in a two-sector model, your aggregate demand is equal to aggregate supply, right? What is aggregate demand? C plus I. And what is aggregate supply? C plus S, right? So you can either use it for consumption or you can use it for saving. If you cancel out C, what are you left with? I is equal to S. So your investments is equal to savings when you are in equilibrium. Your investment is injection, your saving is leakage. So your leakages are equal to your injections. You can either show it this way or you can also show it in the with the help of a diagram. Okay. Consumption function. Functional relation. What do you mean by a function? First of all, function talks about the relationship between dependent variables and independent variables. Whenever I say consumption function, you are talking about the relation between consumption and the level of income. Here consumption is your dependent variable, level of income is your independent variable. And what was the consumption equation that we discussed? It is A plus BY. So this discussion we have already completed. Yes. Next, what is your aggregate supply? Your supply is nothing but your aggregate income. So Y is equal to C plus S. So your savings is equal to income minus consumption, right? Your savings is equal to income minus consumption. Your savings is a function of income. Students, remember that Your savings is a function of your income. And what was B when we discussed your consumption equation? B, we called it as MPC. B is nothing but your MPC, right? So what is MPS, by the way, I want to know. MPC is marginal propensity to consume. What is MPS? Marginal propensity to save. What is MPS? Marginal propensity to save. It is nothing but delta S by delta Y. It is nothing but delta S by delta Y. So what do you mean by delta S by delta Y? It is change in savings due to change in the income. Whenever the income is increasing, by what proportion you are increasing your savings? That is told by your MPS. Okay. And students always remember that your MPC plus MPS is equal to 1. Your MPC plus MPS is equal to 1. So what is MPC? It is delta C by delta Y. Plus what is MPS? It is delta S by delta Y. We are just proving how is it equal to 1. Okay. So next, what is delta C plus delta S? What is delta C plus delta S? It is nothing but change in your income. See, delta Y is change in your income. That change in your income can be either used for consumption or used for savings. So it is nothing but delta Y by delta Y, which is cancelling out and coming out to be 1. So MPC plus MPS is equal to 1, right? So always remember that the values of your MPC and your values of MPS will vary between 0 to 1. The values of MPC and the value of MPS will vary between 0 to 1. Okay. So if they are varying between 0 to 1, for example, I say that your MPC is equal to 0.5. What will be the value of your MPS? It will be 0.5. How did you say that? MPC plus MPS is equal to 1. So I told that MPC is 0.5. So MPS will be equal to 1 minus 0.5, which is 0.5. Clear everybody? Yes. So you have to remember the condition that MPC plus MPS is equal to 1 and your MPC is marginal propensity to consume. The formula delta C by delta Y. Your MPS is marginal propensity to save, which is nothing but your delta S by delta Y, right? So can I also write it this way? So MPC plus MPS is equal to 1, right? MPC is denoted by B. So MPS is equal to 1. So MPS is equal to 1 minus B. So MPS is nothing but 1 minus B is nothing but your MPS. Okay. So this is what I wanted to tell you. So we'll continue with what? We'll continue with your savings function. Let us see what they have written. So they said savings is a function of income and savings is equal to minus A plus 1 minus B into Y. So what is this minus A? It is the dis-saving portion. It is the dis-saving portion. And what is 1 minus B? It is your MPS. I have just now shown you, right? 1 minus B is nothing but your marginal propensity to save. So we have completed your MPC, MPS discussions, right? So let us also discuss what is APC and APY. Sorry, APS. So APC is nothing but C by Y. What is the formula for APC? It is the ratio of total consumption to total income. That is on an average you are talking. So how do you get that? It is C by Y. What is APS? It is the average propensity to save. It is nothing but S by Y. It is savings by income. That is what portion of your income are you saving. And what is C by Y? What portion of your income are you consuming? Clear everybody? Yes, this is your APC. This is your APS. And so we were discussing about the two-sector model, right? In your two-sector model, you have got only your consumption expenditure and investment expenditure, ignoring the government expenditure and your foreign sector, right? And whenever you are talking about the investment expenditure in the two-sector model, as we are in the short run, investment is considered to be constant. It is autonomous of the level of income as well, right? So we call it as I bar. So let us see what they have written here. So the two-sector Keynesian model is the simplest representation of the Keynesian economics, excluding your government sector and the foreign sector. So you're only taking the consumption expenditure and the investment expenditure. So equilibrium in the two-sector model. So equilibrium in the two-sector model, just a second. Yeah. So equilibrium level of national income is determined where aggregate demand is equal to aggregate supply. So wherever your aggregate demand is equal to aggregate supply, that is your equilibrium condition. And in two-sector model, your aggregate demand is equal to what? Your aggregate demand is equal to consumption expenditure plus investment expenditure. Your aggregate supply is also called as your what? Aggregate income. So it is denoted by Y. And your level of income is used for two things, which is your consumption and savings. So C plus I is equal to C plus S. So what will happen? Your investment is equal to savings. Your investment is equal to savings, right, everybody? So that is the thing. What else? So they have also presented this in the form of a graph, as you can see here. So in panel A, in terms of aggregate demand and aggregate supply, income is measured on x-axis, your consumption, your savings, your investment are measured on the y-axis. See, what they have done is, they have taken your aggregate demand in the upper graph. In the lower graph, they are talking about the leakages and injections. What is the leakage in your two-sector model? It is your savings, which is considered as leakage. What is the injection in your two-sector model? It is your investment, which is considered as injection, right? So as you all can see, at this particular point, which is your equilibrium, your aggregate demand is equal to aggregate supply and your investment is equal to savings. That is, injection is equal to your leakages. But you also have to see something else. What do you see beyond the equilibrium point? Like beyond this equilibrium point, at point B, you observe that your aggregate supply is greater than aggregate demand. So there is a disequilibrium that you see here, and this disequilibrium is adjusted actually. Okay, so what will happen? Your aggregate supply is greater than aggregate demand, indicates that your C plus S is greater than C plus I. That is, your S is greater than I. If savings are greater than investment, people are not spending, right? So what will happen to the aggregate demand? It will decrease. So what will happen to the aggregate demand? It will decrease. What will happen to the inventories? They will increase. What do you mean by inventories, people? If aggregate demand is not there and your supply is more than the demand, so there are additional units that are not being sold, right? So they are considered to be inventories, right? So inventories keep piling up. So when inventories are piling up, what will happen to the investment? That will also decrease. So you eventually will move towards the equilibrium. Now, if you see at this point, your aggregate demand is greater than your aggregate supply. As you can see, your aggregate demand is greater than your aggregate supply. That is, your C plus I is greater than C plus S. That is, investment is greater than savings. So when investment is greater than savings, what will happen to the inventories? They will decrease. They will decrease. When demand is greater than supply, the inventories will decrease and you will go for additional investment right? So whenever you increase your additional investment, what will happen to the equilibrium level of income? That will increase as well. What will happen to the equilibrium level of income? That will also increase. So whenever there is a disequilibrium, you are moving towards the equilibrium. So what do you see here? All the points on the 45-degree line. See, if you are on the 45-degree line, that indicates that you are in equilibrium. That is, the aggregate demand is equal to aggregate supply, right? So this equilibrium point, whatever you are seeing here, this is on the 45-degree line, which is your aggregate supply line or reference line or your income line. So if you can see, if you are below the 45-degree line, this is your 45-degree line. If you are below your 45-degree line, you can see that aggregate supply is greater than aggregate demand. If you are above the 45-degree line, your aggregate demand is greater than your aggregate supply, right? Since I is constant, in the short run, your investment is taken to be constant, right? So aggregate expenditure schedule, that is C plus I, lies above the consumption by a constant amount. See, this is your A plus BY, that is the consumption function. So if you add investment to it, it will shift upwards. It will shift upwards. So as your investment is independent of the level of income, your consumption function is shifting by a constant amount, which is called as investment. Your consumption is shifting by a constant amount, which is called as your investment, right? So only at point E with output Y0, economy is in equilibrium. Now students, let us focus on something very, very important. See, you are all in Keynes world, right? So is there a possibility for involuntary unemployment or not? There is a possibility for involuntary unemployment. So what Keynes stated was, now at E you are in equilibrium. Correct, I totally agree. But what guarantee is there that this equilibrium is the full employment level of equilibrium? There is no guarantee that this level of equilibrium is your full employment level of equilibrium. This is your potential level of income. No, not at all. So there is a possibility that there is underemployment as well, right? So in panel B, they have plotted your injections and your leakages, which you have already discussed, right? Next, let us discuss this. Equilibrium with unemployment or inflation. I told you, right? In Keynes' world, it is not a mandate that whenever you are in equilibrium, you don't necessarily have to be at the full employment level. So always Keynesian equilibrium AD is equal to AS need not take place at the full employment. What is full employment? You are utilizing all the resources without any underutilization or excess capacity. Because full employment exists only if AD line intersects the 45-degree line at the level of potential GDP. So what is potential GDP? The maximum amount of output that you can produce using all the resources efficiently is your potential level of GDP. That is where there is no recession and unemployment is at its natural rate. So what is natural rate of unemployment, students? Natural rate of unemployment is that which persists in any economy, okay? So it is equivalent to the summation of structural unemployment plus frictional unemployment. So what is natural rate of unemployment? It is structural unemployment plus frictional unemployment. So what is structural unemployment? See, any economies undergo structural changes. That is, until date you are doing the tasks in a manner, and from today you're going to change the task. So there will obviously be unemployment because the workers are not having the required skill set. Okay, that is your structural unemployment. So what is frictional unemployment? Whenever you're shifting jobs, there is some period where you stay unemployed even though you don't want to stay unemployed. That is your frictional unemployment. You don't want to stay unemployed, but still you have to stay unemployed because there is a friction created, right? So that is your frictional. Any economy will witness this structural and frictional unemployment, right? Next, but there is no guarantee that the equilibrium will occur at the potential GDP. This we have been saying from the beginning of the lecture. The economy can settle at any equilibrium which might be higher or lower than the full employment level. Okay. So now listen to me carefully. If you are settling somewhere that is below the potential level of GDP, that is, you could have reached, let me see it here. Yeah. For example, this is what? This is your optimum level of output. For example, what they have did was, they are talking about your deflationary gap. They are talking about your inflationary gap. People, deflation is something that you see when your aggregate level of output, that is your output, whatever output that you're having right now, is less than the potential level of output. Okay. That will happen if you have deficit aggregate demand. Okay. You see deflationary gap or recessionary gap when you have deficit aggregate demand. You see inflationary gap when you have excess aggregate demand. If aggregate demand is in excess, you see inflation. If aggregate demand is in deficit, you see recession, right, everybody? Next, it occurs when the economy is in contractionary phase of the business cycle. Business cycles are nothing but, there are fluctuations in the economic activity, and you typically have 4 phases in your business cycle, which is your expansion, your peak, contraction, and depression. So what is the meaning of contraction? It is the period of falling economic activity. Contraction is the period of falling economic activity. So whenever economic activity is on decreasing trend, your aggregate demand kind of decreases, right? So what do you see in recession? You see deficit aggregate demand during recession. So at the full employment level of output, if the AD for an amount of output is less than the full employment level of output. So if the aggregate demand is not, whatever full employment level of output you have to reach, for that you require a specific amount of aggregate demand. If right now whatever aggregate demand you are having is not sufficient for you to meet the full employment level of output, then you are under your recessionary phase. Right, then deficient demand exists. This deficient demand gives rise to deflationary gap. If you see the graph, you will clearly understand, students. The OQ star is the full employment level of output. Okay, so if you are actually producing at the full employment, you need to produce OQ star. But right now, what is that you're having is your aggregate demand is this. Your aggregate demand is this. So at this aggregate demand, you are only able to produce this level of output, which is M. So M is less than the full employment level of output. You actually could have produced Q star, but you're only producing M. What is the reason you're only producing M? Because your aggregate demand is less when compared to the aggregate demand that is required for you to achieve the full employment level. So what aggregate demand will help you achieve the full employment level? This dotted line is the level of aggregate demand that will help you achieve the full employment level of output. So as you can see, this dotted line is intersecting your aggregate supply at this point, and this point is your full employment level of output. So what do you observe here? You require Q star F. What is the aggregate demand that you are requiring to achieve the full employment level of output? You require Q star F. But what do you have in hand? You have Q star G. You require Q star F level of aggregate demand. But what do you have in hand? You have Q star G. So the gap between F and G, this is your deficit demand. This is your deficit demand. So you are lacking in this. So there are only two questions you have to pose yourself. How much do I require to achieve the full employment level? How much am I having right now? If whatever you are having right now is less than what is required to achieve the full employment level, you are in deficit. If whatever you are having right now is more than what is required to achieve the full employment level, you are in surplus. Whenever you are in surplus, you will see inflation. Whenever you are in deficit, you see recession, right? So these are the things. Next, let us discuss your inflationary gap. So what are the questions I asked you? What do you require? What do you have? If what do you have is greater than what do you require, then you will be in inflation. If what do you have is less than what you require, you are in deflation. Now you are in inflation, right? So you have excess demand. You are having something that is more than the required amount of demand. So let us see the amount of inflationary gap. So what is it? Q star is your what? Full employment level of output. To achieve this full employment level of output, you require Q star F level of demand. What do you require? You require Q star F level of demand. But what is it you're having is, you're having Q star G. You require Q star F. You're having Q star G. So this is your excess demand. This portion that you're seeing right now in your flower bracket is your excess demand, that you're in excess of what that is required. So this is your inflationary gap. Now there is something some key point that you have to remember here. People always notice that whenever you reach full employment, it indicates that you have actually produced whatever you can. You have exhausted the full capacity. Now, even if the demand is increasing, the only increase that you see is in your nominal variables, not the real variables. That is, as you can see, you are actually at M level of output. You have a feeling that, madam, you said Q star is the full employment level of output. I am at M level of output. So I am greater than what is Q star. I am greater than Q star. That is a good thing. No, why are you feeling sorry about? See, the thing that has happened here is, after Q star, whatever increment in your national income that you are seeing is only due to increase in the prices. What happened here was, supply became constant. At the full employment level of output, your supply became constant. That is, it has become vertical. Okay. Now what happened? Your aggregate demand has increased. Initially, this was your aggregate demand. Now your aggregate demand increased. So what is happening here? The price is increasing, but do you see any increment in the level of output? No. So after the full employment level of output, the supply becomes constant. The supply being constant, if there is an increase in the aggregate demand, that will only foster an increase in the prices. So whatever increment in the income that you are seeing is the nominal increase, not a real increase. Okay. So those are the things I wanted to just memorize for you. So as you can see, in the Keynesian model, neither wages nor your, one second. So in the Keynesian model, neither wages nor interest rates will decline to automatically adjust to the market conditions. So okay, let me just take you back to some things. According to classical economists, your wages, your prices, your rate of interest are very, very flexible. So why are they flexible? They are flexible for the very reason because classicals believe that the market is self-adjusting. And for market to self-adjust, you need to have whatever things that I have told you right now to be highly flexible. But according to Keynes, who is, living in the short run, he said the wages, prices, interest rates, whatever you are talking about are not really flexible. They are actually rigid. So the market cannot really self-adjust. That is what Keynes has told. So what is that you have to remember here? According to classicals, your prices, your wages, your rate of interest are flexible, which actually makes the market, sort the disequilibrium, whatever it is encountering. But according to Keynes, whatever variables that I have told you right now, they are not actually flexible. They are actually rigid. which is the reason why your market is not very self-adjusting and Keynes has required for government intervention. Clear everybody? So this was few things with regard to your two sector model. Now what we will do is we'll discuss something called as multiplier. We'll discuss something called as multiplier. I will make you understand multiplier with the help of a graph. So as you can see, this is your income line or your reference line, nothing but your aggregate supply line, right? So your aggregate supply is denoted by Y, and your income can be used either for consumption or for savings, right? Now this is your aggregate demand line. This is your aggregate demand line, which is equal to C plus I. What is your aggregate demand line? It is equal to C plus I, sorry. Now, what happened was we have increased your aggregate demand. What it did is we have increased your investment, let us say for suppose. So, you have a fresh aggregate demand. Okay, this is a bit cross. Let us use another color. Yeah. So, your aggregate demand shifted upwards. This is AD is equal to C plus I bar. Okay. This is I bar, this is I1 bar. Okay. So what happened? There was an increment in the investment and your aggregate demand shifted upwards. So you notice something very unique here. Your investment increased by this amount. This is the change in the investment. Agreed? This is the change in the investment. But what is the change in the income that you see? You see a larger change in the level of income. That is, with a small increment in the investment, if you see a large change in the income, this is the change in the income. As you can see, change in the income is greater than change in the investment. As you can see, your change in the income is greater than change in the investment. This is your multiplier. This is your multiplier. So what is your multiplier? It is change in the income due to change in the investment. What is multiplier? Change in the income due to change in the investment. Your multiplier is denoted by small k. Your multiplier is denoted by small k. So what will be the change in the income? It will be k times delta I. It will be k times delta I. Now what is the how do you calculate your multiplier? Your small k is equal to 1 by 1 minus MPC. Your small k is equal to 1 by 1 minus MPC, which is your multiplier. To be more precise, this is your investment multiplier because you're calculating the change in the income due to change in the investment, right? So this is your investment multiplier, which is 1 by 1 minus MPC. How did I get this 1 by 1 minus MPC? Let us do it. So you all know that at equilibrium, aggregate demand is equal to aggregate supply. You all know that aggregate demand is equal to aggregate supply. You denote your aggregate supply by Y. You denote your aggregate demand by C plus I. You denote your aggregate supply by Y and you denote your aggregate demand by C plus I, right? So how do you write C? It is nothing but A plus BY. Your consumption equation is A plus BY and I is autonomous, right? So I bar. I is autonomous, so I bar. So plus I bar. So you have Y common here. So can I write it as Y minus BY is equal to A plus I bar, and I will take Y common. 1 minus B is equal to A plus I bar. Now Y is equal to 1 by 1 minus B into A plus I bar. Yes, clear everybody? Now I'll split it. So Y is equal to A by 1 minus B plus 1 by 1 minus B into I bar, right? So if I want to understand what is the change in the income due to change in the investment, can I differentiate? I will go for partial differentiation. So let me say dou Y by dou I is equal to change in the income due to change in the investment. So the remaining all aspects will be considered to be constant. So this is considered to be a constant. So differentiating a constant will be 0 plus 1 by 1 minus B. So what is your investment multiplier? It is 1 by 1 minus B. What is B, people? It is nothing but your MPC. 1 by 1 minus MPC. So this is how I got your investment multiplier. Clear everybody? Yes. So these things you have to remember. And some other things that you have to remember is, according to Keynes, your values of the MPC will vary from 0 to 1. But he said that they will be greater than 0.5. This is very, very important. According to Keynes, the value of MPC will vary from 0 to 1, but the value will be greater than 0.5. That is something that he has told. Okay. Now let us discuss something else. So you got your investment multiplier to be 1 by 1 minus MPC. MPC values vary from 0 to 1. If MPC is 0, then the multiplier will be equal to 1. If MPC equal to 0, multiplier will be equal to 1. If MPC is equal to 1, multiplier equal to infinity. If multiplier equal to infinity. So when will multiplier be equal to infinity? If MPC is equal to 1, then your multiplier will be equal to how much? It will be equal to infinity. Clear everybody? Yes. So what is the relationship between your MPC and multiplier? They have what relation? They have an inverse relation. If MPC decreases, multiplier increases. If MPC decreases, multiplier increases. If MPC increases, multiplier decreases. Now you tell me if I am right or wrong. Now you tell me if I am right or wrong. Okay. So I'll give you 2 minutes time, or you can pause the video and analyze whatever I have told you right now. You have to tell me if I am right or if I am wrong. Okay. Think and tell me. I have already written that your multiplier is nothing but 1 by 1 minus MPC. So I have written that if MPC is increasing, your multiplier is decreasing. If MPC is decreasing, your multiplier is increasing. So whatever I have written here is a big blunder. Okay. Your MPC and your multiplier have a direct relation. Your MPC and your multiplier have a direct relation. MPC increase, multiplier increase. People, if MPC is decreasing, your multiplier will decrease. I wrote your multiplier to be 1 by 1 minus MPC. So can I write it as 1 by MPS? Okay. When MPS is increasing, multiplier will decrease. When MPS is increasing, multiplier is decreasing, because this is a leakage. MPC is an injection. So when injections are increasing, multiplier will increase. When leakages are increasing, multiplier will decrease. So this is the concept of your multiplier. Next, everybody. So we'll discuss something else, which is your multiplier shows how shocks to one sector are transmitted throughout the economy through the ripple effect of water. So what is happening here? I told you that whenever you are increasing the investment, your income is increasing more than the increase in the investment. So what is happening here? When you increase the investment, what happened? Your aggregate demand increased, right? So when your aggregate demand has increased, what happened to the investment? That also increased. When your investment has increased, you started hiring more number of people and you kind of created more employment opportunities. When you created more employment opportunities, what is happening to the incomes of the people? Increasing. If incomes of the people are increasing, what will happen to the demand? It is increasing. So as you can see that this process is going on happening. This process is going on happening like a virtuous cycle of prosperity, right? So this is called as the ripple effect of water. This is called as the ripple effect of water. So as you can see, assume in a two-sector model, the economy is in equilibrium and the autonomous investment increases by 500 units. But the increase in income that you see is more than 500 units, right? So what is the reason behind this? An upward shift in the aggregate demand leads to an increase in the income and equal to increase in disposable income. Firms experience increased demand, increase their output. The process further continues as an autonomous rise in investment leads to induced increase in the consumer demand. That is what I am telling you. So whenever you are increasing your investment, the employment opportunities are increasing, income levels are increasing, consumer demand is also increasing. So you are kind of actually posing an impact in other sectors as well, creating a ripple effect of water. Right? So what is the impact of leakages on the multiplier? See people, always remember that injections will increase the multiplier, leakages will decrease the multiplier. Leakages means what? They kind of cause a fall in the economic activity. When there is a fall in the economic activity, what will happen to the multiplier process? It will die down. It will die down. Okay. So this is very, very important. You have to remember this equation. So how did I get this? How did I get this? Because you people learned that C is equal to A plus BY. You learned that C is equal to A plus BY. So how did I get this? This is even right or wrong? So let us see how did we get this. Okay. So Y is equal to C plus I. Y is equal to A plus BY plus I. Y minus BY is equal to A plus I. Y is equal to 1 by 1 minus B into A plus I. So what is the value of I that you got? 1 by 1 minus b into a plus I. What is C? C is equal to a plus by. Substitute y in C, which is equal to a plus b by 1 minus b into a plus I. Simple. Okay. So this is how you got this. This is how you got this. Clear, everybody? So what did I do here? I have just substituted the value of y that I have obtained in your consumption function, which has given me a plus b by 1 minus b into a plus I. Yes. Next, people. So we'll continue with the three sector model. We'll continue with the three sector. So students, let us continue with your three sector model. So what is your three sector model? You have C plus I plus G. That is, you include government expenditure, but you exclude the foreign sector, right? So what do you see here? In the Keynesian three sector model, AD consists of household consumption plus your business investment and your government sector's demand for goods and services. So here, what are you not including? You are not including the foreign sector. So what are the assumptions that we are taking? Investment and government expenditure are constant. So I told you, right, your investment and government expenditure are independent of the level of income. So you denote them with I bar and G bar. You denote them with I bar and G bar. Next, there is also no foreign sector. Next, prices are fixed, all are real variables. So what do you see here is that you are in short run, right? You are in which run? You are in short run. And according to Keynes, the prices are rigid. According to Keynes, the prices are rigid. So whatever increase you see, that is the increase in the real variables, right? So at equilibrium, what do you see? Your aggregate demand is equal to aggregate supply. Your aggregate supply, also called as your aggregate income, is denoted by Y. So Y is equal to C plus I plus G, right? So what do you see here is, let us see it in a graph which will make the things even more easy. So what I will do is, in panel A, I will draw your aggregate demand. In panel B, let us see your leakages and injections. Okay. So what do you do here is, please draw first your 45-degree line, which is nothing but your reference line or your aggregate supply line, right? So Y is equal to C plus S plus T. What is this T? See, your income can be spent either for consumption, either for savings or for taxes, right? Now you have your aggregate demand line, which is C plus I plus G. What is your aggregate demand? C plus I plus G. So at equilibrium, your aggregate demand is equal to your aggregate supply. What is your aggregate demand? C plus I plus G is equal to C plus S plus T, which is your aggregate supply or your aggregate income. So if you cancel out your C's, your I plus G is equivalent to S plus T. Your I plus G is equivalent to S plus T. So what is I plus G here? They are your injections. I already taught you, right? Your investment and government expenditure are considered to be injections. Savings and taxes are considered to be leakages. So what do you see? At equilibrium, your injections are equal to your leakages. Your injections are equal to your leakages. So what we will do is, let us draw your leakages injections graph as well. Fine. So you guys know that, you already know that this is your savings line. This is your savings line, but this is also your leakages line now. You have not only savings as leakages, but also you have taxes, right? So this is your S plus T, and they are directly related with the level of income. They are directly related with the level of income. So as income increases, your savings increase, and as we follow progressive taxation, your tax liability will also increase, right? So what is happening here? Let us draw another line. So let us say this is your I plus G. This is your I plus G. Fine. So this is your injection. I plus G is nothing but your injection. I plus G is your injection, right? So whenever you are in equilibrium, you just have to draw it this way. It has to come a bit like this, okay? So whenever you are in equilibrium, that is whenever aggregate demand is equal to aggregate supply, your I plus G is equal to S plus T. I have proved it here, right? That is what we are planning to show it in the graph as well. So whenever AD is equal to AS, your injections are equal to your leakages. Here in the three sector model, the injections are I plus G, the leakages are S plus T, right? So if you are below the 45-degree line, what do you see here? You see aggregate supply greater than aggregate demand. So your S plus T will be greater than I plus G. That is, leakages will be greater than the injections. Whenever leakages are greater than injections, what will happen to the income? It will decrease. And here, as you can see, whenever you are above the 45-degree line, your aggregate demand is greater than your aggregate supply. So I plus G is greater than your S plus T. Here, as you can see, your injections are greater than the leakages. Here, what do you see? Your injections are greater than the leakages. So whenever your injections are greater than the leakages, you see a rise in the economic activity. So income will increase, right? So whenever disequilibrium is there, that is set out. So whenever disequilibrium happens, that is corrected by, adjustment of your income. So if aggregate demand is greater than aggregate supply, injections are greater than leakages, leading to an increase in the income, and you will be approaching the equilibrium level. Whenever supply is greater than demand, leakages are greater than your injections, there is a decrease in the level of income and you are approaching the equilibrium level of income. Okay, so let us see what they have written here. Taxes on households, business sector used to fund the government purchases. So the taxes that we are talking here are your what? They are your leakages. So that leakages are being injected back into the economy in the form of government purchases. Government borrows from financial markets. See, there are chances where your government expenditure can be exceeding the government revenue, right? So what will be the government doing then? It will be borrowing some money. Next, two leakages that household sector have are savings and your tax payments. And what are the injections that you have? You have your government expenditure and you have your investment, right? Next, this is the graph that they have shown here. So in panel A, what did they show? They showed your aggregate demand. So they first drew your consumption function, which is C is equal to A plus BY. Later they added investment. Investment is an autonomous component, right? So yeah, as you can see, your aggregate demand shifted upwards by a constant amount, which is I. Now we are also including G because we are in the three sector model. So again your C plus I have shifted upwards by a constant amount, which is your government expenditure, right? So whenever you are in equilibrium, that is C plus I plus G is equal to your aggregate supply, that is aggregate demand is equal to aggregate supply. What do you see? You see that your I plus G is equal to S plus T. Your I plus G is equal to S plus T. That is, your injections are equal to your leakages. That's it. Next, this everything we have discussed. So what we will do right now is we will derive these different formulas. Okay, people, this is very, very important, which you have to memorize. Okay, all these things that you are witnessing here, you have to memorize. So what have they written here? At equilibrium, your aggregate supply is equal to aggregate demand. So as government is present, you also have something called as taxes, right? So for taxes, they have given T bar plus Ty. So let us understand what is the meaning behind this. See, T bar is autonomous taxes. T bar is autonomous taxes. See, what are autonomous tax or lump sum tax, to be more precise? Your T bar is your lump sum tax. What is your lump sum tax? Irrespective of the level of income, you will be imposed by this lump sum tax. So you are not connecting with the level of income. Now this small t that you see here is your proportional tax. So this is your lump sum tax. And this is your proportional tax. This is your proportional tax. Clear, everybody? So you have two types of taxes. One is the lump sum tax, which is independent of the level of income. The other is the proportional tax, which is related to the level of income, right? So we have to take that into consideration as well when you are calculating the disposable income. I will show you how do you do that. Fine. Next. So whenever you have a lump sum tax, what will be the value of the multiplier? Whenever you have lump sum tax and proportional tax, what will be the value of the multiplier? If you don't have lump sum tax, proportional tax, what will be the value of the multiplier? So all that they have written here. You have something called as transfer payments. People, whenever we are calculating the disposable income, you also take into consideration the transfer payments. So what are transfer payments? Transfer payments are one-way traffic, right? The unemployment benefits or the pensions or the scholarships that you keep receiving from the government are considered to be transfer payments. See, they are not received on behalf of some productive activity, but they are just coming into your hands without you even earning them, right? So that is the reason they are considered to be transfer payments. And whenever you are calculating your disposable income, you have to take into consideration taxes. You have to take into consideration the transfer payments as well, right? So how do you do that? That we'll have a look just now. Okay. So yeah. So after doing this, we will proceed with the four sector model, and you have your foreign trade multiplier. After that, we can end the lecture and we can proceed to do some problems. But before that, my request is please take out your notebooks so that you can write things down. So let me write the, things for you, like what are the things that we are considering. So first of all, we are talking about the three sector model. So here your AD is equal to AS indicates, Y is equal to aggregate supply, aggregate demand is equal to C plus I plus G. At equilibrium, aggregate supply is equal to aggregate demand. So Y is equal to C plus I plus G. Okay. Yes. So what is your, tax equation? T is equal to T bar plus small t y. T is equal to T bar plus small t y. So your taxes are a summation of lump sum tax and as well as proportional tax. And what does TR denote? They denote your transfer payments. What is your consumption equation? Which is C is equal to A plus B y D. Your consumption is a function of disposable income. So what is disposable income? It is Y minus taxes plus transfer payments. Your YD is equal to Y minus taxes plus transfer payments. Like after deducting the taxes, after adding the transfer payments, what you are left with is your disposable income. That is the money that is available for you to spend. Okay, everybody? Yes. So let us write down your things. So Y is equal to A plus B into Y minus, what is your equation for taxes? Minus T bar minus small ty plus, this is your C, plus I bar and your G bar. I bar and G bar indicates they are your autonomous components or independent of the level of income. They are constant in the short run, right? So multiply this. Y is equal to A plus by minus bt bar, sorry, minus bty plus, okay, we forgot to add transfer payments, students. So add your transfer payments as well, plus btr plus I bar plus G bar. Okay, so plus I bar plus G bar. So take all the y terms on one side. So y minus by plus bty, y minus by plus bty is equal to a minus bt bar, what else, plus btr plus I bar plus G bar. Okay, so this is your thing. Next, take y common, y into 1 minus b plus bt is equal to a minus bt bar plus btr. This is also autonomous, okay, plus I bar plus your G bar. Now take b also common, 1 minus b into 1 minus t is equal to a minus bt bar plus btr bar plus I bar plus G bar. Okay, so y is equal to 1 by 1 minus b into 1 minus t into a minus bt bar plus btr bar plus I bar plus G bar. Okay, this is the thing that you have. This is the thing that you have. And whatever you are seeing here right now is your multiplier. Whatever you see here is your multiplier. See people, you have an equation here. Your income is being influenced by your lump sum tax, by transfer payments, by investment, by government expenditure. Now we only want to understand what is the change in the income due to change in the investment. What is the change in the income due to change in the investment? Okay, this will become your investment multiplier. So what is it? 1 by 1 minus b into 1 minus t. You just have to do the differentiation here. Okay, you just have to do the differentiation. Now what is dou y by dou g? It is government expenditure multiplier. That is change in the income due to change in the government expenditure is nothing but your government expenditure multiplier. So this will be 1 by 1 minus b into 1 minus t. Right, students? Now, what is your transfer payments? So, change in the income due to change in the transfer payments is b by 1 minus b of 1 minus t. What is your lump sum tax multiplier? It is dou y by dou t bar, which is minus b by 1 minus b into 1 minus t, which is minus b by 1 minus b into 1 minus t. So, these are the different multipliers that you have got. See, whatever method I have shown you right here, the same method you have to apply while you are doing your foreign trade multiplier. Okay. So, the same method you have to apply for your foreign trade multiplier. This is a very, very simple thing. What you have to do is, you just have to do the differentiation after you kind of, bring out these things. Like if I only want to know what is the change in the income due to change in the investment, I keep the remaining things constant. If I only want to know what is the change in the income due to change in the transfer payments, remaining things are taken to be constant. So that is how you do the thing. So as you can see, these are the different multipliers. Okay. So this we have already done. So you got your 1 by 1 minus b of 1 minus t. But if you don't have any taxes, be it your lump sum tax or your proportional tax, what is the government expenditure multiplier? 1 by 1 minus b. The same like your investment multiplier that you got in your 2-sector model, right? So let us proceed to your 4-sector model. In your 4-sector model, you have a foreign sector. So it is y is equal to c plus I plus g plus x minus m. So what is your foreign sector? It is C plus I plus G plus X minus M. You are also taking into consideration the net exports here, right? So people, just listen to me carefully. So whenever you are talking about exports and imports, in exports, your exports are your injections and imports are your leakages. So what are the list of leakages that you have? Your savings are a leakage, your taxes are a leakage, your imports are a leakage. Now, what are the list of injections? Your government expenditure, the level of investment, and exports are considered to be the injections, right? So, whenever you are in equilibrium, that is whenever aggregate demand is equal to aggregate supply, the injections are equal to your leakages. So, what will you get? You will get S plus T plus M. What are these leakages? Is equal to I plus G plus X. These are your injections, right, everybody? This is what you will be getting in your 4-sector model. So let us see this. So as you can see, S plus T plus M, this is plus, S plus T plus M is equal to I plus G plus X. So you are in equilibrium when aggregate demand is equal to aggregate supply. So if you are above the 45-degree line, what do you see? If you see that aggregate demand is greater than aggregate supply. If you are below the 45-degree line, aggregate supply is greater than your aggregate demand. Clear, everybody? So here what you have to remember is your foreign trade multiplier. Here what do you have to remember is your foreign trade multiplier. So what is the foreign trade multiplier? I will just take you through that. Your foreign trade multiplier is nothing but, this is your foreign trade multiplier, right? It is 1 by 1 minus b of 1 minus t plus m. It is 1 by 1 minus b of 1 minus t plus m. If you don't have the proportional tax, your foreign trade multiplier will be 1 minus b plus m. If you don't have a proportional tax, your foreign trade multiplier will be 1 by 1 minus b plus m. Okay. So if what will I do is, I will just do this also so that you can have some clarity. So let me do this. So before that, you need to learn this as well. Your imports equation is your m bar plus my. So what is small m? It is marginal propensity to import. What is small m? It is marginal propensity to import. What is your m bar? It is autonomous imports. That is your independent of income. Okay, what is M bar? Autonomous imports, which is independent of the level of income. MPM is your marginal propensity to import. Clear, everybody? Yes. And your X is autonomous again. X is considered to be constant, X bar. Okay. So what we will do is, we'll calculate your foreign trade multiplier as well, so that things will be easy for you. So as you can see here, it is 1 by 1 minus b plus m. If I open the bracket, if I don't, it is 1 by minus of b minus m, right? It is simple as that. Okay, what I will do is, I will calculate this multiplier for you so that you can understand. So as you know, even in a 4-sector model, the equilibrium condition is aggregate demand is equal to aggregate supply, right? So y is equal to C plus I plus G plus X minus M, right? Yes. So X is autonomous, so I'll write X bar. So Y is equal to A plus B YD plus I bar plus G bar plus X bar minus of, it is M bar plus small m y. It is M bar plus small m y. So Y is equal to A plus B YD plus I bar plus G bar plus X bar minus M bar minus small m y. So take all y's on one side. It is y minus by plus my is equal to a plus I bar plus G bar plus X bar minus M bar, right? So if you take y common, it is 1 minus b plus m is equal to a plus I bar plus G bar plus X bar minus M bar. Okay. So if you take y is equal to 1 by 1 minus b plus m into a plus I bar plus G bar plus X bar minus M bar. Now if I want to calculate the the foreign trade multiplier, it will be this. It is foreign trade multiplier is equal to 1 by 1 minus b plus m. That is, if you take dou y by dou x, it will be 1 by 1 minus b plus m. If you take dou y by dou m, it will be minus 1 by 1 minus b plus m. So this is your foreign trade multiplier. Clear, everybody? So this is the thing. So what they have done is they have taken the minus sign common. So if you will get my 1 by 1 minus of b minus m. These are the things that you have to remember in your what 4-sector model. So thank you, students. What we have done right now is we have completed your chapter. We have completed your chapter entirely. So you just take a look at these multiplier things. Okay. So just remember that in a 2-sector model, it is the multiplier formula is 1 by 1 minus MPC. In a 3-sector model, if you don't take the proportional tax and the lump sum tax, it will be 1 by 1 minus MPC. If you take the proportional tax, I already showed you the calculation, and your simple foreign trade multiplier is 1 by 1 minus B plus M, or 1 by 1 minus of B minus M. So for you to attain some confidence, what we will do right now is we will do some problems. We will do some problems so that you will be familiar with the concepts, so that you can attain some surety that, okay, I've listened to the lecture and I'm actually able to apply the things. Fine. Okay, students. So what we will do right now is to enhance our conceptual knowledge on Keynesian determination of national income, let us solve few problems. Fine. So what is that you see here? Under the equation, C is equal to A plus BY, B is equal to 0.8. What is the value of expenditure multiplier in a 2-sector model? Okay. So what multiplier are they talking about? They are talking about investment expenditure multiplier. So what is the formula for investment expenditure multiplier? 1 by 1 minus MPC. And in your consumption equation, as you can see, C is equal to A plus BY. This is your consumption equation. In your consumption equation, A is the autonomous consumption, BY is the induced consumption. In that, your small b represents your marginal propensity to consume, right? So what is the value of marginal propensity to consume they have given in the question? It is 0.8. So what will be the answer? 1 by 1 minus 0.8, which is 1 by 0.2. So what is 1 by 0.2? It is 5, right? So this is how you solve this problem. So we have just handpicked few questions which we will be taking you through, which will help you attain some confidence with regard to the chapter. So let us do the next question. If the consumption function is C is equal to 20 plus 0.5 YD, they have again given your consumption equation. So then an increase in the disposable income by 100 will result in an increase in the consumer spending by how much? So what do you have to do? They have given your YD here, right? They have given your YD here. You just have to substitute your YD here. So it will be C is equal to 20 plus 0.5 into 100, right? So what it will become? 20 plus 50. So what is your consumption? It is 70, right? So we will proceed with the next question. What is your next question? Calculate the value of MPC and MPS. So how do you calculate MPC? It is change in consumption due to change in income. See, once you calculate your MPC, MPS is a piece of cake. Why? Because MPC plus MPS is equal to 1, because MPC plus MPS is equal to 1. So your MPS will be 1 minus MPC. Your MPS will be 1 minus MPC. Am I right? Yes. So what they have given you here? They have given you Y1 initial income, Y2 new level of income. They have given you C1 initial consumption, C2 new level of consumption. So what is the formula for MPC? Delta C by delta Y. What do you mean by delta C? C2 minus C1. What do you mean by delta Y? Y2 minus Y1. So it is C2 minus C1 by Y2 minus Y1. What is C2 minus C1? It is 3000. What is Y2 minus Y1? It is 4000. So 3000 by 4000 is nothing but 3 by 4. So it is nothing but 3 by 4. What is 3 by 4? 0.75. So if your MPC is 0.75, it is quite obvious that your MPS will be 0.25. Yes, so this is option A. It is option A. I hope you understood how we did this. Let us proceed to the next question. Yeah, let us do this. An increase in the investment by 600 crores. So what did they tell you? There was an increase in the investment by 600 crores. So what is change in the investment? It is 600 crores delta I, and there was an increase in the national income by 2400 crores. So what is delta Y? It is 2400 crores, right? So what is the formula for your investment multiplier? It is, let me write that down. Your investment multiplier small k is equal to 1 by 1 minus MPC, right? So it is nothing but change in the income due to change in the investment is equal to small k, right? Change in the income is equal to change in the investment is your small k. So change in the income by change in the investment is equal to 1 by 1 minus MPC is equal to 1 by 1 minus MPC, right? So what is change in the income? 2400 divided by what is your change in investment that they have given? 600 is equal to 1 by 1 minus MPC, right? So what is 2400 by 600? It is 4. It is 4. 6 4 is 24, right? So it is 4. 4 is equal to 1 by 1 minus MPC, right? So if you cross multiply, 4 minus 4 MPC is equal to 1. So if you cross multiply, 4 minus 4 MPC is equal to 1. So what will this become? Minus 4 MPC is equal to, this is wrong, minus 4 MPC is equal to 1 minus 4. So minus 4 MPC is equal to minus 3. So MPC is equal to 3 by 4. MPC is equal to 3 divided by 4, which is 0.75. So what is the value of your MPC? It is 0.75. What will be the value of MPS? 1 minus MPC, 0.25. It will be 0.25. So did you understand what we did here? We have applied the formula of your investment multiplier. Investment multiplier is nothing but change in the income due to change in the investment. So it is option A, right? Next. Let us do this problem. Given the savings function S is equal to minus 10 plus 0.2y. 0.2 is what? It is your MPS. So what will be your MPC? 0.8. So what will be your MPC? 0.8, right? And autonomous investment is 50 crores. So we will tell me one thing, at the equilibrium level of income, your investment is equal to savings in a two-sector model, right? So if you equate savings and investment, will you get the value of Y? Obviously, you will get the value of Y. So it is minus 10 plus 0.2y is equal to 50. 0.2y is equal to 60. Y is equal to 60 divided by 0.2, right? It will be 300. Y is equal to how much? 300. So if Y is equal to 300, what will be the level of your saving? It will be 50. So in equilibrium level of income, your savings is equal to investment, right? So if investment is 50, your savings is also 50. If investment is 50, what is your level of savings? They are also 50. So what will be the level of consumption? It is income minus savings is equal to level of consumption. So it is 300 minus 50 is equal to level of consumption. So let us see the options if they are right or wrong. Equilibrium level of income is 300. That is what we have got. So it is correct. Next, Consumption equilibrium level of income is, consumption in the equilibrium level of income is 250. How did they get that? It is y minus s. What is the value of s? It is 50. Okay. Next. So this option is correct entirely? Correct. So if the investment increases permanently by 5 crores, so what is the change in the investment that you are seeing? It is equivalent to 5 crores. The new level of income is 325 crores and the consumption is 270 crores. So what are they saying? If they are asking if the statement is correct or not. Okay. So what is the change in the investment? They are saying it to be 5 crores. So let us calculate what is the new level of income. Okay. Let us calculate what is the new level of income. So I told you right already what is the level of MPC. It is 0.8. So let us calculate the value of multiplier first. So if MPC is equal to 0.8, what is the value of the multiplier? It is 1 by 1 minus MPC, which is equal to 5. How did I get that? 1 by 0.2 is equal to 5. So what is the change in the investment that they are telling you has happened? It is 5 crores. What is the value of investment multiplier? It is change in the income due to change in the investment is equal to small k. Small k is nothing but 1 by 1 minus MPC. That how much you got? You got it to be 5. So change in the income by 5 is equal to 5. Therefore, your change in the income is equal to 25. What will be the change in the income? It will be equivalent to 25, right? This you agree. What was your old level of income? 300. What is the new addition made to this income? It is plus 25. So what will be the new level of income? It will be 325. It will be 325, right? So what is the new level of income? It is 325. So what will be the level of consumption? It is y minus c. It is y minus s. I'm so sorry. What will be the level of consumption? It will be y minus s. So please calculate the level of saving at the new level of income. So what is the value of saving at the new level of income? Substitute y is equal to 325. So it will be 325 multiplied by 0.2 minus 10. So it will be 55. 55 is your level of saving. So what is your level of new level of income? 325 minus 55 is 270. So this is also correct. So both A and B are correct. So I hope you understood how we did this. It is very simple. See, the only trick in your Keynesian determination of national income is that you have to remember the conditions, the equilibrium conditions, and you have to use some logic. That is all. Nothing more and nothing less. Fine. Next. Let us do some other problems also. It will be helping you. So we'll randomly pick few problems. Okay, let us do this. Suppose you have the following information about a closed economy. So there is no foreign sector. So that C, I and G is given. So they are asking you to find the equilibrium level of income. So what is the condition for equilibrium? Your AD is equal to AS. Your AD is equal to AS, right? So what is your aggregate demand? C plus I plus G. What is your aggregate supply? Y. It is denoted by Y. So let us write down the information. 50 plus 0.8Y is your C. C is equal to 50 plus 0.8y. I is equal to how much? 200. G equal to 100. G equal to 100. So let us find out the equilibrium level of income, which is Y is equal to C plus I plus G. So Y is equal to 50 plus 0.8y plus 200 plus 100. So Y is equal to 200 plus 100, 300 plus 50, 350. 0.8y plus 350. So take y common. So it will be y minus 0.8y is equal to 350. Right? So it is y into 1 minus 0.8 is 0.2 is equal to 350. So y is equal to 350 divided by 0.2. What is it? 350 divided by 0.2, which is 1750. So what is your income? 1750. Let us see if it is there in the options. Yes, it is 1750. Let us see the next question. Suppose the G increases by 125. So what is delta G? It is equal to 125. What is the new equilibrium level of income? What is the new equilibrium level of income? Okay. So what do you do here is that calculate the expenditure multiplier, government expenditure multiplier. For that you require your MPC. Okay. So what is your MPC? 0.8, right? So 1 by 1 minus MPC is equal to 1 by 1 minus 0.8 is equal to 5 is your government expenditure multiplier. Okay. So what is government expenditure multiplier? Change in the income due to change in the government expenditure is equal to 5. What is the change in the government expenditure? Delta Y is equal to, how much is the change in the government expenditure they have given? I forgot. It is 125. What is the change in the government expenditure? It is 125. So delta G multiplied by 5 will be the change in the income. So 125 multiplied by 5. It is 625. Delta Y is equal to 625. What is the new income? It is Y plus delta Y. What is Y? It is 1750 plus 625, which is 1750 plus 625 is equal to 2375. Okay. So let us see if it is there or not. Okay. So they have not given it. So suppose G increases by 125. What is the new equilibrium level of income? So somewhere something has gone wrong. Let us have a look into this. So we'll just check what happened. They said G is increasing to 125. 1 second. Okay, so the mistake that we did here was they said G is increasing to 125. So originally it was 100. Now the increase is to 125. So how much is increased? 25 rupees. Okay, we took that 125 as delta G. Okay, that was the mistake that we have done here. So people, what we have to do is, like, G is 100, right? So G is 100. Now the G is 125. So what is delta G? It is 25. Your delta G is 25. So let me just correct that for you. So as you can see, your delta G is equal to 25. So your government expenditure multiplier is change in the income due to change in the government expenditure, which is 5. Multiplier is correct. We calculated no 1 by 1 minus MPC. That is all correct. So what will happen? Your delta Y is equal to 5 multiplied by 25. So what is 5 multiplied by 25? It is 125. So originally what was your income? It is 1750. It is 1750. For 1750, if you add 125, it is 1875. So your new income is 1750 plus 125, which is 1875. So you understood, right? English is also very, very important. They said it increases to 125. They did not say it increased by 125. So they have not told you that 125 has, increased. They only said originally it was 100, now it is 125. So the increment is only 25. We took the entire 125 to be delta G. There we went wrong. Okay. So this is the answer. 1875 is the answer. Next, what did they ask? What level of G is needed to achieve a target level of income of 2000? So they gave you the target level of income, which is 2000. They are asking you what is the level of G that you require to achieve this target level of income. So let us do. So people, let us do the problem. What are they asking? If you have to achieve Y is equal to 2000, what should be the level of government expenditure? So they have already given you Y. So you know that Y is equal to C plus I plus G, right? So what is the value of C? Do you remember? C is equal to some 50 plus 0.8Y. I is equal to 200. Okay. So Y is equal to 50 plus, excuse me, 0.8y plus I is equal to 200. G we have to find out. Okay, G is not yet known. G we have to find out. So Y is already given. Substitute Y. 2000 plus 50, I'm sorry, is equal to, 2000 is equal to 50 plus 0.8 into 2000 plus 200 plus G. Just say G is the missing figure. So 2000 is equal to 50 plus 1600, okay, plus 200 plus G. So if you minus these values from your 2000, 2000 minus 1650, 1850, no? 1850 is equal to Z. So G is equal to 150. So G is equal to 150. So for you to achieve an equilibrium level of income which is 2000, you need to have G which is 150. So let us see if that is correct or wrong. Yeah. So this is the level of income that you need to have, right? Fine. So let us do another problem. So which one should we do? So what we will do is, we'll do this problem, 78, 79. We'll do this and we'll, put an end so that the remaining problems, whenever you are doing, you will not have a query. So let us finish with this problem. So they have given C is equal to 10 plus 0.75 YD. Okay. I is equal to 50. G is equal to T is equal to 20. So they have a balanced budget. Okay. Your government expenditure is equal to taxes is equal to 20. Where C is consumption, I is equal to investment, YD is the disposable income. So they are asking you to find the equilibrium level of national income. So first let us write down the information in a legible manner. So they said C is equal to 10 plus 0.75 YD. This is what they have given. Yeah. C is equal to 10 plus 0.75 YD. I is 50, G equal to T equal to 20. G equal to T equal to 20. Okay. So how do you calculate your disposable income, students? It is Y minus T. How do you calculate your disposable income? It is Y minus T. So what they have given, C is equal to 10 plus 0.75 into Y minus 20. Because I have to eliminate taxes to know the disposable level of income, right? Okay. So Y is equal to C plus I plus D. That you all know. So Y is equal to 10 plus 0.75 into Y minus 20 plus I is how much? 50 plus G is how much? 20. So did they give any proportional tax, by the way? Hope they haven't. Yeah, they did not give any proportional tax. They have only given you lump sum tax. We don't want to make any more mistakes, right? Yeah. So Y is equal to, let us do this, 10 plus 0.75Y. So 20 into 0.75 is 15 minus 15 plus 50 plus 20. Okay. So 10 minus 15 plus 70, 80 and minus 15. 80 minus 15 is 65. So Y minus 0.75Y is equal to 65. So 0.25Y is equal to 65. So 65 divided by 0.25 is 260. So Y equilibrium level of income should be 260. What do they have? Yeah. So it is 260. What is the size of the multiplier? It is nothing but 1 by 1 minus MPC, right? So what is 1 by 1 minus MPC? It is they have not given proportional tax, so it will be 1 by 1 minus MPC. So what is the value of MPC? It is 0.75. So what is 1 by 1 divided by 0.25, which is 4. So it is 4 times. So the multiplier formula is 1 by 1 minus MPC. People, they have only given you the lump sum tax. If they have given you the proportional tax also, the multiplier would have been 1 by 1 minus B of 1 minus T. Never forget. So don't make such silly mistakes. So these are the problems that we wanted to discuss. So I hope that you enjoyed the session. You were able to learn something. So I'll see you all on the next session. Welcome back to another session of Economics of Finance. So in this session, we'll be discussing the concepts of money demand. Okay. So let us deep dive into the history of money first of all. So over the years, as you know that in the beginning what they used was cowrie shells, they used barley, they used peppercorns, they used gold, they used silver as money, right? So over a period of time, we got this paper money. But in the beginning, as you all know, we are very, you popularly know the usage of gold and silver. So how this paper money evolved? So let us understand that first, okay? So until relatively recently, gold and silver were the main currency that people used. So what people earlier did was, they used to have huge amount of gold and silver, right? They used to go to the banks, they used to deposit this gold and silver, and in return they used to get a bank note. That bank note they used to use for transaction purpose. Okay. Now what happened was they kind of delinked this gold with the paper money, and they kind of started something called as fiat money. So the meaning of fiat money is, fiat is nothing but on the order of the government. Okay, so fiat meaning is on the order of the government. So as gold and silver are heavy, so I already told you, right? People deposited these precious metals at banks and claimed a note against them. And this note was used for transactionary purposes. So to buy or sell anything, and again can be exchanged for precious metal. Later, paper claim on precious metals was delinked. So what happened later was they delinked this, paper claim for precious metals, and they introduced something called as fiat money, right? So fiat money is something that is accepted by all the people. So that is why it is used as currency. So fiat money, the fiat money is materially worthless. Okay, so materially it has got no value. If you see a 10 rupee note or 100 rupee note, it is not of that value, but still we are using it in circulation because people are accepting that as currency, right? So fiat money is materially worthless but has value simply because a nation collectively agrees to ascribe a value to it. Okay, the government has ordered people to use it as currency. So people are believing that this has some worth and they are using it as currency. Indian Union Minister for Finance and Corporate Affairs, who is she? Ms. Nirmala Sitharaman. In Union Budget for 22-23, she introduced something called as central bank digital currency. Okay, you know that these digital currencies called your Bitcoin, everything got so popular, right? So what our RBI thought was, we can actually come up with this digital currency which will be even more efficient, because for paper currency you need to print that, you need to circulate that, lot of cost is involved. But if you introduce digital currency, the efficiency will also increase, right? Next, so what is the definition of money? So that if we see in simple terms, money refers to the assets which are commonly used and accepted as means of payment. So what is money? See, anything that is accepted as a medium of exchange, that is considered to be money. And money has, some functions like it has medium of exchange, store of value, it is used as a standard of deferred payments, all that we'll be seeing in the coming sessions, right? Not only coming sessions, in the next topic itself, we are going to see that. Fine. Next, for policy purposes, money is a set of liquid financial assets. See, people, whenever you hear the term liquidity, it indicates that whenever something can be easily converted into cash, whenever something can be easily converted into cash and can be used for transaction purpose, it is considered to be liquid. And money is the most liquid asset, as it can be easily used for transaction purposes, right? Next, what are the different functions of money? So the first function that you see is medium of exchange. So what do you mean by this medium of exchange? Whenever you go to a market, whenever you want to purchase something, you give money and in return you take goods and services, right? So it is used for transactionary purposes. Next, unit of accounts. See, whenever you're going to purchase something, you ask what is the price, right? And that price is expressed in terms of money. So money is considered to be a unit of account. And what is standard of deferred payments? See, payment can be contracted for future date in terms of money. So using money, you can make future payments as well. So it is considered as a standard of deferred payments. Now, what is the store of value? People kind of love holding money. Why do they hold money apart from transactionary purpose? They believe that money has some value and it can be used for future purposes. Any unforeseen circumstances, anything can happen, right? So money is considered as a store of value, right? So what are the features of money? If you have these things, it is called as money, right? So money is totally liquid. What is liquid? Anything that can be easily used for transactionary purposes, it is considered to be liquid in nature, right? Money has generalized purchasing power. So why is money given so much of importance? Because using money, you are able to purchase many things, right? So money has purchasing power. Next, money is generally acceptable in settlement of all current and future transactions. See, money is not only used in the settlement of current transaction, but it is also used in the settlement of future transactions as well. That is why I told you, right? It is a standard of deferred payments. Now, what are the characteristics of money that you see here? It is durable and long lasting. See, all the notes that you see, like whatever 100 rupee note, 200 rupee note, whatever notes that you are using, whatever you are using in terms of money, has to be durable and long lasting. It should not be a case where you tear the 10 rupee note and it is cut into two pieces. So that cannot be called as money. And it is effortlessly recognizable. See, if I want to purchase something, and if I give a 100 rupee note, they must be easily able to accept it. They should not see the 100 rupee note and say like, what is this, is this used as money? So there should not be a question mark like that. So it has to be effortlessly recognized. Next, it has to be difficult to counterfeit. What do you mean by counterfeit? Duplication should be impossible. That is, people cannot duplicate the currency. That is said to be difficult to counterfeit. Okay. Next, relatively scarce, supply is elastic. What do you mean by relatively scarce? See, when I say relatively scarce, I mean to say that, see, whenever money is, supplied in the economy, it has to be scarce. No, otherwise it will not hold the value. Whenever something is in abundance, it will not hold any value. If you increase the money so much by tons, by tons of amount, your money will not hold value. What will happen in the economy? Inflation will pop up in the economy, right? So your money has to be scarce. And what do you mean by supply is elastic? If the RBI wants, it can increase the money supply. If the RBI wants, it can decrease the money supply. It can do that, right? So it is considered to be elastic. Anything that can be easily changed is something that is elastic. Next, portable or easily transported. See, earlier, why did people take a banknote? Because gold and silver were very tough for the transportation purpose. They were very heavy to carry. But now, after these paper notes have come into existence, they are easily portable or transported. Next, possessing uniformity. So what do you mean by uniformity? My 10 rupee note and the 10 rupee note in somebody else's hand has to be the one and the same. There should not be any difference. Okay, there should be uniformity whenever you are issuing money. Next, divisible without losing value. For example, I say I have 10 rupee notes and I have a 100 rupee note. Both are the same, no? Same value, no? If I have 10 rupee notes or if I have a 100 rupee note, it has got the same value. Just because I have divided the 100 rupee into 10 rupee notes, it must not be losing any value. So it has to be what? It has to be divisible but without losing the value. I hope I'm making myself clear. Yes? Okay, let us proceed to the next one, demand for money. So what do you mean whenever people say demand for money? Demand for money is nothing but the desire of the people to hold money. The desire of the people to hold money. So what I have there written here, it is the desire of the people to hold money. Demand for money is a derived demand, that is demand for liquidity and demand to store of value. See, what do you mean by derived demand? See, you are demanding money for some reasons, right? They are transactionary reasons, they are precautionary reasons. For those reasons, you are trying to hold money with yourself. So what is demand for money? It is the people's willingness to hold money. Next, though money gives no return. See, money in itself will not give any return, right? If you are holding money in your hand, it will not give you any return. But you kind of, if you invest that somewhere in a financial asset, like if you buy stocks or if you buy bonds, it will kind of give you some return. So though money gives no return, households and firms hold money because it is 100% liquid. See, now what I can do, I can either, keep my money in the form of stocks or in the form of bonds. But what will happen? The liquidity will kind of decrease. See, if I have money in my hand, I can immediately take up a transaction. If I convert the money into stocks and bonds, I have to convert them back into money if I have to conduct some transaction. So people are actually happy to hold money because of its liquidity, because it is 100% liquid and offers the most convenient way to meet the day-to-day transactions. That is the reason I told you that whenever people are willing to hold money, they are holding money for what? They are holding money for transactionary purpose, they are holding for precautionary purpose, and they can also be holding for speculative purpose, which we'll be learning in the future sessions. Like whenever we are discussing about the Keynesian, liquidity preference theory, all these aspects we'll be covering. Right, next, what are the determinants of money demand? Like on what grounds will you demand money? Like what are the factors that determine like how much your money demand will be? The first and foremost factor is your level of income. See, what is the first factor? It is the level of income. So higher the level of income, higher will be the demand for money. Why so? Because whenever the income is increasing, the transaction demand for money will also increase, right? Next, general level of prices. So what will happen if the prices are increasing? That is, you require more amount of money to fulfill day-to-day transaction. So what will happen to the money demand? Money demand will also increase. Next, rate of interest. See, this is your opportunity cost of money. For example, if I am holding money with myself, what is that I am losing? I am losing the rate of interest. So if in the market, if the rate of interest is increasing, if in the market, the rate of interest is increasing, what will happen to the demand for money? It will decrease, because if I'm holding money with myself, I'm losing something called as the rate of interest. So if the rate of interest is on an increase, the opportunity cost of me holding the money is actually increasing, right? So rate of interest and demand for money are inversely related. That is, rate of interest increase, money demand decrease. Rate of interest decrease, money demand increase. Next, degree of financial innovation. See, when we speak about degree of financial innovation, let us talk about your ATMs. Earlier, there were no ATMs, right? So you cannot easily withdraw money whenever you want. You cannot easily withdraw money whenever you want, right? So with the invention of ATMs, what is happening? People are not actually holding cash now. And now you have this Google Pay, Paytm, all this. So with the advent of Google Pay, Paytm, is anybody maintaining cash with themselves? Nobody is maintaining cash with themselves, right? Everybody is maintaining money in digital form, because see, making transactions has become more easy. So in earlier days, as making transactions was really tough, people actually demanded money. That is the reason there was high demand for money. So whenever there is financial innovation happening, the demand for money will also decrease. The demand for money will decrease. Next. So in this chapter, what we are going to do is, we are going to study the different theories of money demand. You have the quantity theory of money given by Fisher. You have the Cambridge approach. You have the cash balance approach. You have Tobin's. You have Baumol. You have Keynes. All this we will be covering in this chapter. So what we will do right now is, we will start with the classical approach, or the quantity theory of money given by Irving Fisher. Okay. So whatever equation that Fisher has given, that is called as the equation of exchange or the transaction approach. Okay. So let us just take a look. So first of all, let us understand what Fisher tried to tell. Fisher said that there is a direct relationship between money supply and prices. There is a direct relationship between money supply and prices. That is, whenever the quantity of money is increasing, the prices will also increase. That is what your Fisher has told. So let us write down what Fisher has told. Let us understand here. So what is the first thing that we will be learning now? It is the quantity theory of money given by Irving Fisher. What is it? Quantity theory of money. And what is the equation that he has given? It is called as equation of exchange. What is your equation of exchange? It is MV is equal to PT. What is the equation of exchange? It is MV is equal to PT. Okay. So what is the meaning of M? It is the quantity of money. V is the velocity. P is your average price level. And T is the total number of transactions. What is T? T is the total number of transactions. Yes, people. So what is the equation of exchange? It is MV is equal to PT. M is the quantity of money. V is the velocity. P is the average price level. T is the transaction. People, this side, whatever you are seeing, that is the left hand side, which is denoted by MV, is your money supply, and the right hand side, which is denoted by PT, is your money demand. So Fisher has stated that money supply should be equal to money demand, then we will be in the equilibrium. But before understanding any other things, we need to understand what is the meaning of velocity here. See, velocity is nothing but the rate at which you are the rupee is changing hands. In simple words, if I have to tell you, suppose I have got some 10 rupee note, that 10 rupee note with how much speed it is changing hands, that is called as velocity. The rate at which it is changing hands is nothing but your velocity. So what is that they have written here? Let us have a look. The quantity theory of money given by Irving Fisher is the demanded for transaction motive or the medium of exchange. Students, it is very, very important here to understand that. See, Irving Fisher actually focused only on a function called as medium of exchange. Your money has several functions, right? It is medium of exchange. It is also considered to be a store of value. It is a standard of deferred payments. All that we have studied just now, right? So what Irving Fisher has taken into consideration was, he only considered this medium of exchange function of money. He has not talked about anything with regard to store of value, right? Next, demonstration on QTM, which is your quantity theory of money. What does it say? There is a strong relationship between money and price level. What did your Irving Fisher say? There is a strong relationship between your money supply and price level. That is, whenever the money supply is increasing, the prices will also increase. So change in the quantity of money in circulation brings changes in the general price level of the commodity. So what is the Fisher's version of quantity theory of money? It is MV is equal to PT, right? So what is the meaning of M? It is the total quantity of money or the total amount of money in circulation, and your V is the transaction velocity, average price level, total number of transaction. I already told you, right, what is the meaning of V? The rate at which money is changing hands is your velocity. Okay? Yes. So Fisher has actually modified his equation further, saying that MV plus M dash V dash is equal to PT. So what Fisher did here was he has also taken into consideration the credit money. So what Fisher did here, he also has taken into consideration the credit money. Who creates the credit money? It is created by the commercial banks. So M dash is the amount of credit money created by commercial banks. V dash is the velocity of the credit money. V dash is the velocity of credit money. So what is the meaning of M dash? It is the total amount of credit money. V dash is the velocity of circulation of credit money, and total supply of money will be MV plus M dash and V dash, and total demand for money will be equal to PT. So whenever we are in equilibrium, your money demand is equivalent to your money supply, right? The more the number of transaction people want, the greater will be the demand for money. So whenever I have already told you, right, Fisher has already only talked about medium of exchange function. So he only talked about the transaction demand for money. He only talked about the transaction demand for money. So whenever the number of transactions are increasing, the demand for money will also increase. But what Fisher said here was, he told that the value of V and the value of T will remain to be constant. He said that the value of T and the value of V will remain to be constant. Okay. So when these are taken to be constant, whenever M is increasing, what will happen to the prices? That will also increase. So whenever the money supply is increasing, there is also an increase in the prices. Clear? Next. So your next approach is your neoclassical approach or the Cambridge approach or the cash balance approach. So neoclassical approach or the Cambridge or the cash balance approach. So it was given by the Cambridge economists who were Alfred Marshall, A.C. Pigot, Robertson and John Maynard Keynes. Money increases utility in transaction motive and also precautionary motive. See, the difference between your Cambridge approach and your quantity theory of money is, quantity theory of money spoke from money supply point of view. Cambridge equation spoke from money demand point of view. Cambridge equation focused on two functions of money, which is medium of exchange and store of value. Fisher has only focused on one function of money, which is nothing but your medium of exchange. He actually ignored the store of value. Okay. So what is the transaction motive? It is demand for money is a positive function of income. I already told you, right? Whenever the income is increasing, your transaction demand for money will also keep increasing. So higher the income, higher will be the transactions, higher will be the transaction demand for money, right? Since the value of aggregate expenditure is equal to money national income, it can be referred as transaction demand for money. What relation does it have with the aggregate expenditure? It is having a positive or a direct relationship. So what is the Cambridge equation? They said that money demand is equal to K times PY. So what is the meaning of K here? K is the proportion of money you are willing to hold. K is the proportion of money, or K is the demand for money of the total income. See, price multiplied by Y is your nominal income. Price multiplied by Y is your nominal income. See, Y is your real income. P is your average price level. If you multiply price with your real income, you will be getting your nominal income. So K is nothing but the portion of the nominal income which you are demanding, or it is your money demand. Okay, but there are two interpretations of K here that you have to take into consideration. So like I told you, MD is the demand for money, Y is the real national income, P is the general price level, and PY is nothing but your nominal income. So your real income multiplied by prices will give you your nominal income. So K is equal to Cambridge. K is a parameter of the economic structure and monetary habits expressed in two forms. So what are those two forms here? See, one is from an economy point of view, One is from an individual point of view. Here you have one from the economy point of view and one from the individual point of view. So what is the meaning of K here? From economy point of view, it is the ratio of total transactions to income. That is, like how many transactions are you going to take place in the as a portion of your total income, that portion you will be holding as money demand, right? Now if I talk from an individual perspective, I know that there are a couple of transactions that I want to take up. So in those transactions, for for performing those transactions, how much of it I'm willing to hold in the form of money, how much of it I'm willing to hold in the form of money, that is from an individual perspective. That is ratio of the desired money balances to total transactions. See, if I have to conduct a couple of transactions, in those transactions, how much of it I am willing to hold in the form of money. Clear, everybody? The equation explains the demand for money. It is the portion of the total money income. People, in simple terminologies, see, what portion of your money income are you willing to hold with yourself? That is your money demand. And the equation is money demand is equal to K times PY. PY is your nominal income. P is your average price level. Y is your real income. Right, everybody? Yes. Next. Precautionary motive. Here they have also considered another important function of money, right? Apart from being a medium of exchange, they also told that money is used for a store of value. Money's function is also a store of value, right? So that also has been taken into consideration. Since sale and purchase of commodities do not take place simultaneously. See, the meaning is, see, whenever you are receiving the income, you are not going to spend the entire thing on the same day, right? Your transactions keep happening all over the month, okay? So you keep receiving money and you don't keep spending money, okay? So there is a time gap that is there. So for the very reason you need to hold some portion of the money. For the very reason you need to hold some portion of the money. So since sale and purchase of commodities do not take place simultaneously, individuals need a temporary abode of purchasing power as a hedge against uncertainty. Suppose on first I have received my paycheck and my next paycheck will be on the first of next month. Till then I have to survive, right? So I need to hold some money for my precautionary purpose. I don't know when what will happen, right? So some money will be held for precautionary motive. As money gives utility in its store of wealth, money is demanded for itself. So money is very, very important because it is also acting as a store of value apart from being a medium of exchange, right? So next theory is your Keynesian theory of demand for money or the liquidity preference theory. So what your John Maynard Keynes did was he said that we hold money for three motives. One is your transactionary motive, the other is your precautionary motive, and the other is your speculative motive. So what did he say? We hold money for three motives: transaction motive, precautionary motive, and speculative motive. Transactionary motive and precautionary motive are a function of income, and speculative demand for money is a function of income comma rate of interest. So we'll discuss in detail what is your speculative motive. I'll explain that to you, but let us start with your transactionary motive. So people desire to hold money rather than securities or long-term interest investments. Total demand for money is the sum of, I told you, right, there are three types in this: transactionary, precautionary, and speculative. So what is transactionary motive? It is a direct function of money income. So if your income is increasing, the total number of transactions which you will be taking up will also increase. So if the income is increasing, the total amount of transactions which you are willing to take up will also increase. So the transaction demand for money will also increase, right? So need for cash for current transaction, for personal and for business exchange. Need for holding money is due to lack of synchronization between receipts and expenditure. I told you, right, there is a time gap between receipts and expenditure. The moment you receive the money, you don't spend the entire money, right? And there is a gap, or rather a time gap between your paychecks. One you receive on the first of this month, the next is on the first of next month. So in between whatever time period is there, you need to, carefully allocate your money expenses. Next. So whatever you are seeing here, this is the transaction demand for money equation. So LR is nothing but the transaction demand for money, K times Y. It is K times Y. That is a portion of your income you are holding as transaction demand for money. Next, what is precautionary motive? It is also a direct function of your money income, right? So whenever money income is increasing, the precautionary demand for money also keeps increasing. So why do you maintain money for precautionary purposes? Because you never know what is going to happen. There are always uncertainties happening, right? So for that, you need some portion of the money to keep it to be kept aside. So individuals and business keep a portion of their income to finance the unpredictable incidents. Unpredictable incidents in the sense you may never know what will happen. Some health expenditure may come up, some sudden educational expenditure may come up. So for those sudden expenditures, you maintain some portion of the money. Depends on the size of the income, economic and political condition, personal characteristics, that is optimism or pessimism. See, when do you actually maintain money for precautionary motive? If you're far-sighted in nature. So if you run on check to check basis, that is different. Okay. So if you do that, then you will not be going for precautionary motive. If you are only far sighted and if you're very, if you are very pessimistic about the future and also optimistic about the future, you want to maintain some good amount of money for precautionary purposes, right? Next, speculative demand for money. It is an inverse function of rate of interest. So what we will do right here is we will just, draw a graph for you that will easily help you understand. Okay. I told you, right, the speculative demand for money is inversely related to the rate of interest. I'm going to mark my rate of interest on y-axis, the speculative demand for money on your x-axis. I'm going to mark your rate of interest on y-axis and the speculative demand for money on your x-axis. So if you see the graph, it is downward sloping. If you see the graph, it is downward sloping. And the reason it is downward sloping is because the inverse relationship between the rate of interest and speculative demand for money. Okay. So here you will be having two interest rates. One is the critical rate of interest. One is the rate of interest that is prevailing in the economy. One is the rate of interest that is prevailing in the economy and the other is your critical rate of interest. Fine. Apart from this, you also have to learn something with regard to bond yield and bond prices. Always remember, students, there is an inverse relationship between bond prices and bond yield. So if bond price increases, bond yield, which is nothing but the rate of interest, will decrease. So what will happen if bond price increases, the bond yield will decrease. So what is the relationship between bond price and bond yield? It is inverse relationship, right? So what happens here is you're actually at this particular rate of interest. You're actually at this particular rate of interest. Now we are expecting the rate of interest to increase. So let us just write this down in an order. You're actually at a particular rate of interest. Okay. So, and you're expecting the rate of interest to increase. Okay. You're expecting the rate of interest to increase. Okay. So, for example, the prevailing rate of interest is less than the critical rate of interest. Critical rate of interest is nothing but the what is the rate of interest that you are expecting in the future that it will be. Okay, that is your critical rate of interest. So if your prevailing rate of interest is less than the critical rate, one day it will reach the critical rate, right? So in the future, you are expecting the interest rates to increase. So whenever the interest rates will increase, what will happen to the bond prices? They will decrease. Whenever interest rates will increase, what will happen to the bond prices? They will decrease, right? So what will happen to your speculative demand for money? It will increase. What will happen to the speculative demand for money? It will increase or it will decrease. You have to think and tell me now. Okay. So that is, I'm leaving it to you. Just pause the video for 2 minutes and think and answer. But I will give you a small hint. Always remember, students, the relationship between the rate of interest and the speculative demand for money is inverse. The relationship is inverse. Okay. So if you are expecting the rate of interest to increase in the future, so what will happen to the bond prices right now? Bond prices then they will decrease. So in the future, if the bond prices are decreasing, what will happen? It will be a capital loss for you. It will be a capital loss for you. So will you hold the money to yourself or will you invest in the bonds? You will definitely hold the money to yourself, right? So this is the thing that you have to remember. What I will do right now is I will take you through the material so that you will understand it, even in a better manner. So let us do it again. So speculative demand for money is an inverse function of your rate of interest. So people hold money balances to take advantage of the future changes of rate of interest and bond prices. So students, what is the relationship between rate of interest and bond prices? There exists an inverse relationship. That is, if rate of interest increase, the bond prices will decrease. If the rate of interest will decrease, the bond prices will increase, right? So what are the assumptions here? Expected return on money is 0. See, money itself will not give any return for you. So the expected return on money is considered to be 0. Expected return on bond is what? Your interest rate and the expected rate of capital gain. So what is this capital gain? For example, you are purchasing bonds right now. In the future, if the price of the bonds are increasing, so what will happen? You will be able to sell the bonds at a higher price. So you got them at a lower price. You are selling them at a higher price. What is that resulting in? It is resulting in a capital gain for you. It is resulting in a capital gain for you, right? So rate of interest and the demand for money are inversely related. Rate of interest and market price of the bond are inversely related. That is what I have told you. Your rate of interest and price of the bond are inversely related. Your rate of interest and the demand for money is also inversely related. Example, if the current rate of interest is greater than the critical rate of interest. So right now, whatever interest rate is prevailing in the market, it is greater than the critical rate of interest. So what is the critical rate of interest? The rate you are expecting will, persist in the future. The rate that you are expecting will persist in the future. So what will happen as the current rate is greater than the critical rate, the interest rates will fall. Investors will expect the interest rates to fall. And whenever interest rate is decreasing, what will happen to the bond price? What will happen to the bond price? They will increase. Whenever interest rates decrease, bond price in the future, they will increase, right? So what will happen? You will actually get a capital gain. So whenever in the future bond prices will increase, what will you get? You will get a capital gain, right? Yes. Next, holding of wealth holder in this asset portfolio. If the current rate of interest, which is your RN, your current rate of interest is denoted by RN, is greater than the normal or the critical rate of interest, is greater than the normal or critical rate of interest. So what will happen? You will actually go for government bonds. If the current rate of interest is less than the critical rate of interest, you will hold the cash. So what is happening here? For example, your current rate of interest is less than the critical rate of interest. So you are expecting the interest rate to rise. You are expecting the interest rates to rise, right? So when you're expecting the interest rates to rise, what will happen to the bond prices? They will decrease. When the bond prices will decrease, what will happen to you? You will incur a capital loss. When the bond prices are decreasing, you will incur something called as the capital loss, right? So whenever you are incurring something called as capital loss, it is better that you don't hold in the form of bonds, but rather you hold in the form of what? Cash. You rather hold in the form of cash. And for example, if the prevailing rate of interest is equal to the critical rate of interest, you actually, either you hold cash or bonds. Okay. So it depends on your risk appetite. Like if you're a risk averse person, you may hold it in the form of cash. If you're a risky person or a risk lover, you will actually, take your portfolio to be, holding in the form of bonds, right? So we'll just revise this thing again for you. So what did I tell here? So as you can see, there exists, I'll do it in this graph only. As you can see, there exists an inverse relationship between the rate of interest and the speculative demand for money. So what is happening? If the rate of interest is increasing, the speculative demand for money is decreasing because people are holding lesser and lesser amount of cash with them right now. So why is the speculative demand for money decreasing if the rate of interest is increasing? The opportunity cost of you holding money with yourself is increasing because outside the rate of interest is increasing, right? So what use is it if you hold money with yourself? So as the opportunity cost is increasing, the speculative demand for money will also decrease. Clear, everybody? And now if the rate of interest is increasing, and for example, this is your critical rate of interest. This is your critical rate of interest. That is your prevailing rate of interest. Prevailing rate of interest is RN, right? Your prevailing rate of interest is RN. If your prevailing rate of interest is greater than the critical rate of interest, that is your prevailing rate of interest is greater than the critical rate of interest. So you are expecting that your rate of interest, that is the prevailing rate, will reach the critical rate, right? So when the prevailing rate of interest will reach the critical rate of interest, you will see a fall in the rate of interest, the prevailing rate of interest. So what will happen to the bond prices? They will increase. What will happen to the bond prices? They will increase. So whenever there is an increase in the bond prices, what will you see? You will see capital gain, right? So in the future, as you are able to sell the bonds at a higher price, you are going to hold lesser amount of money right now and you are going to invest in the bonds. You are going to invest in the bonds. Okay, that is the reasoning. Now let us understand another concept called as liquidity trap, which is given by John Maynard Keynes. Okay. So So for example, in liquidity trap, your graph completely becomes horizontal. Okay. Here, there you see an inverse relationship between your rate of interest and speculative demand for money, right? But in this region, you see that the graph has become completely horizontal. That is, in the liquidity trap situation, what happens is, when the rate of interest falls very, very low, when the rate of interest falls very, very low, people expect that this rate of interest will not fall beyond this level. Okay. So what happened right now was the rate of interest fell so low, and people expect that the rate of interest will not fall beyond this level, and in the future it will only increase. They will expect that in the future it will only increase. So in the future, if they expect the rate of interest to increase, what will happen to the bond prices, students? They will decrease. So what will happen if you hold bonds right now? You will incur a capital loss, because in the future you can incur a capital loss. You feel that it is better to hold the cash with yourself. You feel it better to hold the cash with yourself, and all the money is trapped in the hands of people. All the money is trapped in the hands of people. This situation is called as liquidity trap. And Keynes states that whenever there is a situation of liquidity trap, monetary policy is ineffective and fiscal policy is effective. So Keynes states that whenever you are in a situation of liquidity trap, your monetary policy becomes ineffective and it is your fiscal policy that has to come into action. Right? So let us see what is liquidity trap. It is a situation in which the current rate of interest are so low and the saving rates are high, rendering the monetary policy ineffective. In liquidity trap, consumers choose to avoid bonds, keep their funds in savings with an expectation of rise in the interest rates in the near future. So students, whenever you are expecting the interest rates to rise, what will happen to the bond prices? They will fall. And whenever bond prices will fall, you will incur something called as capital loss. For that very reason, you are not willing to hold bonds, but rather you are willing to hold cash, right? It is a situation in which investors would maintain cash savings rather than hold bonds. The speculative demand becomes perfectly elastic. I told you, right? Your graph will become parallel to x-axis or it will become horizontal with respect to the interest rates, and the speculative demand curve becomes parallel to x-axis. And this, whatever region has become horizontal or parallel to x-axis, that is referred to as your liquidity trap. So I hope I have made myself clear with your liquidity trap, and also we have made clear, you have achieved some clarity with regard to your rate of interest, your bond prices, and what will happen if your normal rate of interest is greater than critical rate of interest. What will happen if your critical rate of interest is less than your normal rate of interest. So students, what you do is try to revise these things, okay? It is just simple logic that you have to remember. If you remember that logic, things will get very, very easy. Okay, students, so let us continue our discussion with speculative demand for money. So Keynes stated that there is an inverse relationship between the speculative demand for money and rate of interest. So if we draw the graph for that, so you will be plotting your rate of interest on y-axis and the speculative demand for money on x-axis, right? So if you draw the graph for it, so how will it be? It will be downward sloping, projecting an inverse relationship between rate of interest and the speculative demand for money. Okay. Now let us understand few other concepts. Here we will be understanding what is the relationship between bond price and bond yield. See, bond yield is nothing but what is the rate of interest that you are earning on the bonds, right? So there is an inverse relationship between bond price and bond yield. That is, if bond prices are increasing, then the rate of interest decreases, and if prices are decreasing, that is bond prices are decreasing, then the rate of interest will increase. Clear, everybody? So what is the relationship between bond price and bond yield? There is an inverse relationship between bond price and bond yield, right? So for example, you are at this particular rate of interest, okay? You are at R. And this is the speculative demand for money, okay? R is the rate of interest, that is prevailing rate of interest, and DD is the speculative demand for money. So what do you see here? For example, you have to learn another concept called as critical rate of interest. Let us denote it with RC. What is this? Critical rate of interest. And RN, let us denote this with RN. RN is the prevailing rate of interest, okay? So right now RN is the prevailing rate of interest and RC is the critical rate of interest. So what do you mean by critical rate of interest? It is the rate of interest that you are expecting to have, that you are expecting to prevail. It is the rate of interest that you are expecting to prevail, or it is the expected rate of interest. It is the expected rate of interest. Okay. For example, you are expecting the rate of interest to increase. Right now you are at RN and you are expecting the rate of interest to increase. Okay, that indicates that your normal rate, or rather the prevailing rate of interest, is less than the critical rate of interest. So there is an expectation for the rate of interest to increase, right? So when rate of interest is going to increase, what will happen to the bond prices? They will decrease. What will happen to the bond prices? They will decrease, right? So when bond prices decrease, what does this result in? It results in capital loss. What does this result in? It results in capital loss. So people will not wish to hold bonds because that will result in a capital loss, and they will demand more money. Clear, everybody? So the speculative demand for money will increase, right? For example, if the normal rate of interest is greater than the critical rate of interest. So sorry, I'll write it in the superscript. For example, if the normal rate of interest is greater than the critical rate of interest, that is, people are expecting the rate of interest to decrease. People are expecting the rate of interest to decrease. So if people are expecting the rate of interest to decrease, what will happen to the bond prices? That will increase. So what will happen to the bond prices? It will increase. So when bond prices will increase, that will result in a capital gain. That will result in a capital gain. So people will demand less amount of money and invest more in the bonds. So people will demand less amount of money and more amount of bonds. So they will say that if I invest in bonds in the future, there is a possibility for me to get a capital gain. So this is your normal rate of interest or the prevailing rate of interest, and this is your critical rate. For example, this is your critical rate or your expected rate, right? So right now this is the rate of interest and this is the demand for money or the speculative demand for money. As you can see here, the rate of interest that is prevailing is greater than the critical rate of interest, is greater than the critical rate of interest. So eventually this rate will reach the critical rate of interest. So what will happen to the rate of interest? It will decrease. What will happen to the bond prices? They will increase. So that is why people are holding lesser amount of money right now and investing more in the bonds, because in the future they will be getting capital gain. In the future they will be getting capital gain. So Keynes has also talked about some other concept called as liquidity trap. So what Keynes stated was, if the interest rate is falling beyond a certain level, if the interest rate is falling beyond a certain level, what will happen? People will expect that the interest rate will not go beyond this level. Okay, it will further increase. For example, the interest rates are here right now. Okay, so people are thinking that already the interest rates have reached so low, so there is no possibility that the interest rate will fall below this level. So they will only expect the interest rates to rise. So when the interest rates, that is, they are expecting the interest rates to rise, so what will happen to the bond prices? They will fall. See, the key to this concept is that you remembering that there is an inverse relationship between bond price and rate of interest, right? So what are the people expecting? They are expecting the interest rate to rise. So what will happen to the bond prices? They will fall. So for example, if you are purchasing bonds right now, in the future, if the bond prices fall, you will be selling your bonds at a lesser price, which will result in a capital loss. Which will result in what? It will result in a capital loss. So what people will think is, me investing in bonds is not a very good idea. Let me hold the money with me. Let me hold the money with me. So what will happen? It will result in a liquidity trap. Liquidity trap is a situation where people are holding the money to themselves rather than investing in the bonds because they are expecting the rate of interest to increase. So what Keynes stated was, the money supply is ineffective when the economy lands up in a situation called as liquidity trap, and it is only the fiscal policy that can save the economy. It is only what? It is only the fiscal policy that can save the economy, right? So this was the concept that I was wanting to talk to you. So let us proceed to the next one. So we just completed your liquidity trap. Now let us proceed to something called as inventory approach to transaction balances, the real cash balance. This was given by Bamul. Okay. So what you have to remember here is, there is a square root formula you have to remember. You have to remember the relationship between the variables, and that will do the job for you. So let us start the topic. So inventory approach to transaction balances. Bamul, Tobin developed a deterministic theory of transaction demand for money known as inventory theoretic approach. So this theoretic approach was developed by Baumol and Taubin, right? So money is demanded for. So why are you demanding money at the first place? For transaction purposes, right? You have some day-to-day transactions to be held. So for that very reason, you will demand money. So transaction purposes, money or real cash balance is viewed as inventory held for transaction purposes. So how did Baumol view money here? He viewed money as inventory, and Baumol always stated that your money has to be maintained at the optimum level, because whenever you are having more amount of money, that indicates that you're incurring an opportunity cost. What is your opportunity cost? See, rather than you holding the money, if you had invested the money elsewhere, you could have earned a rate of interest, right? So interest is your opportunity cost. So it is very, very important that you maintain an optimum cash balance, right? Next, real cash balance. Real cash balances are the money of some base year purchasing power. So what is real cash balance telling you? It is talking about the purchasing power, okay, adjusted for inflation. So assumptions of Baumol's theory are, see, there are two media for storing value. See, here rather than transaction motive, he has also talked about something called as store of value. Your money is not only acting as a medium of exchange, but it is also acting as a store of value. Yes, so money is witnessed as a store of value and is also interest bearing financial assets. So they also viewed money as a store of value and also interest bearing alternative financial assets, right? Next, so what do you mean by interest bearing alternative financial asset? See, when you deposit money in your banks, like in the form of you're maintaining a savings account, you will be earning some minimal rate of interest rate. So it is also an interest bearing alternative financial asset as well. So application of Baumol's theory in terms of brokerage fee. See, we will come back to this, but what we will do right now is we will see the formula, the square root formula that I was talking about. So C is equal to square root of 2by by r. So what do you mean by C? C is nothing but cash withdrawal. So the amount of cash withdrawal depends on the brokerage fee. B indicates brokerage fee, Y indicates the level of income, and R indicates the rate of interest. So what is the formula here? C is equal to square root of 2by by r. Okay, your cash withdrawal and the rate of interest are inversely related. What is the relationship between your cash withdrawal and the rate of interest? They are inversely related. That is, if the rate of interest is increasing, your cash withdrawal will decrease, because you having more amount of cash balances with you will actually increase your opportunity cost. How is your opportunity cost increasing? See, outside the rate of interest is increasing. So if you put the money balances in some financial instruments, you will be getting the rate of interest. But if you maintain the money balances with yourself, that kind of acts as a disincentive for you and it increases your opportunity cost. So what is the relationship between cash withdrawal and rate of interest? It is inverse. So cash withdrawal will decrease if the rate of interest will increase. Now what is B? Brokerage fee. People, you have to convert your money balances into bonds. You have to convert your money balances into bonds or some financial assets. You kind of incur some expenditure called as brokerage fee. So for example, if the brokerage fee is really, really high, that is the conversion cost that of your money to a financial asset is really, really high, then what will you do? You will actually increase your cash withdrawal. That is, if brokerage fee is increasing, you are not feeling that it is an incentive, because you are actually incurring more amount of cost. So you feel like maintaining the cash balances with yourself, right? So cash withdrawals increase, brokerage fee increase. So they both have a direct relationship. And when the income increase, your transaction demand for money will also increase. So what will happen to the cash withdrawal? That will increase. So if you have to analyze your formula, you share an inverse relationship between cash withdrawal and the rate of interest. There is a direct relationship between cash withdrawal and the brokerage fee. There is a direct relationship between cash withdrawal and the level of income. This is your square root formula. Now let us see what they have to tell you. So application of Baumol's theory in terms of brokerage fee. There is a fixed cost of making transfers between money and alternative assets. So what is the fee that you are going to incur for transforming your money into a financial asset? It is your brokerage fee, right? Bonds offer return. What is the rate of return that bonds are offering you? It is your rate of interest. But include the transaction cost while converting the money into bonds. Yes, when you maintain bonds, they surely will give you a rate of return, which is your rate of interest. But while you're converting your money into bonds, you're incurring some transaction cost, which is called your brokerage fee, which has to be taken into consideration while you're making some decisions. So demand for money and bonds depends on cost of transferring money into bonds. So how much of cash withdrawal are you going to make? Depends on what? It depends on the brokerage fee. That is the reason I told you that your cash withdrawal and your brokerage fee share a direct relation. Your cash withdrawal and your brokerage fee have a direct relationship. So effect of brokerage fee. If brokerage fee is increasing, so what is happening here? Your conversion cost is increasing. So what is happening? Your transaction cost is increasing. Number of transactions decrease. See people, whenever the transaction cost is increasing, what will happen to the number of transactions? That is, your willingness to convert your money into bonds is going to decrease. So average bond holding will decrease. So what will happen to the transaction demand for money? It will increase. That is your cash withdrawal will increase. That is the transaction demand for money will increase rather than you investing in bonds. Next, application of Baumol's theory in terms of rate of interest in inventory management. So individuals keep optimum inventory of money for their day-to-day transaction purposes. They see, when you are actually running a business or you being an individual, you need to maintain an optimum level of inventory. Here I am talking about the optimum level of money balances. Okay, you cannot actually maintain a very low balance or a very high balance. Maintaining a very high balance, you're kind of incurring something called as opportunity cost. That is, you're losing the rate of interest. If people hold inventories in the form of money, the cost foregone is the interest. That is what I was talking about. The opportunity cost that you are incurring by maintaining money balances is nothing but the rate of interest. Investment in bonds or shares provides returns. So risky and involves capital loss. See, whenever you are holding bonds, whenever you are holding these bonds, there is some sort of risk involved in it, right? See, the bond prices may increase or the bond prices may decrease. So if the bond prices are increasing after the purchase, you will incur something called as capital gain. If the bond prices are falling, you will encounter something called as capital loss. So there is some sort of risk involved in it, right? Next, holding money, currency and demand deposits. So how can you hold money? You can hold it in the form of currency, or also you can maintain it in the form of demand deposits. That is the reason I told you, right? Money is an alternative financial assets, because when you are maintaining these demand deposits, when you are maintaining the money with the banks, you are given some minimal rate of interest, right? Very safe and riskless, but gives no interest. But what Baumol has taken here is that he has taken this assumption that if you are maintaining in terms of demand deposits, money is not going to give you any return. If you maintain some saving account or something like that with a fixed lock-in period, then you will be getting rate of interest. But when you are maintaining demand deposits, you are not given any rate of interest. Savings deposits in the banks, safe and risk-free, gives some interest. That is what I was talking about. So whenever you maintain savings deposits, that these deposits are kind of, you cannot withdraw whenever you want. They are not highly liquid. When compared to demand deposits, they are less liquid. So you are given some, compensatory rate of interest. So what is here? It is safe, but it is also risk-free, right? So, but bonds are actually risky, but the return is good. And, the fluctuations in the bond prices will actually cause the capital loss or capital gain. Next, the square root rule. Transactions demand for money depends on rate of interest. So, if the rate of interest on savings deposit increase, people will hold less money. See, the amount of cash that you hold depends on the rate of interest. So if the rate of interest is increasing, your opportunity cost is increasing. So people will hold lesser amount of money. Baumol proved that the average amount of cash withdrawal, which minimizes the cost, is the square root of 2 times of brokerage fee multiplied by the size of an individual's income and divided by the rate of interest. So this is the formula that we already explained. So it is nothing but square root of 2by by r. R and C have an inverse relation. B and C have a direct relation. Y and C also have a direct relation. Yes. So I hope that you all understood this Baumol's theory. Let us proceed with the Friedman's restatement of quantity theory of money. Okay. So Friedman has told few additional points. One important point is that he considered money as an alternative financial asset. He said that, see, money is a good that is giving you return. But what Baumol others have thought was money is not giving you any sort of return, but money in itself gives you return, is something said by Milton Friedman. Okay, let us see the points, whatever he said. Friedman extended Keynes' speculative demand for money in terms of asset price theory. Money is a good as any other durable consumption good. So money is considered to be a good according to Milton Friedman. So what are the determinants of demand for money? See, your demand for money depends on other financial assets, like what is the return that you're getting on equity, what is the return that you're getting on bonds, what is the, how much of human capital, how much of wealth that you're having. So all these factors are also taken into consideration while we are assessing the demand for money. And one most important thing in Milton Friedman case was he took the permanent income. That is, see, whatever future income that you're going to get, this Milton Friedman, what he did was he discounted that and brought it to the present value. Okay. So whatever future income that you're going to get, whatever wealth that you're having, everything is taken into consideration. He did not take any windfall gains while calculating this permanent income. Only that income which is, certain, that is taken to assess the demand for money. So total wealth is equal to, permanent income. It represents the present expected value of all the future income. So future value are brought to the present value. For bringing that, you have to discount the future value, right? Permanent income is the function of total wealth, and total wealth is permanent income by discount rate, right? So the nominal demand for money is the average return on 5 asset classes. So namely money, bonds, equity, physical capital, human capital. So these are the things that determine the demand for money. People, let me also give you some additional information. Milton Friedman stated that whenever you are having more amount of human capital when compared to physical capital, that is, you're very young and you don't have much amount of wealth, your idea will always be to accumulate wealth, right? So whenever human capital is more, your idea of savings will be also more. Okay. So the money demand will actually decrease. So nominal demand for money is positively related to price level, because whenever the prices are increasing, the transaction demand for money will also increase, right? Next, nominal demand for money is inversely related to rate of interest. See, whenever rate of interest is increasing, your opportunity cost of holding the money will increase. So to reduce the opportunity cost, you hold lesser and lesser amount of money. A positive inflation rate. See, what will happen if there is inflation in the economy? If you are having money balances with you, the value of the money will kind of decrease if there is a positive inflation rate. So it is better that you convert this money into some asset before it loses even more value, right? So what will happen to the demand for money? It will decrease, because whenever there is a positive inflation rate, your opportunity cost of holding the money will increase, because your money is actually losing value day by day. Your money is losing value day by day. So that is the reason. So this is your Milton Friedman. The last thing that we are left with is your Tobin. See, Tobin is very, very simple actually. Keynes stated that you either hold money or you either hold bonds. Keynes stated that you either hold money or you either hold bonds. But Tobin came and said, Keynes, how it is not possible. People in real world maintain a portfolio. People in real world have a portfolio. That is, they have both cash and bonds in their portfolio. They maintain a combination of assets. It is not the extreme cases like either they have that or this. It is not that. So that was told by Tobin. So demand for money as a behavior towards risk. So propounded by James Tobin, an American economist. So money is demanded for what? Speculatory motive. Money is demanded for speculatory motive. That is, to take advantage of the changes in the interest rates and the prices, you kind of maintain some amount of money. And what is the assumption that we are taking here? People prefer more wealth to less. So people are always wanting more amount of wealth. So individual's behavior is risk aversion. What do you mean by risk aversion? You prefer lesser risk when compared to more risk. See, there are three types of behaviors. One is risk lover, risk neutral, risk averse. Risk averse people do not want to take any sort of risk. Risk neutral is they prefer some risk and some no risk scenario. But risk lover people, they always try to have more amount of risk in their portfolio, right? So I told you, right, either you hold cash or bonds, that is told by Keynes, but Tobin stated that you hold both cash and bonds. But in your portfolio, if you are holding more amount of bonds which are very risky, that indicates that you are a risk lover. But if you are holding equal proportion of bond and cash, it means that you are risk neutral. But you are holding less amount of bonds when compared to cash, it indicates that you are a risk averse person. Individuals diversify their portfolio by holding a balanced combination of safe and risky assets for a little different balance between risk and return. If individual chooses more proportion of bonds in his portfolio, high return and high risk, but a risk averter will not choose such portfolio. So when you are a risk lover, you choose more amount of bonds, but when you are a risk averse person, you choose lesser amount of bonds. So if the individual chooses to hold only money or as demand deposits, safe and riskless assets. So you are actually a risk averse person. You don't want to take any sort of risk. You don't want to take any sort of risk, but your return is zero. Because demand deposits and cash, they don't give you any sort of return, right? Next, Tobin's liquidity preference function. In an individual's portfolio, inverse relationship between rate of interest and demand for money. So why is there an inverse relationship between rate of interest and demand for money? See, if the rate of interest is increasing, what will happen to the opportunity cost? That will also increase. So what will happen to the demand for money? It will decrease, right? So liquidity preference function will slope downwards. Just like your Keynes stated, there is an inverse relationship between rate of interest and speculative demand for money. Next, asset demand for money in the portfolio increases as the rate of interest on bonds falls. So if the rate of interest on bond is falling, the rate of return that bonds are giving you is falling, your demand for money will increase, right? Next, it measures the interest elasticity of demand for money as an asset. So what are we doing here? We are checking the sensitivity of the, like, how are you responding when the rate of interest on bonds is changing? How is your demand for money responding? So like to take the sarams of this entire thing, or to take the conclusion, it is nothing but there is an inverse relationship between your price and your speculative demand for money, right? So these are your formula. We'll just go through the formula which you have to remember, okay? So because for you to solve the bits, you require them. So Irving Fisher's, what was his approach? He gave the quantity theory of money. What was the equation that Irving Fisher has given you? It is MV is equal to PT. Okay, there is another extended equation that he has given, which is MV plus M dash V dash is equal to PT. Okay, so MV plus M dash V dash is the supply of money. PT is the demand for money. So whenever you are in equilibrium, your money demand is equal to money supply. And what was the Cambridge approach equation? Money demand is equal to K times PY. K is the proportion of money you are holding for the transaction purpose, right? But Cambridge people also talked about another function of money called as store of value. But your Irving Fisher only focused on medium of exchange. Cambridge economists also considered store of value. And what is your Keynes liquidity preference theory? He's talked about three motives: speculative motive, transactionary motive, precautionary motive. Your precautionary motive and your transactionary motive depends on the income. They are a function of income, but your speculative demand for money is a function of rate of interest. And Baumol's square root rule, which we have just discussed, which is C is equal to square root of 2by by R. Right, everybody? So these were the few things I wanted to discuss with you. So what we will do now is we will try to solve some bits so that we can enhance your conceptual clarity. Okay, students, so what we will do right now is we'll discuss some bits. So I'll give you some time to read the question, or it is better that you pause the video and go through the question and give the answer. Okay. So what is the first question here? They are asking you to choose the incorrect statement. Okay. So anything that would act as a medium of exchange is called as money. Let us put it on hold. Let us read all the statements. Money has generalized purchasing power and is generally acceptable in settlement of all transactions. So money acts as a medium of exchange. So it is used in the settlement of transactions. Yes. Money is a totally liquid asset. We told you, right? Money is the most liquid asset because it can be used in the performance of, transactions. Currency which represents money does not necessarily have intrinsic value. People, you have two types of value. One is the face value, the other is the intrinsic value. The real value is considered to be intrinsic value, and whatever is, there on the face is considered to be the face value. Okay, you might be feeling a bit confusing. So if I take your 100 rupee note, on your 100 rupee note, it is written 100 rupees, right? 100 rupees is the face value, like whatever is there on the face. So that is your face value. But to make that 100 rupees, whatever that you have incurred, the cost of production of that 100 rupees, your intrinsic value. Sometimes you might have just increased some 4 rupees to make that 100 rupee, but your intrinsic value is actually not equal to the face value. So that is true, right? So if you see your option A, anything that would act as medium of exchange is money. See, there are three functions that a money has to fulfill, okay? It must act as standard of deferred payments, store of value, medium of exchange. Just because it is medium of exchange, you cannot say that anything that would act as medium of exchange is called money. No. So option A is incorrect statement. So for something to be called as money, it must fulfill all the three aspects, right? Next. Money performs all the three functions. So for anything to be called as money, it must perform three functions, right? Medium of exchange, store of value, unit of account. See, your prices, whatever you're paying for goods and services, they are always expressed in terms of money. So let us see where the three options are: medium of exchange, unit of account, and store of value. So it is option C, right? The next one, demand for money is what? It is a derived demand. What do you mean by derived demand? See, there is some reason why you are demanding money, right? For transactionary motive, for precautionary motive, you are demanding money. So there is a reason behind it. So that is the reason it is called as derived demand. Next, what do you mean by real money? Anything that you adjust for inflation that will become real. Okay, so it is nominal money adjusted to the price level. So it is nominal money adjusted to the price level. This is your real money. Okay, next. Higher the dash, higher would be the dash of holding the cash and lower would be the dash. So what is this? Higher the demand for money. Okay. Excuse me. Higher the demand for money, higher would be the opportunity cost of holding cash and lower will be the interest rate. Okay. Higher the Okay, I think it is this. Higher the interest rate, higher would be the opportunity cost of holding cash and lower will be the demand for money. See, whenever the rate of interest is higher, what will happen to the opportunity cost? It will increase. So, higher the interest rate, higher will be the opportunity cost. Therefore, lower will be the demand for money. So, what is the right option? It is option D. Okay. So, what is the next one? The precautionary money balances people want to hold. So, what is this? As income elastic and not very sensitive to the rate of interest, as income inelastic and very sensitive to the rate of interest people, precautionary demand for money is a function of income, not rate of interest. It is a speculative demand for money that is a function of rate of interest. So this is wrong. Determined primarily by the level of transactions. No, this is transaction demand. Are determined primarily by the current level of transactions. No. So it is option A. Are income elastic and not very sensitive to the rate of interest. So it is option A. Next, speculative demand for money. So I told you already that the rate of interest and speculative demand for money are inversely related. That is, when rate of interest increases, the speculative demand for money decreases. So is negatively related to the rate of interest. Next, according to Keynes, if the current rate of interest is high, if the current rate of interest is high, if the people are expecting the rate of interest to fall, so in the future, if the rate of interest will fall, what will happen to the bond prices, everybody? They will rise. And what will you get by that? You will get something called as capital gain, right? So what will be the option? People will demand more money because the capital gain on bonds would be less. No. That is not the right answer. People expect the rate of interest to rise and the bond price to fall in the future. Okay. Okay. So already the rate of interest is high, no? People may expect the rate of interest to fall and the bond price to rise in the future. So it is option C. Already the rate of interest is high, right? So what will people expect? They will expect the rate of interest to fall. So what will happen to the bond price? It will rise. And what will you get? You will get a capital gain. Next, according to Bamul and Tobin approach, the demand for money, the optimum. So what you have to see is, you have to see the formula here. 2by by R. So you have to see this formula and you have to answer this question. So this and this, cash withdrawal and the rate of interest have an inverse relation. Cash withdrawal and the brokerage fee have a direct relation. Cash withdrawal and level of income also have a direct relation. So a positive function of income Y and price level P, a positive function of the transaction cost, a negative function of the nominal rate of interest. So all of the above, all the options are correct. So it is all of the above. Next, in the equation mv is equal to py, what does v represent? It represents the velocity of circulation of money. Next, Fisher's equation of exchange states that, see, what did Irving Fisher state? There is a direct relationship between the money supply and the prices. What did Irving Fisher state? He stated that there is a direct relationship between money supply and the prices. So keeping the transactions and the velocity to be constant in the short run. So P varies directly with M. Next, the price of bonds is dash related to the rate of interest. Obviously, they are inversely related to the rate of interest. So, price of the bonds and the rate of interest are inversely related, right? So, this is the answer. So, I hope that you got some conceptual clarity with regard to the concept of money demand. You enjoyed the session. So, what we will be doing is, we will meet you in the next session, that is with the concepts of money supply. Thank you, students. Happy learning. Hello students, welcome back to another session of Economics for Finance. So in this session, we'll be discussing the chapter Monetary Policy. Like all the other chapters, we are going to complete this chapter in a span of 1 hour or 1.5 hours so that you will be able to answer all the questions asked, right? So let us jump into the chapter. So let us understand first what is the meaning of monetary policy. So what is the meaning of monetary policy? Monetary policy refers to the use, monetary policy, just give me a moment. Monetary policy refers to the use of monetary policy instruments by the central bank to regulate the availability, cost and use of money, credit to promote the economic growth. People just listen to me carefully. Who is the Central Bank of India? It is Reserve Bank of India. So at Reserve Bank of India's consideration, you have got large number of instruments which the RBI uses to regulate the money supply and to, control the economic activity or control the inflation in the economy. So those instruments are categorized into qualitative instruments and quantitative instruments, which you will be learning in this particular chapter, right? Next, so how do you regulate the cost of money? See, whenever you are increasing the supply of money, you see a fall in the rate of interest. So the cost of borrowing for the people will decrease and more people will be willing to borrow the money and the economic activity will kind of increase, right? So there are two types of monetary policy an RBI can adopt, that is our central bank, which is expansionary monetary policy and contractionary monetary policy. The meaning of expansionary monetary policy is the RBI is trying to reduce the money supply. The meaning of contractionary monetary policy is reducing money supply. The meaning of expansionary monetary policy is increasing the money supply. So what is it, students? Expansionary monetary policy is increase in money supply. Contractionary monetary policy is decrease in the money supply. Right, everybody? Next. Let us understand the monetary policy framework. So it has got three basic components. One is the objectives of monetary policy. See, our objective is what? The objective of the Reserve Bank of India is inflation targeting. That is to put the inflation or to maintain the inflation rate between 2% to 6%. And the average rate of inflation that must prevail in the economy is about 4%. So every central bank has got some objectives that it works on, right? Now, what is the second point? It is the transmission mechanisms of monetary policy. What is it? Transmission mechanisms of monetary policy. See, whatever decisions the central bank is taking, how are they being transmitted to the grassroots level? So, you have got the commercial banks in between who are acting. So, what are the different transmission mechanisms that are used to pass on the monetary policy initiatives taken by the central bank to the grassroots level? Next, what operating procedure? See, operating procedure is nothing but day-to-day activity to meet these targets. Whatever the targets have been set by the central bank, if you have to meet them, what are the day-to-day activities that you are performing is nothing but your operating procedure. So what are operating procedures, students? They are the day-to-day activities performed to achieve the monetary objectives, right? So let us understand what are the objectives of monetary policy. So what we are going to do in this chapter is, we are going to see all these three things. We are going to see all these three things. That is the objectives of the monetary policy, the transmission mechanism and the operating procedure. Fine. So let us start with the objectives of monetary policy. So what is the primary objective of monetary policy? It is maintenance of a judicious balance between price stability and economic growth. See, any central bank, or in our case, it is the Reserve Bank of India, right? So the objective is maintaining a stable growth and maintaining stability in the prices. That is, inflation has to be moderate, right? Next, what else? What are the explicit objectives of monetary policy of a developing economy? So what are the explicit objectives? See, our main objective is focusing on price stability. Like I have always told you that inflation targeting is the main objective of your Reserve Bank of India. And what is the target? What is the band that we have given? It is 2% to 6%. What is the average? It is 4%. So there are also other objectives which the RBI has to achieve, which are maintenance of the economic growth, ensuring an adequate flow of credit to the productive sectors. See, whose responsibility is it that credit flow is ample in the economy? It is the responsibility of Reserve Bank of India. Next, sustaining a moderate structure of interest rate to encourage the investments. So it is the responsibility of Reserve Bank of India again to encourage investments in the economy, and for investments to be encouraged, or rather if investments have to be pushed up, it is the interest rate that they have to maintain, so that investments are kind of ample in the economy and the economy sees a rise in the economic activity. And who actually can change the interest rates? It is the Reserve Bank of India. How can they change the interest rate? Through their monetary policy initiatives. Next, creation of an efficient market for government securities. See, the purchase and sale of government bonds is taken care by the Reserve Bank of India. You people might have heard of the terms called treasury bills, government bonds, or government securities, right? So whenever you're hearing the term treasury bills, it indicates that they are issued for a period that is less than 1 year. Treasury bills are short term in nature. Government bonds or government securities are long term in nature. Clear, everybody? So less than 1 year is short term, more than 1 year is long term. So what are these government bonds? See, it is not always that the revenue is greater than the expenditure. Most of the cases, or rather can I say in almost all the cases, the government expenditure will always be greater than government revenue. So to meet that deficit gap, the government kind of borrows money and it uses an instrument called as government bonds. Okay. And the sale and purchase of government bonds has to be taken care by the Reserve Bank of India. See, like it is the banker of the government, right? So all the activities of the government have to be taken care by the Reserve Bank of India, right? Next, so what are the other objectives of the Reserve Bank of India? Can you please revise? Or rather, any central bank of a country, they must maintain stable economic growth. Stability in prices is the primary objective. So they have to maintain moderate inflation. And what is our objective? Inflation targeting, right? So what are the other objectives? Ample, money supply has to be created. Ample credit has to be created so that investments are encouraged. And the government securities are also dealt by the Reserve Bank of India. That is, the sale and purchase of government securities are also dealt by the Reserve Bank of India. Next, what are the objectives of monetary policy of India? That is RBI Act 1934. You know, the Reserve Bank of India has been established under the RBI Act 1934, right? So what are the aims of your Reserve Bank of India? See, any institution, if it is established, it is established for a particular purpose. So what is the purpose of our Reserve Bank of India? That is to regulate an issue of banknotes. See, the authority to print and issue currency is with the Reserve Bank of India. Barring 1 rupee coins and 1 rupee notes, which is handled by the government of India, the remaining is taken care by the Reserve Bank of India. Maintaining reserves to secure monetary stability. So what is this? India follows minimum reserve system. That is, whenever RBI is having a reserves which are worth 200 crores, of which some portion has to be maintained in terms of gold and in terms of foreign currency. If you are maintaining this minimum reserve, you are able to print unlimited currency. Okay, you are getting the eligibility to print unlimited currency. For example, you want to print 1 crore rupees. The RBI wants to print 1 crore rupees. So the basic thing that it has to fulfill is it needs to have a minimum reserve of 200 crores. And I'm talking about this 200 crores should comprise of gold and foreign currency, right? And the prices are 1962 prices. Okay, this 200 crores, I'm talking in terms of 1962 prices, because it is from 1962 that we started following this minimum reserve system. Now for printing 1 crore, the basic condition that you need to fulfill is you need to maintain a minimum reserve of 200 crores. This has given you the eligibility to print your unlimited currency. Now to print or to release this 1 crore, you need to print double the amount. That is, you need to print 2 crores. In that, 1 crore can be issued and the remaining 1 crore has to be maintained in terms of foreign currency reserves. That is, this 1 crore is backed by foreign currency reserves, which has to be maintained by the Reserve Bank of India. Next, that is the thing that they are saying here. So why do you do this? This is done to attain stability, right? So that your currency will hold some value. Next, to operate the currency and credit system of the country to its advantage. So who regulates the money supply in the economy? It's the Reserve Bank of India. So money supply can control the rate of interest, and rate of interest determines the demand for credit and supply of credit. So this is how your RBI is trying to influence the economic activity through their monetary policy. And there are two types of monetary policy like we have discussed earlier. There is expansionary monetary policy and there is contractionary monetary policy. During times of inflation or rising price level, the RBI resorts to contractionary monetary policy. During recession, that is falling economic activity, the RBI resorts to expansionary monetary policy. Now, let us discuss the second step, which is the transmission mechanism of the monetary policy, right? So what is this monetary transmission mechanism? What is the meaning of monetary transmission mechanism? It is nothing but the channels through which the monetary aggregates affect the aggregate output, employment, price level. See people, RBI is kind of controlling the monetary policy. What is the goal of the RBI? Through monetary policy, it wants to influence your aggregate output, level of employment and price level. And to influence these three things, in between there are few institutions that are helping RBI to achieve their targets. So that is nothing but monetary transmission mechanism. Now, transmission of monetary policy, it can be summarized in two stages. What are those two stages? They are changes to monetary policy affect the interest rates in the economy. That is what I am telling you. If you go for an expansionary monetary policy, the RBI is kind of increasing what in the economy? Money supply in the economy. Whenever there is an increase in the money supply, whenever money is easily available, the rate of interest will decrease, right? The rate of interest will decrease. And whenever the RBI follows contractionary monetary policy, that is, it sucks out additional money from the economy or excess money from the economy, money is not easily available for the people. So what will happen to the rate of interest? It will increase. So through monetary policy, your RBI is kind of influencing the interest rates. Next, change in the interest rate affect the economic activity and inflation. So how is change in the interest rate affecting economic activity and inflation? Let us take two examples here. See, what is the first thing that has happened? Through monetary policy, what has been affected? Interest rate. Now, interest rate is posing an impact on the economic activity and inflation. How is it posing an impact on these two things? Take investors for example. See, if anybody want to invest, they're not having their own funds, right? They will definitely borrow some money. And whenever you want people to borrow money, the rate of interest has to be low or high. It has to be low. So, whenever the rate of interest is low, more people borrow and more economic activity is generated, right? So, interest rate has an impact on the economic activity because based on the interest rate, people decide whether to borrow or not to borrow. Now, let us take households as an example. As the rate of interest is low, the households are borrowing more and demanding more goods and services. As they are demanding more goods and services, if supply is matching demand, that is all fine. If the demand is greater than supply, what do you see in the economy? You see inflation in the economy. What is the meaning of inflation? Inflation is nothing but rise in the general price level. What is the meaning of inflation? Rise in the general price level. I hope I made myself clear. So, monetary policy affected the interest rates. Interest rates affected your economic activity and inflation. Next. So, let us understand. This process is complex and uncertain in timing and size of the impact on economy is unpredictable. So, let us understand the different channels of monetary policy transmission. So, the first channel that you see here is the saving and investment channel. Saving and investment channel. Okay. So what is it happening here? If the interest rates on bank deposits are reduced by the central bank. See, what do you mean by bank deposits? People, rather than holding money with themselves, they are putting money in the banks, in the saving account, in FDs, vagera, vagera. The reason why they are putting money in their banks is nothing but because they are earning something called as rate of interest. So rate of interest is something that is motivating people to put their money with the banks, right? So what is happening if the rate of interest is reduced? If the rate of interest on deposits is reduced, people will lose the incentive to deposit the money. They will feel, Arey Baba, if it is there in the bank or there with me, what difference is it making? So what will happen to the savings? Household savings will decrease. When household savings are decreasing, that is more people are holding money with themselves. See, you will not hold the money for no reason, right? You will kind of demand goods and services. So what will happen to the household consumption? That will increase. When household consumption is increasing, what is happening? Economic activity is also increasing. So what is happening here? When the rate of interest has declined on the deposits, more people are not saving. So more people are holding the money with themselves. So what is happening to the spending? The spending is increasing and you see an increase in the economic activity. Clear everybody? Now, This is from whose side? This is from depositor side. Now let us talk from investor side. If the interest rates on loans reduced by the central bank. So if cost of borrowing, what is interest rate on loan? It is nothing but cost of borrowing. What is interest rate on loan? It is nothing but cost of borrowing. So if cost of borrowing is reduced, households will borrow more money. Investors will also borrow more money. See, when they are borrowing more money, what will happen to the economic activity? That will also increase, right? So let us see the point here. Low repayments make the households borrow. So when the rate of interest is decreasing, the cost of borrowing is decreasing. People feel like borrowing more amount of money. So demand for assets such as housing investments increase. See, I want to construct a house and I want to take a loan, housing loan. See, I will take a housing loan if the rate of interest is really, really less. That will actually, make me, feel like I want to build my house. So what will happen? The housing investment. See, households, in which areas do they invest? They go for residential investments. Household, where do they invest? They go for residential investment, right? So what happens to the residential investment? It will increase. Next, businesses. Low cost of borrowing make businesses to invest. If returns on these projects, see, whenever you are kind of investing somewhere, you analyze two things. One is, what is the cost of the project? What will be the return on the project? If the return on the project is more when compared to the cost on the project, you will definitely go ahead with the project, right? So what is happening here? If returns on these projects are greater than cost of borrowing, firms use debt rather than business owners' funds. So what will happen now? So if the cost of the borrowing is less than the return, for example, the cost of the borrowing is 8% and the project is giving you a return of 10%. You are making a profit of 2%. Would you borrow or would you not borrow? You will definitely borrow because you are on a profit side, right? Next. The next channel that you see here is cash flow channel. I hope you understood the saving and investment channel. So we actually spoke from depositor side. We actually spoke from lender side as well. So we actually spoke from depositors, that is who are depositing their money, and from the people who are borrowing the money. So whenever there is a fall in the interest rate, lesser people will save, and whenever there is a fall in the interest rate on loans, more people will borrow. So these are the two things that you need to remember. Now, cash flow channel, availability of cash with households and business. So income to households and businesses decrease. So what is happening here? If the rate of interest on bank deposits is reducing, I have put my money in the banks, right? I have deposited my money with the banks. So if the rate of interest is decreasing, the interest income that I am getting is decreasing or increasing? It is decreasing. When rate of interest is decreasing, households and business spending will decrease because the income that I am getting has fallen, no madam. See, whenever I am putting my money with the banks, I have deposited my money with the banks. The reason I deposit the money with the banks was I was getting some return. Now, when the rate of interest has fallen, what is happening to my interest income? That also decreased. When my interest income is decreasing, what will happen to my spending? That will also decrease. So this will result in a reduction in the economic activity. So do you see here what is happening? Here you saw an expansionary monetary policy. Here what are you seeing? You see a contractionary monetary policy. So these both are working in the opposite directions. These both are working in the opposite direction. They'll ask you in the exam. Like saving and investment channel, cash flow channel work in dash direction. They work in opposite direction. Because in saving and investment channel, you saw increase in spending. In cash flow channel, you saw decrease in spending. Next, if the rate of interest on loans is reduced, what will happen? Let us see. Interest payments on debt will increase. So what is happening here? Interest rates, if the interest rate on loans are reduced by the central bank, so interest payments on debt will increase. Cash availability with the households and businesses increase. Next, so this is not increase, it is actually decrease. Okay, so whenever your loan rate of interest on the loans has fallen, what will happen to the debt burden? That will decrease because you don't have to pay more interest payment right now because the rate of interest has fallen. So what will happen to the cash availability? That will increase. So what will happen to the spending on goods and services? That will also increase. Clear, everybody? So what did you see here? If the rate of interest on loans is falling, your repayment amount will also fall. So you have more amount of cash available with you right now to spend. So what will happen to the spending on goods and services? That will also increase. Next. Let us talk about something called as asset price channel. So lower interest rate on loans. People, what will happen when the interest rates on loans are very, very less? The present discounted value of the future income will increase. See, what happens here is when the interest rates on loans are really, really less, you borrow more amount of money. That is, you demand more assets. So when the demand for assets is increasing, what will happen to the price of assets? That will also increase. That is what they are talking in the asset price channel. That is what they are talking in the asset price channel. So what will happen here? Support asset prices by encouraging the demand for assets. Simple. See, whenever the loan, the rate of interest on loan is falling, so what is happening here? You are demanding more assets. So whenever you are demanding more assets, what will happen to the price of the assets? That is increasing. So it is giving you a feeling that you are more wealthy right now. As the asset price is increasing, you are feeling that you are more wealthier, right? So asset prices will increase. Collateral of an asset for banks to lend against will increase. Easier for households and businesses to borrow. So if your asset prices are increasing, so what will happen? You can actually pledge that asset and get more amount of money. An increase in the asset price increases people's wealth. See, whenever you see people spending, that not only depends on their current income, but also the amount of wealth they are holding. Okay. If the people feel that they are more wealthier, that is, if the prices of their fixed assets, they kind of increase or they kind of surge, they make people feel more wealthier and they also want to spend more now. Next, household consumption increase, housing investment will increase. So did you understand the logic here? Rate of interest on borrowing decrease. So demand for assets increase. Asset price increase. So if asset price is increasing, people are feeling wealthier. If people are feeling wealthier, the demand for goods and services and housing investment will also increase. Next, let us discuss another channel, which is your exchange rate channel. So what is this exchange rate channel? It is for the exporting firms and import competing firms. The appreciation or depreciation of the currency, how does it affect our economic activity? So what is happening here? Let us understand one simple thing here, okay? So there is a rate of interest prevailing in our economy. There is a rate of interest prevailing in Indian economy, and there is a world rate of interest prevailing outside the Indian economy. For example, if the rate of interest prevailing in the Indian economy is less than the rate of interest prevailing in the world economy. So what did I tell you right now? The rate of interest prevailing in the Indian economy is less than the rate of interest prevailing in the world economy. That is what they have written. If RBI decreases the rate of interest in the Indian economy is less than the rate of interest in the world economy, right? So what will happen? Investors earning from assets in India will be less than what they are earning from assets in other countries. So whenever the rate of interest is decreasing, the investors will lose their interest to invest in the country because now they are getting lesser amount of return. So what is happening? Why are they losing interest? When RBI reduces the rate of interest that is prevailing in the Indian economy is less than the rate of interest that is prevailing in the world economy. So investors, when they are investing somewhere, they will look at the rate of return, right? So they now feel that, hey, Baba, in India, the rate of interest is less, but in the world economy, the rate of interest is really, really high. So let me not invest in India. Let me actually invest somewhere else. Okay, so demand for assets in India as well as Indian rupees will decline. See, whenever the foreigners want to invest in India, they need to buy what? They need to buy rupees by exchanging their currency. For example, if an American wants to invest in India, he has got dollars with himself. What he will do? He will sell those dollars, buy rupees and then invest in India. So then the demand for rupee was increasing because he is giving dollars and demanding rupee. Now, as people are not investing in India, what has happened to the demand for rupee? It has decreased. What has happened to the demand for rupee? It has decreased. Whenever the demand for rupee has decreased, what will happen to the value of the rupee? As nobody is demanding rupee, what will happen to the value of the rupee? That will also decrease. We call that as depreciation. We call that as depreciation. And whenever a currency depreciates, it is favorable for the exports and not favorable for the imports. So whenever a currency depreciates, it is favorable for the exports and not favorable for the imports. So let us see the points. So demand for assets in India as well as Indian rupee will decline. So this will lead to what? This will lead to the lower exchange rate or the Indian rupee depreciation. So what will happen? The Indian rupee will depreciate. So cheaper exports, costlier imports. See, any country wants to enhance its exports and reduce the level of imports. That is when it is profitable for it. See, exports means you're selling goods and services and earning revenue. That is Indian economic activity, or Indian goods are demanded. And whenever you are importing, you're actually spending your money on foreign goods. You are not generating Indian economic activity, you're generating the economic activity for somebody else. So how can it be profitable for your country? So whenever a currency is depreciating, what will happen to the exports? They will increase. What will happen to the imports? They will decrease, landing the country in a profitable situation. So costlier imports add to inflation in India. So let us understand what is this. Okay, costlier imports add to inflation in India. Let us understand this. Let us, split it and then understand. So what is happening when imports get expensive? When imports get expensive, one second, the demand for foreign goods will decrease. What will happen? The demand for foreign goods will decrease. And when the demand for foreign goods are decreasing, so what has happened here? The imports have become expensive. When the imports got so expensive, your Indians will not import, rather they will decrease the demand for foreign goods and increase the demand for Indian goods. Whenever there is an increase in demand for Indian goods, what will happen to the prices of the Indian goods? May I know? They will increase. So increase in demand for something will result in an increase in the price, right? So whenever the demand for Indian goods is increasing, what is happening to the price of the Indian goods? That is also increasing. So causing an inflation in the Indian economy, right? So what are the other channels? You have something called as the quantum channel and two credit channel. So what are your credit channel? One is the bank lending channel. The other is the balance sheet channel. See, whenever a bank is lending money to you, it kind of sees your assets and liabilities, right? Your balance sheet is nothing but a statement showing the assets and liabilities. So banks kind of see the weight of the assets and then provide you loans. So whenever the assets of a company are increasing, it is actually easy for it to borrow money, right? So that is one channel. Next, let us read the note point what they have written here. So if the interest rate increases, cost of borrowing for the households increase. So their consumption decrease. Yes, absolutely. So what is happening to the cost of capital? It will increase. So this is from a household point of view. This is from an investor point of view. When the cost of capital increases, their investment will decrease. Cost of capital is nothing but cost of borrowing. Their investments will decrease. So it is referred to as contractionary monetary policy. A fall in the interest rates is expansionary monetary policy. A rise in the interest rates is contractionary monetary policy. So students, will you memorize this? A fall in the interest rate is expansionary monetary policy. A rise in the interest rate is contractionary monetary policy. That's it. So the next thing that we have here is the operating framework. I told you, right? The day-to-day activities that you perform to achieve the monetary targets, that is nothing but your operating procedures. So let us read what they have given here. Operating framework of a monetary policy. Monetary policy implementation through choosing operating target, choosing intermediate target, and choosing policy instruments. Listen to me carefully, students. You have got an objective. You have got an objective. For achieving those objectives, you set certain targets. For achieving those targets, you have certain instruments at the discretion of the Reserve Bank of India or the central bank of the country. So what is it? What is that I have told you? For any institution, for any central bank, there are a set of objectives. For achieving those objectives, you need to set some targets. Okay. For achieving those targets, you have got some instruments at the discretion of the central bank, right? So what are operating procedures? Day-to-day implementation of monetary policy by central banks through various instruments is referred to as operating procedures. So I told you, right, the RBI has got a set of qualitative instruments and quantitative instruments. It using those qualitative and quantitative instruments in the day-to-day activities to achieve their targets, in turn who will achieve the objective is nothing but the operating procedure. Next, what are your monetary policy instruments? I told you there are two types of instruments. One is qualitative, the other is quantitative. One is qualitative, the other is quantitative. So the instruments are categorized into quantitative and qualitative tools, right? So let us read the quantitative tools first. So this is your lesson, people. In monetary policy, the most important part is you understanding what are the various quantitative tools available with the Reserve Bank of India. Clear, everybody? So have direct effect on the economy's entire money supply. Let us see how they are having a direct impact on the money supply. So the first thing that you can see here is the reserve ratio. See, whenever I say reserve ratio, it includes two things. One is your CRR, the other is your SLR. CRR is the cash reserve ratio. SLR is the statutory liquidity ratio. See, you being a scheduled commercial bank have to follow the rules that are set by the RBI. Now the RBI, what it does is it decides the reserve ratio. See, this reserve ratio indicates that whenever a bank is receiving deposits, it cannot lend out the entire deposits, but a portion of the deposits has to be maintained as reserves with the Reserve Bank of India. So I told you, right, there are two types of reserves. One is the cash reserve ratio, the other is your statutory liquidity ratio. Talking about your cash reserve ratio, currently the cash reserve ratio is 4%. The current cash reserve ratio is 4%. So whenever a bank is receiving deposits, for example, there is a bank called as A and it received a deposit of 100 rupees. Now, can it lend out the entire 100 rupees to the public? No, it can't. So in that 100 rupees, what it has to do is 4% it has to maintain with the Reserve Bank of India. That is 4% of 100 rupees has to be maintained with the Reserve Bank of India and it has to be not used for lending purposes. That is your cash reserve ratio. So what is your cash reserve ratio? The amount of deposits that a commercial bank has to maintain with the Reserve Bank of India. Next, what is your statutory liquidity ratio? See, statutory liquidity ratio is maintained with the commercial banks with themselves. That is, the current statutory liquidity ratio is 18%. So, what is the statutory liquidity ratio means? See, some portion of the deposits have to be maintained in terms of liquid assets. That is, they have to be maintained in terms of cash, in terms of gold, and in terms of government securities. So, what is that I have told you? Statutory liquidity ratio indicates that some portion of the deposits has not to, they should not be lent. Okay, I'm so sorry. Some portion of the deposits, they should not be lent and they have to be maintained as statutory liquidity ratio. And what is the current statutory liquidity ratio? It is 18%. So 18% of the deposits have to be maintained in terms of cash, in terms of gold, and in terms of government securities. So let us see this. Banks require to set aside some portion in cash with the Reserve Bank of India, which is nothing but your cash reserve ratio, and the current CRR is 4%. Fraction of the total net demand and time liabilities. So let us understand what is this net demand and time liabilities. See, students, the meaning of net is nothing but receipts minus payments. What is the meaning of net? It is receipts minus payments, right? So whenever I am saying net demand and time liabilities, see, whenever a bank is receiving deposits, it has got a demand liability portion and a time liability portion. So what is this demand liability portion? For example, I went to the bank and I made a demand deposit. So what do you mean by demand deposit? Whenever I go to the bank and I ask for my money, the bank has to repay that money back to me. So that is the demand liability portion of the bank. Whatever deposits we are putting with the commercial banks, they are a liability for the commercial bank. They are an asset for us, right? So this is the demand liability portion. All the demand deposits are your demand liability portion. All your time deposits, that is after a specific period of time, after a maturity period, I go and ask my funds back. Before that, I cannot do that, right? So this is the time liability portion. That is, I'm giving the commercial bank some period of time, right? So a bank has demand liability portion and time liability portion. Now, what is the meaning of net? I told you, right? Receipts minus payment. So deducting demand liability, time liability minus interbank deposit. What is it? Demand liability minus demand liability, time liability minus interbank deposit. Okay. So what do you mean by interbank deposits? See, suppose let us take the example of the State Bank of India and the ICICI Bank. Okay. So whenever I have a transaction with a person, let us say I am person A person A is having a transaction with person B. Person A is having a transaction with person B. Person A has an account in SBI. That is, I have an account in State Bank of India. And person B has an account in ICICI Bank. Okay. So whenever A and B are transacting with each other, SBI and ICI are transacting with each other. So when these both have to transact with each other, they need to have an account with each other. That is, SBI maintains an account with ICICI. ICICI maintains an account with SBI, right? So whenever they are having an account with each other, they are holding deposits also. This is called as interbank deposit. This is called as interbank deposit. Okay. So demand liability, time liability portion minus interbank deposits will give you your net demand time liability. And whenever you are maintaining your CRR and SLR, they have to be maintained as a percentage of the net demand and time liability portion. Clear, everybody? sir. So students, what is net demand time liabilities? It is demand and time liability portion minus the interbank deposits, right? So whatever cash reserve ratio that we are maintaining with the Reserve Bank of India has to be maintained as a percentage of the net demand and time liability. So let us start our discussion again with SLR. So what have they written here for SLR? It is nothing but banks are required to set aside this portion as a percentage of the net demand time liabilities. What is the current SLR rate, students? It is 18%. So this 18% have to be maintained in terms of liquid assets, and that liquid assets can be in terms of cash, gold and government securities, right? So banks are allowed to earn interest on these securities. However, it is very, very low. So what did we learn? That in the liquid assets, you can maintain in terms of cash, gold and government securities, right? When compared to other risky investments, the yield on government securities is comparatively low. Next, let us go to the other instrument, which is your open market operations. The open market operation is nothing but the sale and purchase of government securities by the Reserve Bank of India, which kind of regulates the money supply in the economy. So let us understand how the sale and purchase of government securities is regulating the money supply. So first of all, understand what are these government securities. You keep hearing the term treasury bills, government bonds, right? So whenever you are talking about short-term instruments, it is treasury bills. Long-term, it's government bonds. Whenever the government is in requirement of funds, it borrows money from the public, right? Next. So to control money supply, the RBI buys and sells government securities in the open market with an objective to adjust rupee liquidity conditions in the market. So how that is done, let us have a look. So whenever RBI feels that there is lot of money supply in the economy causing inflation in the economy, students always remember there is a direct relationship between money supply and the general price level. So whenever the RBI feels that there is excess money in the economy causing inflation in the economy, it tries to suck out that excess money. And how does it suck out that excess money? It releases government securities in the economy. It makes people purchase those government securities. So the money from the people will go to the government. The money from the people will go to the government. So RBI sells government security, liquidity is sucked out from the market, inflation gets controlled. See, whatever inflation that you have seen, that was seen because of the rise in the money supply. It was seen due to excess money supply. If that excess money supply can be reduced, inflation can be brought into control, right? Next, RBI buys government securities. When does RBI buy government securities? See, whenever RBI is purchasing government securities, it is releasing money supply into the economy. So whenever RBI feels that there is, recession happening or there is a fall in the economic activity, there is a need for injection of money supply into the economy to, increase the economic activity, RBI resorts to buying of government securities. That is, RBI gives cash or releases money supply and gets government securities, right? Next, OMO affects short-term interest rates, in turn affects the long-term interest rates economic activity. Okay, let me just tell you about something which is called as Operation Twist. So let me just open the notepad here. So in this, we are going to see how a short-term interest rate can affect the long-term interest rates. Clear, everybody? So what RBI does is, let me open a section for you. No, this not okay. Yeah. So what RBI does it sells short term government securities. What RBI does, it sells short-term government securities. Whenever it sells short-term government securities, what happens to the supply of the government securities? It will increase. When the supply of the government securities increase, what will happen to the price of the government securities? It will decrease. And what will happen to the rate of interest? That will increase. Okay, everybody? Now, when it sells the short-term government securities, what is it receiving? It is receiving money from the sale of short-term government securities. Whatever sale proceeds that has received from the sale of short-term government securities is used in the purchase of long-term government securities, is used in the purchase of long-term government securities. So, whenever RBI purchases long-term government securities, the demand will increase. Whenever the demand will increase, what will happen to the price? That will increase. What will happen to the price? That will increase. Whenever the price of the government securities increases, the rate of interest will decrease. See, one key thing that you students have to understand here is the relationship between bond price and bond yield have an inverse relation. The relationship between bond price and bond yield have an inverse relationship. Clear, everybody? So this thing, whatever we have done here, is called as operation twist. That is, by selling your short-term government securities, by acquiring the proceeds of short-term government securities, those proceeds have been used to purchase the long-term government securities, which has reduced the rate of interest, right? So whenever the long-term rate of interest is decreasing, more people will be willing to borrow money and more economic activity can be generated. So this is how you are using short-term government securities to influence the interest rates in the long term. I hope you understood. Yes. So let us proceed to the next one. The different policy rates under market stabilization scheme. See, what is the meaning of market stabilization scheme? The name itself suggests that it is nothing but you're trying to stabilize the prices or stabilize the economy when there is excess money supply. You're kind of cleaning the economy when there is excess money supply. So this market stabilization scheme, it is actually an agreement between Government of India and the Reserve Bank of India to maintain stability in the economy. So let us see what is happening here. Under market stabilization scheme, the Government of India borrows from the Reserve Bank of India, such borrowing being additional to the normal borrowing. People, please do remember that whatever borrowing that is done by the Government of India under the market stabilization scheme is not a normal borrowing. It is not a normal borrowing. This is done only to stabilize the economy, only to suck out the excess money from the economy. That's it. Okay. I'm repeating this again. Market stabilization scheme, whenever the government is borrowing money, that is by issuing the bonds, whatever borrowing is coming under MSS is not normal borrowing. It is addition to the normal borrowing. And this is solely done for what? This is done to stabilize the economy. Yes, and issues treasury bills or dated securities, right? So what is this liquidity adjustment facilities? Let us just understand this. Okay, let me take a small example. So there is a bank A and there is a bank B. There is bank A and there is bank B. Okay, bank A received 100 rupees of deposits. Bank B also received 100 rupees of deposits. Okay, so as per the RBI regulations, you being a scheduled commercial bank, you need to maintain some portion of your deposits as reserves. That is, you should not lend that to anybody else, right? So you maintained some, let us say 22 rupees as reserves. Now you are having 78 rupees that is available to lend to the people. The same goes for bank B. It is having 78 rupees to lend to the people. Now what happened here? Bank A has lent how much amount? It has lent some 48 rupees. It has lent some 48 rupees and it is having an excess of 30 rupees. Bank A has lent how much? It has lent 48 rupees and it is left with a surplus of 30 rupees. Bank B The demand for loans is 108 rupees. So it is in a deficit of 30 rupees. Okay. So now bank A has a surplus of 30. Bank B has a deficit of 30. So what bank B can do, it can go to bank A and ask, as you're in a surplus of 30, can you lend me this 30? Bank A will agree, but as they are competitors, Bank A may actually exploit Bank B by charging a very high rate of interest. So what RBI has done was, it has introduced this liquidity adjustment facilities. That is, whenever banks are facing with the shortage of funds, they can avail the liquidity adjustment facility. Whenever banks are facing shortage of funds, to avoid exploitation, they have introduced something called as liquidity adjustment facility. So bank B, instead of borrowing from bank A at a very high rate of interest, it can actually borrow from the Reserve Bank of India to adjust its short-term obligation. Clear, everybody? So let us see the point here. So, liquidity adjustment facility, on the basis of the recommendations of the Narasimhan Committee on the banking sector reforms, the RBI introduced something called as liquidity adjustment facility for financial accommodation to central banks. What do you mean by financial accommodation? That is, whenever the banks are in short of money, they will be borrowing from the Reserve Bank of India through repo and reverse repo. So, let us understand what is this repo rate. See, in simple terms, repo rate is nothing but the rate at which the commercial banks borrow from the Reserve Bank of India. What is repo rate? It is the rate at which the commercial banks borrow from the Reserve Bank of India. And whenever Reserve Bank of India is giving money to the commercial bank, or rather when the Reserve Bank of India is lending to the commercial banks, it needs some collateral, that it will ask for some security. Even though they are commercial banks, some security is required, right? So whatever government securities that the commercial banks are maintaining, a part of the SLR. See, I'm not talking about the SLR securities. In SLR, the banks need to maintain some portion as government securities, right? I'm not talking about that portion. So they maintain, barring your SLR, the banks maintain some government securities. So these government securities are pledged with the RBI and they are taking the loan. So this repo meaning is repurchase. Repo meaning is repurchase. So what are the commercial banks repurchasing? So they promise the Reserve Bank of India that whatever securities that they are pledging with the bank, they are going to repurchase those government securities on a future date. And whenever I am saying repo, it is for short term purpose. Whenever I am saying repo, it is for short term purpose. Clear, everybody? So repo is for short term borrowing. So let us see the point. Banks borrow from the Reserve Bank of India on short-term basis against the repurchase agreement. So what are they repurchasing? They are going to repurchase the government securities, whatever they have pledged with the RBI. Next, the rate charged by the RBI for this transaction is called as repo rate. So repo is nothing but the rate at which the commercial banks are borrowing from the Reserve Bank of India. Monetary policy uses repo rate as one of the significant tools to control money supply. Okay, people. So repo is used for short-term operations. Repo is used for short-term operations. And you also have something called as overnight purpose. Okay, overnight lending is also done. For that overnight lending, whatever rate is decided, it is called the policy rate. For overnight lending, whatever rate is decided, that is called the policy rate. Okay, fine. So you have call and you have term borrowing. Okay, call borrowing, term borrowing, which we have discussed in your money supply. Call means 24 hours. Term more than 24 hours. So overnight, whenever you are talking about overnight borrowings, it is called as what? It is your, the rate that is decided for overnight borrowing is your policy rate. Next, reverse repo rate. So this is ulta. So repo rate is nothing but commercial banks are borrowing from the Reserve Bank of India. Under reverse repo rate, the Reserve Bank of India actually borrows money from the commercial banks. That is, whenever the commercial banks are having excess money, they put their excess money with the Reserve Bank of India and in turn earn some rate of interest. They in turn earn some rate of interest. So what is happening here? The Reserve Bank of India is actually taking money from the commercial banks. See, when commercial banks are borrowing from the Reserve Bank of India, they did pledge government securities. Now, the same rule applies for the Reserve Bank of India as well. Even Reserve Bank of India is taking money from the commercial banks, right? So it also has to put some government securities as security, right? So the government securities are put with the commercial banks and money is taken by the Reserve Bank of India from the commercial banks. See, repo is a way of injecting liquidity into the economy. Reverse repo is a way of, sucking out the liquidity from the economy. So when banks are depositing their surplus money with the Reserve Bank of India, the money supply will kind of decrease because these excess reserves, which they could have used for lending purpose, they are actually giving it to the Reserve Bank of India. It is the reverse repo rate, that is the rate RBI pays to the banks to keep additional funds in the RBI. So currently the reverse repo rate is around 3.35%. So what do you have to observe here is that you always have to remember that reverse repo rate is always less than the repo rate. The reverse repo rate is always less than the repo rate. What is the reason why the reverse repo rate is always less than the repo rate? People, if the reverse repo rate is greater than the repo rate, will the banks actually lend money to the people? They will feel that, reverse repo rate is greater than the repo rate. So let me just put all the funds with the RBI. My funds are safe with the RBI and I'm going to get some return. Why should I even take the risk of doing this banking business? So they will get a thought like that. So your reverse repo rate is always less than your repo rate, right? So there is a formula for your reverse repo rate. But right now, it is not, the difference is not 100 basis points actually, it is more than that. But the definition that they have given you, from the beginning this has been coming, so you need to remember this. So your reverse repo rate is repo rate minus 1. The current repo rate is 6.5% student, reverse repo is around 3.35%. As you can see, the difference is not 1 actually. But the definition is, the formula for that is reverse repo is equal to repo minus 1. The standard formula is that. Next, we have already discussed policy rate. So what is the meaning of policy rate? In India, the fixed repo rate quoted for sovereign securities overnight segment. So whenever you are lending on overnight basis, the rate whatever you are quoting for overnight basis is called as your policy rate. Next, let us talk about margin standing facility. So this has been recently introduced. The reason that they have introduced this marginal standing facility was, see, whenever you have to borrow money using repo rate, what you need to have government securities, like you need to have surplus government securities. For example, your bank is not having government securities, but it is in dire requirement of funds. Now, what can it do? Now, it has no government securities, so it cannot borrow using repo rate, but it wants funds so badly. So what RBI has told was, okay, as you require funds so badly, you can actually dip inside your SLR. In SLR, you maintain some government securities, right? Those government securities you can use and you can borrow from the Reserve Bank of India. But there is something that has happened here. You violated the SLR requirement. What did you do here? You violated the SLR requirement. For that, you have to be punished. So under MSF, whatever rate that we are charging is always greater than the repo rate. And the formula is MSF rate is equal to repo rate plus 1. The formula is repo rate plus 1. What happened here actually? Under repo rate, if you want to borrow, you need to have government securities. But you don't have government securities, but you still require funds. But under SLR, you are maintaining some government securities, right? See, technically speaking, they should not be used for borrowing purpose. They are set aside as reserves as per the RBI mandate. And they have to be maintained that way. But you require funds so badly that the RBI has given you permission to dip inside your SLR and use 1%. It is not that you use all your government securities. You can use still 1% of your SLR securities and you can borrow from the Reserve Bank of India. But you violated the SLR requirement. For that very reason, you will be charged a penal rate. That is, the rate is more than the repo rate. So MSF rate is the penal rate at which RBI lends money to the banks over the rate available under the repo policy. So MSF is the scheduled commercial banks can borrow additional overnight money from the Reserve Bank of India over and what is available through the LAF window, that is the liquidity adjustment facility window, by dipping into the SLR portfolio limit. That is, by dipping inside your statutory liquidity ratio, you can actually use that money and then you can borrow. Banks availing MSF rate can use maximum of how much? It is 1% of the SLR securities. So what is the formula for MSF rate? MSF is equal to repo rate plus 1. What is the formula for MSF rate? MSF rate is equal to repo rate plus 1. So let us discuss something called the bank rate. Let us discuss something called the bank rate. See, repo is for short-term obligations, right? Bank rate is used for long-term lending. So bank rate is used for long-term purpose. Okay. So bank rate is also called as discount rate. Bank rate is also called as discount rate. So here what the commercial banks can do is whenever they are having bills of exchange, they can rediscount them with the Reserve Bank of India and they can get money from the Reserve Bank of India. So under bank rate, what is happening? It is a long-term rate. It is also called as discount rate, right? So whenever commercial banks are having bills of exchange, they rediscount them with the Reserve Bank of India and they can get money against that, right? So let us see this. But recent times, bank rate is not so much in use. Actually, with the introduction of liquidity adjustment facility and with the introduction of marginal standing facility, bank rate has actually lost its relevance. So it is the standard rate at which RBI is prepared to buy or rediscount the bills of exchange or other commercial paper eligible for purchase under the Act. Now RBI does not entirely control money supply through bank rate as bank rate has been discontinued with the introduction of liquidity adjustment facilities. So bank rate, is it still in use right now? Not really. Next, bank rate is used to penalize the bank if it does not maintain CRR or SLR. See, you being a scheduled commercial bank, it is a mandate that you maintain the CRR and SLR that is decided by the Reserve Bank of India. Now, there are chances that you may not maintain CRR and SLR. If you don't maintain CRR and SLR, you need to be penalized for that. And the penal rate that is decided is your bank rate. And generally, your bank rate is equal to MSF rate right now. So the penalty that banks have to, face is equivalent to the MSF rate. As bank rate is not really there right now, this is equivalent to your MSF rate. So the penal rate is the highest rate in the LAF corridor. According to that, the banks are penalized. Next, let us read the conclusion. All the instruments of monetary policy, what did we study till now? We studied your CRR, SLR, repo, reverse repo, policy rate, bank rate, MSF rate. So they are inversely related to the money supply or credit supply. See, whatever rates that we have studied right now, if you see an increase in these rates, what will happen to the money supply? You will see a decrease in the money supply. So whenever your CRR, SLR, repo, reverse repo are increasing, that leads to a decrease in the money supply or credit supply. During inflation, so what is happening during inflation? Excess money supply, right? You need to suck out that. So you need to go for contractionary monetary policy. So what will you do? You will increase the reserve requirements. You will increase these repo, reverse repo rates so that this inflation can be tamed down. Right? During recession, what will you do? You will decrease them. During inflation, you will increase them. During recession, you will decrease them. Clear, everybody? So these were your quantitative tools. Now let us talk about your qualitative tools. Let us talk about your qualitative tools. See, qualitative tools are selective tools that affect the money supply on a specific sector of the economy. They don't affect the entire economy, but sector specific. These are morely sector specific. So let us talk about the first one, which is margin requirements. I'll make it really simple for you students. Let us understand the margin requirements with a simple example. So I'll just tell you a small statement. After that, I'll give an example for you. If the margin requirements are increasing, the amount of loan that you can take will decrease. If the margin requirement is increasing, the amount of loan that you can take is decreasing. I'll tell you the reason. One second. Yeah. For example, there is a land that you're owning and it costs 1 CR. The valuation of the land is 1 CR. Okay, 1 crore. Now, what you wanted to do was you wanted to pledge this land with the bank and you wanted to get money against it. You wanted to pledge this land with the bank and you wanted to get money against it. Okay, so let us see what happened here. And the margin required that was fixed by the RBI. The margin requirement that was fixed by the RBI, let us say it is how much? It is 60%. It is 60%. So according to the margin requirement, now the margin requirement is 60%. So you can only get a loan that is 40 lakhs. You pledged a land that is 1 crore, but you only got a loan that is 40 lakhs. So increase in margin requirement will decrease the amount of loan that you can take. For example, the margin requirement is 90%. The margin requirement is 90%. So what is the amount of loan that you can get? 10 lakhs. So margin requirement tells you the amount of money you need to fund yourself. The amount of money that you need to fund yourself. Let us proceed. Next, let us discuss this moral suasion. It is very simple. You already have seen that government securities are issued by the what? Government of India, and the purchase and sale is taken care by the Reserve Bank of India. See, what RBI does it tries to encourage the commercial banks rather than investing in other assets. It tries to persuade the commercial banks to invest in government securities. So that is your moral suasion. You are actually wanting them, you are actually telling that, beta, in these two options, this is good. So please go for it. You are persuading them. You are leaving it to their discretion, but you're telling them what is right, what is wrong. It's like you're actually persuading them to do something. So, by way of persuasion, the RBI convinces the banks to keep money in government securities rather than certain sectors. So, what is the Reserve Bank of India asking the commercial banks? It is asking them to invest more in government securities. Next, selective credit control. See, under selective credit control, what RBI says is, it tells the banks not to lend to certain sectors, especially those involved in speculative business. Let us take the example of gambling, betting, something like that, lottery business. So it tells the commercial banks not to involve in such speculative activities, that is selective credit control. Clear, everybody? Yes. So this is your qualitative measures. So what are your three qualitative measures? They are your margin requirements, moral suasion, and selective credit controls. Clear? So the next topic is your organizational structure for monetary policy decisions in India. This is going to be a very simple topic. In this, we are going to discuss your MPC, the Monetary Policy Committee, how it has been constituted, the members in MPC. So what are the, how frequent your MPC meetings are held, all that we'll have a discussion. And in the last, you're only left with the Reserve Bank of India's monetary policy decision. So with this, we can complete our chapter. So we have actually come to an end. So have some more patience so that we can complete your chapter. Okay, students, so we were discussing about the organizational structure for monetary policy decisions in India, right? So I told you that we'll be talking about the Monetary Policy Committee, the composition of Monetary Policy Committee, the frequency with which the committee meets, all that we'll have a discussion. So with no delay, let us start the subject. Explains how monetary policy is conducted in India. So the organizational structure for monetary policy decisions, what does it explain? It explains how monetary policy is conducted in India. The RBI India Act, the Reserve Bank of India Act 1934 was amended. When was it amended? It was amended on 27/6/2016 for giving a statutory backing to the Monetary Policy Framework Agreement. But let us understand what is this Monetary Policy Framework Agreement first. So it is nothing but it is an agreement between Government of India and the Reserve Bank of India on the maximum tolerable inflation rate. So the Monetary Policy Framework Agreement is nothing but an agreement between the Reserve Bank of India and the Government of India, stating the tolerable level of inflation. That is, the lower limit is 2%. The upper limit is 6%. The inflation should not rise above 6% and should not fall below 2%. Okay. Next. The RBI Act 2016 provides statutory basis for implementation of flexible inflation targeting. So what do you mean by flexible inflation targeting? In flexible inflation targeting, you will be given a band, that is 2% to 6%. So I have given you a range within which you can stay. Right. So I have provided you the flexibility, that is you can vary between 2% to 6%. On an average, you have to remain at 4%. On January 2014, RBI abandoned the multiple indicator and made inflation targeting as primary objective. Like I have always told you, every institution is established with a set of objectives, right? Your Reserve Bank of India, which is the central bank of the country, is also established with an objective. Like it has in the earlier stages, it has many objectives in mind. But finally, that was called the multiple indicator approach. When the RBI had multiple objectives, it was called the multiple indicator approach. Now, what it has done was, it has told people that, dekho, my primary objective, or rather the important objective that I will focus on, is my inflation targeting. Right? So that approach has been, the multiple indicator approach has been changed to the approach focusing on inflation targeting. Next, and this was done on whose suggestions? On the suggestions of expert committee under Urjit Patel. Next, the inflation targeting is set by the government of India in consultation with the RBI. Like I told you, the agreement that is happening between RBI and the government of India. So what they do is, every 5 years, they decide the inflation target. Once in every 5 years, they decide the inflation target. So for 5/8/2016 to 31 March 2021, the target that was set was 4% should be the average inflation. I told you, right? So your inflation ranges from 2% to 6%. That is a tolerable level. On an average, what is the amount of CPI that must remain? It must be 4%. The consumer price index, by the way, talks about retail inflation. The wholesale price index talks about the inflation at the manufacturer level, okay, the wholesale level. So what we are concerned about is the CPI. We are concerned about the end users, right? So our sole focus will be on your consumer price index, which talks about the retail inflation. Next, upper tolerance limit is 6%, lower tolerance limit is 2%. So RBI publishes monetary policy report every 6 months. So a monetary policy report is submitted every 6 months, explaining the sources and forecasts of the inflation for the coming 6 to 18 months. So every 6 months you submit a report and you kind of project the inflation for the coming 6 to 18 months. The central government constitutes as failure to achieve the inflation target when, see, your average inflation is what? It is nothing but the inflation, the upper limit plus lower limit divided by 2. That is your average. If the average inflation is greater than the upper tolerance level, that is the prevailing inflation, let us talk like this, that will make things easier for you. For example, the current CPI is around 8% or it is 7.9%, something like that. So as you can see that the 7.9% is greater than the upper tolerance limit that we have talked about. What is your upper tolerance limit? It is 6%. What is your lower tolerance limit? It is 2%. For example, if the CPI is 1.5%, it will be less than the lower tolerance limit. If it is 7 or 8%, it will be greater than the upper tolerance limit. So nothing can be, accepted. So average inflation greater than upper tolerance limit for any 3 consecutive quarters. One quarter is 3 months, right? So 3 consecutive quarters, if the RBI is unable to get the inflation back on track, that is, if it is not abiding by whatever target that they have set, the government kind of intervenes asking for reasons, right? The average inflation less than lower tolerance level for any 3 consecutive quarters. So government will consider that to be a failure by the Reserve Bank of India. Now, what is your MPC? See, MPC kind of meets every 2 months and it decides the rates that have to prevail in the economy every 2 months. So bi-monthly we call that as. So MPC has 6 members, 3 members from the Reserve Bank of India, 3 members from the government of India. So what they do is every 2 months they meet up, have discussions with regard to what should be the repo rate, what should be the reverse repo rate, what should be the reserve ratios and all. So the current repo rate, recently the MPC had a meeting and they decided that they are not going to change the repo rate and keep it 6.5% like it was previously. I think from 4-5 meetings they have not been changing the repo rate. They are holding it at 6.5%. Next, it consists of 6 members to determine the policy rate and achieve the inflation target through debate and majority vote. So, when there are 6 members in the panel, they do the voting process, whether to change the repo rate or not to change the repo rate, whether to increase the repo rate or decrease the repo rate. For example, there are 4 people, there are like 3 people who said that the repo rate has to be increased and 3 people stated that repo rate has to remain constant. So there is a tie, right? So there is a tie. So you cannot figure out something. So what happens here is the RBI governor will be given an additional vote. The RBI governor will be given an additional vote. I told you, right, 3 people are from Government of India, 3 people are from Reserve Bank. One is the RBI governor himself and the deputy governor. Next. Let us discuss topic 6, which is Reserve Bank of India's monetary policy decision. So RBI uses monetary policy to manage the economic fluctuations and achieve price stability. So that is what we have been learning. So what is the role of RBI? It manages the monetary policy. What is the role of monetary policy? To attain stable inflation and economic growth in the economy. RBI conducts monetary policy by adjusting what? By adjusting the money supply, buying and selling of government securities in the open market. This buying and selling of government securities in the open market is called as open market operations. And the market where the government securities are dealt is called the gilt-edged market. The market where the government securities are dealt with is called the gilt-edged market. Next, with recent increasing openness of the Indian economy. What do you mean by openness of the Indian economy? See, we are actually a closed economy at the beginning of the after the independence, but later on we started to open up, we started accepting investments, we kind of reduced the regulations. So we are accepting investment, private people are allowed to function. So in the beginning we actually followed, even though we called ourselves a mixed economy, our pattern was a socialistic pattern. Later we shifted and then now we are actually trying to explore more opportunities. So whenever India is called as an open economy, it indicates that we are trying to adapt to the changes that took place due to globalization and progressive economic and financial sector reforms. Even financial stability and exchange rate stability have assumed great importance in India. Students, do remember that any economy can sustain if there is financial stability. So financial institutions, the banking and finance play a vital role for the development of any economy. And exchange rate stability. Your exchange rate needs to be stable. What is the exchange rate? It is one currency expressed in terms of other currency. For example, you keep saying that $1 is equal to 83 rupees. So you are expressing dollar in terms of rupee. It is nothing but price of the dollar. For you to acquire $1, how many rupees do you require? And there must always be exchange rate stability. So you cannot expect your exchange rate to fluctuate every other minute. Then people will lose confidence. It can be a huge threat to the investors. It can be a huge threat to the manufacturers because not all the raw materials that they require for manufacturing will be made in the country itself. They need to get it from outside as well. And when they are getting things from outside the country, there involves something called as exchange rate. Next, when RBI lowers the interest rates, monetary policy is easing. See, the meaning of monetary policy is easing is you are going for an expansionary monetary policy. The meaning of monetary policy easing is you are going for expansionary monetary policy. The meaning of monetary policy tightening is you are going for contractionary monetary policy. I hope you understood the things. Now what we will do is we will try to address few questions. We will try to address few questions. So which will help you, gain more confidence with regard to the topic. We'll just solve few bits. And let me just see how much you have understood. So we'll start with this. So what is your first question? Which of the following is the function of the monetary policy? Regulate the exchange rate and keep it stable. Regulate the movement of credit in the corporate sector. Regulate the level of production and prices. Regulate the availability, cost and use of money and credit. See, all the three, they are not considered as functions, okay? So what is the function of monetary policy? You're trying to regulate the money supply. You're trying to regulate the amount of credit in the economy. You're trying to regulate the cost of credit. That is what the function is. So it is option D. What is it? Option D. Next. What is the main objective of monetary policy in India is? What is the main objective of monetary policy? Monetary policy. Reduce food shortages. This is not our objective. Economic growth with price stability. Okay, this seems right, but let us read other options as well. Overall monetary stability in the banking system. Reduction of poverty and unemployment. So what is the option, students? It is economic growth with price stability. See, this seems correct, okay? But this is the more wholesome option. See, in the exam, they don't ask you to choose the correct answer. They ask you to choose the best option. Clear, everybody? So, and you're not only talking about monetary stability in the banking system as such, you're talking about the entire economy, right? So, price stability in the entire economy and economic growth. Next. The monetary transmission mechanism refers to, what does it refer? How money gets circulated in different sectors of the economy post monetary policy. The ratio of nominal interest and real interest? No. The process or the channels through which the evolution of monetary aggregates affects the level of product and prices. So, when the RBI kind of takes any decision, how that decision is impacting the aggregate output, prices, and the level of employments will depend on the basis of channels through which it is passing, right? So, what is the right option? It is option C. So, monetary transmission mechanism is nothing but the channels through which the evolution of monetary aggregates affects the level of product and prices. Next. A contractionary monetary policy induced increase in interest rates. Okay. Contractionary monetary policy is nothing but monetary tightening. That is, you're trying to reduce the amount of money supply prevailing in the economy. So, what happens whenever you're increasing the interest rates? See, whenever you're increasing the interest rates, the cost of borrowing is increasing and people are not willing to take more money or more loans. Increase the cost of capital, yes, and the real cost of borrowing for the firms, okay. Increases the cost of capital, real cost of borrowing for the firms and households. This is what I was talking about. Yes, this is right. I'm not telling this is wrong. But which is the most wholesome option? Which is the best option? It is option B because it includes both firms and households. See, whenever there is increase in the interest rate, it causes increase in the cost of capital, not decrease in the cost of capital. So this is wrong. Has no interest rate effect? No, not at all. It is through interest rates that your monetary policy is trying to impact the economy. Next. So what is your next question? During deflation. See, the meaning of deflation is fall in the prices. So what is the meaning of deflation? Deflation, fall in the general price level. What is the meaning of inflation? Rise in the general price level. So what happens during deflation? The RBI reduces the CRR in order to enable banks to expand credit. See, deflation is the condition that you see during recession, okay, fall in the economic activity. So your approach should be expansionary monetary policy. And if you want to have an expansionary monetary policy, all the reserves that we talked about have to decrease. All the reserves that we talked about have to decrease. So if you are decreasing the amount of CRR, banks are able to lend more money to the people. That is, RBI reduces the CRR in order to enable the banks to expand credit and increase the supply of money available in the economy. This seems correct. Next. RBI increases the CRR. Blunder. RBI reduces the CRR. Yeah. And the banks to contract credit. No, they expand the credit. RBI reduces the CRR but increases the SLR. Wrong. Both the reserves, they have to decrease. See, you are decreasing CRR, you are increasing SLR. What impact? It is negated, right? Positive, negative, mash. Next. Which of the following statements is correct? So, which of the following statements is correct? Students, please read the options. The governor of RBI, in consultation with the Ministry of Finance, decides the policy rate and implements the same. Okay. He decides it with the government of India. While the CRR has to be maintained by the banks as cash with the RBI, SLR requires holding approved assets by the banks with itself, right? So this is the correct option. So this is not just one ministry. The governor of RBI, in consultation with the Ministry of Finance, decides the policy rate and implements the same. This is with the government of India. Okay, so you need to have government of India here. And next, this option seems right. Just have a reading. While CRR, this is not white, while CRR has to be maintained by the banks as cash with the RBI, true that. SLR means what? You are maintaining liquid assets. They may be in gold, they may be in cash, or they may be in government securities. So when repo rate increases, it means that banks can now borrow through. No, this is buying and selling of government securities. This is completely wrong. Not none of the above. So the correct option is option B. Next. RBI provides financial accommodations to commercial banks through reverse repo and repo under which scheme? You have to tell me this. It is liquidity adjustment facility. What is it? Liquidity adjustment facility, right? Next. Is a money market instrument which enables collateralized short-term borrowing. Short-term borrowing, underline this, and lending. This is not tending, it is lending. Through sale or purchase operations. What is that called? It is called as the repo. Repo is nothing but repurchase option, right? So we discussed about this. The rate at which the commercial banks borrow from the Reserve Bank of India. Next. In India, the term policy rate. See, policy rate is used for overnight lending rate. So let us see where you can find that. The bank rate prescribed by the RBI in its half-year monetary policy statement. The CRR, SLR prescribed by the RBI, no. The fixed repo rate quoted for sovereign securities in the overnight segment. So this is your right option, right? So this is your MSF. This is not your related to your policy rate. Next, reverse repo operation takes place when? So, in reverse repo, your RBI is taking money from the commercial bank. RBI borrows money from banks by giving them securities. This is correct, but let us see other options. Banks borrow money. No. Banks borrow money. No. RBI borrows money from central government. No. It is option A. So I hope you enjoyed the session. You were able to solve the bits. So what I request is you have to keep revising the things in your economics for finance. Otherwise, it will be of no help. But students, don't get scared of the subject. It is a very easy subject. You understanding the logic in economics for finance is really, really important. So happy learning. I'll see you in the next session. Hello students, welcome back to another session of economics for finance. So in this session, what we have got for you is Indian economy. Okay. So I heard that many people are requesting for Indian economy. So as we all know that Indian economy is highly theoretical, and what you have to, your approach towards Indian economy is you have to remember the important points from where there is a possibility of asking the questions, right? So what we have done here is we have prepared a notes for you. So we will also display the institute material simultaneously, but first we will start out with the notes. Clear everybody? So with no delay, what we are going to do is we are going to complete your Indian economy in a very short span, making you equipped with all the knowledge that you are required to solve the questions. Clear everybody? So what we will start is, let us start with what is the status of Indian economy. So the first heading that you're seeing here is the status of Indian economy. And what do you see here? Pre-independence period, that is from 1850 to 1947. Even going to that period, let us first understand what was the Indian economy from 1st century to 17th century AD. AD is after death. Clear everybody? So let us just jump into understanding what was the situation of Indian economy between 1st century to 17th century AD. So the first thing that you see is India is the largest economy of the ancient and medieval period. Okay. So if you take a list of the largest economies during that period, India was one among them. And we were prosperous and self-reliant. There was abundance of wealth during that period. What do you mean by self-reliant? We didn't have to depend on somebody else for something, but we were Atmanirbhar. What do you mean by Atmanirbhar? It is nothing but self-reliant. And this is very, very important. So among world's wealth, we controlled among 1/3 to 1/4 of the world's wealth. So what is the amount of wealth that we have controlled? It is 1/3 to 1/4 of the wealth, and which was very dominant. You know that you have got many sectors, but which sector was very dominant for us? Agriculture was the predominant sector, and we were having a surplus of food production actually. So we were very, plenty of food grains were there, plenty of wealth were there. So we were doing very good for ourselves. Okay. Next, we have highly skilled artisans and craftsmen. So you know those handlooms, right? So we were very good with that as well. So all the handmade work, we were very good with that. So what are the things that we have noticed in during 1st century to 17th century? We were the largest economy, we were prosperous, we were self-reliant, and we contributed to 1/4 of the world's wealth. Agriculture was predominant, and we had highly skilled artisans and craftsmen. So what is the next point that you see here? Ancient economic philosophy of India. Under this, what we are going to learn is, we are going to learn about Ardhasastra. So under ancient economic philosophy of India, we are going to study about Ardhasastra. And who is the author of Ardhasastra? He is Kautilya. And he is the minister of Chandragupta Maurya, right? So you have heard of his name, like many serials came out, depicting the character of Chandragupta Maurya and what Kautilya was. So most of you have seen those shows. I think most of you have done. So what actually history teaches us is, it teaches us not to repeat the mistakes. See, why do you go back to the history and study what already has happened? So you got to understand that history for us is available to learn from our past mistakes, and also it sets a ground for the future, right? So what is Ardhasastra? Written by Kautilya, and it's written in between the period 321 to 296 BC. So is the minister of Chandragupta Maurya. And what do you mean by Ardha, students? Whenever I say Ardha, 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 so what is Ardhat of Ardha? Artha generally you people denote it with wealth. Artha means it is wealth. But here what Kautilya did was, it is not wealth alone, but Artha includes all the elements that are required for the material well-being of an individual. So here you have to consider that your artha means not only wealth, but also all the aspects or all the aspects of material well-being that are required for the survival or subsistence, or rather for the survival of an individual, right? Next. So it includes wealth and land as well. So what Kautilya did was, he talked about the ministers, he talked about kingship, he talked about military, he talked about the fortress, he talked about the utilization of land. So there are many aspects that Chanakya talked about in the Ardhasastra. Clear, everybody? So let us understand what is the focus of Ardhasastra. So the first point that you see is means of fruitfully maintaining and using the land. So having land is not sufficient. You need to maintain the land and you need to fruitfully use the land, right? You need to increase the productivity of the land. Next, focus on robust agricultural initiatives, like what are the various irrigation techniques that can be used to increase the productivity as such. And coming to taxes, you have your public enterprises, you have your private enterprises. Public is nothing but government owned, right? So whatever business that government is doing on its own and whatever businesses that private people are doing, they must be charged equally. That is, the taxes that you are charging on their incomes must be equal. You have to make sure that there is proper parity or equality. So what happens if there is such parity or equality? You're actually promoting the private participation as well, because you're giving no undue advantage for the public enterprises, right? Next, focus on multidisciplinary aspects. So what is this multidisciplinary aspects? See, I already told you that Kautilya not only talked about economics here, he also talked about policy making, the military strategy, how a king should be. All such aspects are also talked about in Ardhashastra. So it is referred to as multidisciplinary, right? Next, let us proceed to the next topic, which is nothing but the role of East India Company. Here comes the barbadi of India. Okay, so from here we see the downfall of our country. Till now we stated that we were abundant with wealth, we are abundant with our food production, we contributed so much of wealth to the world economy. But what happened from this period was, from the period of 1957 to 1858, the East India Company comes to India, keeping in mind that they wanted to trade with India. And you know what this turned out to be eventually, right? So what happened during this period was, Britain was experiencing what? Industrialization or industrial revolution. Okay. So what happened was, the manufacturing capabilities of Britain were increasing during this period. And whenever a country is seeing an increase in the manufacturing capabilities, it requires what? It requires raw materials. It also requires a market for those finished goods, right? See, whenever we are manufacturing something, you need a market to sell that, right? So Britain was actually producing so much of goods, so it required so much of raw material. Yes, and when it manufactured so many goods, it required a market to sell them. So India was a perfect destination for both of them. So what East India Company did was, it came to India, it took out the raw materials from India, it made finished goods, and then exported to India. Right, people? So let us see the points. During this period, there was industrial revolution in Britain. So what happened? The manufacturing capabilities of Britain were increasing. So this generates two things. What is it? Need for raw materials and the market for finished goods. So what happened here? India became the exporter of raw materials instead of finished goods. So what happened? We actually could not export finished goods, but we were exporting what? We were exporting raw materials. Always remember, students, if you export the finished goods, there is a possibility for you to experience high growth rate. But what happened here was, there is a concept called as escalated tariff. There is a concept called as escalated tariff. Escalated tariff is something that is used by developed countries to curb the development of developing countries. You actually study about this escalated tariff in the chapter of instruments of trade policy in your macroeconomics. So let me just help you revise the topic. So what happens in escalated tariff is, you impose lower taxes on raw materials and you impose higher taxes on finished goods. So what is happening here? The developed countries, they impose lower import duties on the raw materials. They impose a higher duty on the import of finished goods. So people, what will they do? They will not import finished goods, but they rather will take in raw materials. Understood, everybody? So this was something happening to India in this period as well. So that is the reason we only remained as an exporter of raw materials, and we could not be competitive when compared to this Britain products. So what happened? Heavy tariffs were imposed on Indian finished goods, and I already explained you the concept of escalated tariff rates. What happened here? The exports became costly. Whose exports became costly? See, what do you mean by export? When you're selling something to an other country, that is called as export. If India is selling something abroad, that is called as export. If India is getting something from abroad, it is import, right? So what happened here? Due to the heavy tariffs, our exports were becoming very costly, and compared to the products that were manufactured by Britain, we are not very competitive. And whenever people are buying something, they would want to buy them at a very, very low price, right? But we are offering, when compared to their products, our products were comparatively very costly. That is the reason people were not demanding the Indian goods. So our exports became costly, imports became cheaper. What will be the impact of this sentence on India? There will obviously be a deficit because you're paying more than you're receiving. So what India lost? India lost its competitiveness. India lost its competitiveness. Next, external as well as internal demand for Indian goods fell sharply. Arey Baba, we'll understand that, okay, external demand fell. What about Indians? Were they not purchasing Indian made goods? See, the Western people filled an ideology in our heads that they were way more superior than we were. They were way more sophisticated than we were. Okay. So what happened was these people who were in India, they were trying to mimic the Western behavior. So what happened? The demand for Western goods started increasing and the demand for Indian goods started falling. So destruction of Indian manufacturers took place. So what is the reason behind the destruction of Indian manufacturers? There are three main causes. One is because of the British policies. What were the British policies? They made sure that only raw materials were sent from India but not finished goods. They made sure that we imported most of the Britain's products and we lose our trade competitiveness. Next, demand of domestic customers changed. What do you mean demand of domestic customers changed? They had a change in their tastes and preferences. Now they were feeling that the goods that were made abroad were way more superior than the goods that were made in India. Next, competition between machine-made goods versus handmade goods. The machine-made goods were way cheaper than the handmade goods. So what happened here? More people started demanding the machine-made good than the handmade good. This caused a drastic impact on the Indian artisans and craftsmen. So all of them lost their jobs and all of them were actually driven into poverty. Next. So what is the next heading that you see? Impact of destruction of Indian manufacturers. So what was the impact? See, we understood that with the advent of East India Company, our Indian manufacturers saw a great loss. But because of this loss, what was its impact? This had a drastic impact on Indian economy because now all these people in the manufacturing sector lost their jobs. So they will definitely look for an alternative. And what was their alternative? Agriculture was their alternative. So all the people started moving towards agriculture and the pressure on land started increasing. So whenever the pressure on land is increasing, what will happen? Division of land will happen. When division of land is happening, what will happen to the productivity? It will decrease. When productivity is decreasing, the output is decreasing. India, which was actually abundant in its food production, actually turned out to be a failure during this period. So what happened here? Large scale unemployment. Where do you see large scale unemployment? In your manufacturing sector, you experience large scale unemployment, due to which more people started depending on agriculture. And this led to the increase in the pressure on land. And what did this lead further? It led to further division of land holding, and which reduced the agricultural productivity, increased the poverty. So I hope you're all understanding. Next, there is an important point here that you have to understand. Import of cheap machine-made goods. I told you, right? When compared to handmade goods in India, people started preferring the machine-made goods from Britain. So what happened here? Import of cheap machine-made goods from Britain made the survival of Indian manufacturers very difficult. So what happened? Our Indian manufacturers could not survive because they could not compete with the machine-made goods. And the next thing that is noticeable here is the zamindari system. So zamindari system is again another headache for us. So what happened here was the zamindars, what they did was they gave the land to people for agricultural purpose. In turn, they charged rent for that. Now, what happened when there was a fall of the Indian manufacturers? The demand for land started increasing, right? When the demand for land started increasing, what will happen to the rent that you need to pay on the land? That will also increase. So, zamindars were actually charging a rent that was really, really high that the tenants could not even afford it, right? And the productivity was also falling, and these people were dipping inside poverty. So all these act as a problem for the Indian economy, right? So zamindari system made it difficult. Under this, landowners used to give their land on rent, and they charged a very high rent. The reason being increased demand for land due to the destruction of the manufacturing sector, and the zamindars extracted more rent. So what did the zamindars do? They took it as an opportunity and they extracted more rent, causing the poverty of the people to increase even further. So low productivity destroyed the agricultural sector as well. First, what was destroyed? Our manufacturing sector was destroyed. Next, what was destroyed? Our agricultural sector was destroyed. So this was still the East India Company. This was still the East India Company. Now comes the rule of the British government in India from 1858 to 1947. So what we will do now, right now, is we'll just see some positive points. Like with the advent of British government, it is said that the iron ore industry, the cotton industry, the jute industry, and many other manufacturing units started increasing, and India was actually becoming an industrialized economy. And during the Great Depression, we were ranked 12th among the industrialized countries. So all these are positive points. So let us take a look at the positive aspects that happened when the British government came into India between the period of 1858 to 1947. So first, let us talk about the period that is mid-19th century. Let us talk about mid-19th century. What happened? So in the mid-19th century, the modern industrial enterprise in the colonial India started to grow. So like I told you, there were many industries that were growing. Prominent among them were cotton, jute and iron ore, right? So what happened in the second half of the 19th century? Cotton mill industry grew. And please do remember the positions of India. That is very, very important, can be asked as bits. So cotton mill industry was growing, right? But during 1930s, India is on which position? Fifth position. And in India during that time, how many spindles were there? 9 million spindles. How many spindles were there? 9 million spindles. And what is the rank of India during 1930s with regard to cotton mill industry? India was ranked 5th. Okay, people. Next, jute mill also expanded rapidly around where? It was expanding around Calcutta. Okay, jute mill was also expanding. Cotton mill was very good. So our jute mill industry was on top at the end of 19th century. So what is the rank of our jute mill? Our jute mill industry was on top at the end of 19th century. So what are the different other industries that you saw as well? Brewing industry is nothing but the preparation of alcohol. Paper milling was there, leather making was there, rice milling was also developed. So what are the industries that were developed? May I know? The first that you saw was cotton, next is jute, brewing, paper milling, leather milling and rice milling. So these are all small industries. Now what we'll do is, let us talk about heavy industries. All that I have mentioned right now are your small industries. But what about your heavy industries? Under this, we are going to talk about your iron ore industry, which is very, very prominent. So heavy industries such as iron ore was established in when? So they'll ask you this question. When was heavy industries under which iron ore? That was established in which period? It was established in 1814. By whom? By British capital. So in 1930s, India's iron ore industry was ranked among 8th in number. So what is the rank of India in iron industry? It was 8th in number. And just before Great Depression, you know Great Depression, right? The period ranging from 1929 to 1933. It emerged in the United States of America, but it spread to other economies. As you know that these business cycles, I think in your business cycles chapter, you might have read about it. Business cycles are contagious in nature. That is the fall in one economy. It's kind of obvious that it will spread to other economies as well. So what happened? Just before Great Depression, India was ranked 12th largest industrial country. So what was India's rank before Great Depression? 12th largest industrial country. So jute, we were ranked on the top. Iron ore, we were ranked 8th in number. And just before Great Depression, India was ranked 12th largest industrial economy, right? So all this is fine, no? All these are positive points. Then what went wrong? In the British Raj, what went wrong? Because we all keep criticizing the colonial rule, right? We actually don't call it colonial rule, but we call it colonial loot. We call that as colonial loot. How they have actually extracted all the wealth of India and they have taken it to their place. So what actually went wrong? India's industrial growth was insufficient. Yes, see, whatever you have seen above is an industrial growth, but this growth is not sufficient. Why is it not sufficient? Because the share of manufacturing sector in your entire NDP was only 7% in 1946. So what was the share of industrial sector in 1946? It was only 7%. And coming to the share of employment, you will actually find it very astonishing that during the period of 1900, it was 0.4%. So during the period of 1900, what was it? It was 0.4% of the total population. And by 1941, it only grew by 1%, which is 1.4%. Is it a substantial growth? Actually, is it generating much of employment to the Indian population? Not at all. During 1900, it was 0.4%. Now in 1941, it is just 1.4%. So this went wrong during the industrial growth. Okay. So we did tell few positive points, but there are negative points which are dominating the positive ones. Okay. Next. So the next heading that you see is Indian economy post-independence. So this is all pre-independence, how the colonial loot has happened and all. So if we have to talk post-independence, our reforms era, everything of that comes into picture. I think most of you students are aware of the LPG reforms, the 1991 new economic policy, all that you might have read about. But we are going to focus on many aspects as well. So the first thing that we are going to do is we are going to discuss what happened in the period 1947 to 1991. You all know we just got independence and we were actually shaken by what happened with us due to the Britishers, because we allowed them into India, right? For that very reason, this loot has happened. So we didn't want such thing to happen again. So in the beginning years of our independence, we were actually a closed economy and we did follow a socialistic pattern of society. Actually, there were two philosophies that were very famous after independence. One was the Nehruvian philosophy, the other was the Gandhian philosophy. What Nehru stated was, let us focus on industrialization, let us focus on heavy industries. But what Gandhiji wanted was, he said, no, we have to focus on our roots. We have to focus on villages. We have to focus on the cottage industries. We have to focus on the small scale industries. But the Nehruvian philosophy kind of became very popular. That you all know the rest of the story, right? So what was the status of our Indian economy post-independence? Let us understand that first. When the Britishers left us, what was the condition of the Indian economy? They did leave us, but in what state did they leave us? So the thing that you have to understand is when the Britishers left us, the literacy rate was just 18%. So when the Britishers left us, what was the literacy rate? The literacy rate was just 18%. And what about the life expectancy? Can you even imagine? It was just 32 years. So what is the life expectancy? 32 years. And we were in severe poverty. Many people were dying of hunger. So what we did was we established something called as Planning Commission. So under Planning Commission, what the government does is for the coming 5 years, what the government needs to do, how the government needs to act, a proper plan was prepared, which sectors had to be developed, where investments have to be made. So a proper plan was done. So that job was done by the Planning Commission. But as you all know, we had only 12 5-year plans. In the year 2015, Niti Aayog came and the abolition of Planning Commission took place. But that is not relevant for us right now. That is just for your general knowledge purpose. So what happened in 1948? So in the period 1948, what happened was there came something called as Industrial Policy Resolution. There came something called as Industrial Policy Resolution. Like I earlier told you that after our independence, we did not know whether we have to go for a socialistic pattern of society or a capitalistic pattern of society. Under socialism, you know that government plays a predominant role. But under capitalism, the private people are given the freedom to explore and grow. right? So we had two superpowers because I think you all are aware about it. We have got two superpowers. One is Russia, the other is the United States. You know, Russia is totally socialistic pattern of society, and USA is this perfect example for capitalistic pattern of society. So they wanted India to join, like either we join Russia or we join, the United States of America. But what B.R. Ambedkar, he had this opinion that we just got our independence. Let us not decide what will be the structure of our economy. Let the people of this country decide whether they want to be a capitalistic economy, whether they want to be in a socialistic economy, or whether they want to be a mixed economy. So what we decided was we'll go for a mixed economy. But the truth was, in the beginning years of our independence, even though we opted for a mixed economy, socialism was quite predominant because there was a lot of government control. And that is proven by this industrial policy resolution introduced in 1948. So what this resolution had? Expanding the role of public sector. What this resolution had? Expanding the role of public sector, licensing to private sector. That is, prevalence of licenses. That is, prevalence of, very tiresome or cumbersome documentation procedure. If you want to set up an industry or if you want to set up a factory, you have to approach n number of departments getting approvals. This is a tiresome act, right? So you will lose interest in, venturing into business and all. So what they did was they required the private people to take license for every single thing, for every single issue. So next what happened? So like by now only you can understand that during the 1948 industrial policy resolution, who were given importance? The government sector was given importance, and government monopoly in strategic areas. See, what are strategic areas? Important or key areas where government presence is a must, like your banking or your transportation. So all such areas, railways, you know that, right? So in these areas, government monopoly is a must. Okay. Next, policies in 1950s, like I have earlier told you, they were divided into two. What are those, may I know? They are Nehru's philosophy and the Gandhian philosophy. So what did Nehru focus on? Nehru stated that we will go for a socialistic society which emphasizes heavy industrialization. But what did Gandhiji wanted? He wanted small scale and cottage industry to be developed. He focused on villages. He focused on villages. So this was your 1948 industrial policy resolution. After this, we had another resolution which came in the period 1956. So what was it? Industrial policy resolution in the period 1956. So what did the industrial policy resolution in 1956 supported? You know that in 1948 policy resolution, we gave more importance to the government sector. So what happened in 1956? The same happened. We gave importance to the government sector. So what is the first point here? It supported enormous expansion of public sector. So undue priority was given to whom? Public sector. What do you mean by undue priority? Undue priority is nothing but undue advantage was given to public sector over your private sector. Next, what happened? Reduce the incentive for private sector. People, if you are actually favoring the public sector, will the private people, want to grow, or will the private people want to participate? No. So there was undue advantage that was being given to the public sector. So what happened due to this? The private investments were discouraged. When private investments were discouraged, what will happen? It will have a long-lasting negative impact on the industrial growth of the country. So if private people are not coming into picture and only public sector was handling it, there is no 100% guarantee that your public sector will always be a success. See, we were a welfare state in the beginning. So what do you mean by welfare state? You are more focused with the development of the people, the welfare of the people. You're not profit oriented. When the government does some business, do you think it keeps in mind the profit? No. The only motive that the government has in mind is the welfare of the people. Okay. When welfare is given priority over, the growth, do you think there would be any industrial growth? If you want to see industrial growth, private participation is a must, because they are the people who run on profit motive, not the government sector, right? So what happened to India was also, you give more importance to government sector. It is no wrong. But were they flourishing well? No, they were not. They were running in losses. Next. We also faced a BOP crisis. So what do you mean by BOP crisis? So what happened was India faced a BOP deficit. That is, the inflows were less when compared to the outflows. That is, as you all know, we wanted to become an industrialized economy, right? So what we did was we were importing the capital goods. We were importing the crude oil. You know that India's 80% oil needs are met by import of the crude oil, right? So we were, importing huge amount of capital goods. You know what are capital goods, right? Capital goods are those goods which are used in the production of consumer goods. Capital goods are those goods which are used in the production of consumer goods. So what happened here? Due to huge imports and negligible exports, India actually faced a BOP crisis, or the balance of payments was in deficit. Okay. Next. So what about this? The next topic is first 3 decades. So from the period of 1950 till the period of 1980, as you can see, these 30 years, or the rather 3 decades, what happened during these 3 decades? Something very interesting happened during these 30 years. What happened was, India actually saw a stagnant growth of 3.5%. So what happened was, the annual rate of growth during this period was only 3.5%. It was a stagnant rate of growth. And for that very reason, this was also called the Hindu rate of growth. This is also called the Hindu rate of growth. So what happened was, the first 15 years, the focus was on capital intensive projects like, so what are your capital intensive projects? Building roads, dams, power plants, heavy industries were given importance rather than consumer goods. So you are very capital intensive in nature and you have not much focused on your consumer goods. So what happened was, there was a major shift in the Indian economic strategy in the mid 1960s. So what happened here, from 1950 to 1980, the annual average growth rate that you have seen in your Indian economy was just 3.5%. Okay. So in 1960s, what you saw was a major shift in the Indian economic strategy. So what happened here? You gave importance only to the manufacturing sector. I think you're all familiar with the second 5-year plan, also called the Mahalanobis plan. Okay. In that, the industrial sector was given major importance. But what about agriculture, the backbone of the Indian economy? It was actually neglected. It was actually neglected. So what happened here? Agriculture was not given priority in the second 5-year plan, also called the Mahalanobis plan, right? So continuous decline in the monsoon. So what happened? They say, no, all the problems come knock your door at once, right? So what happened was, one thing, they have not given importance to agricultural sector, and the nature also was not giving importance. The monsoon was also very erratic, that is, continuous decline in monsoon was happening. And on top of this, there were two droughts that we faced in the years 1966 and 1967, and we also faced wars in 1962, 1965. So what happened here? Due to all these reasons, we were actually seeing a major food crisis in India. India was seeing a major food shortage. But what we used to do was, we used to ask for aid. We used to ask for aid. That is the United States of America under the Public Law 480. So there is a law called as PL 480, under which India used to get grains from the United States of America whenever we saw a food crisis. But what happened was, I strictly remember, it was during Indira Gandhi government that she asked for help under PL 480. But the president at that time, he did not accept the request. So our sentiments were badly hurt actually. Okay, our sentiments were badly hurt. It was due to the, 1962, the wars that we were engaging in. So there was some problem with the diplomatic ties and we could not get the aid. Then we understood the importance of being self-reliant. And came into picture the Green Revolution. So you know that he was headed by Dr. M.S. Swaminathan, the great person. So he actually made India from a food deficit country to a surplus country, right? So let us see the points. So you saw two consecutive droughts in the period 1966 and 1967. So due to which India faced a severe food crisis. So under which public law did we get aid from United States of America? It was Public Law 480. It was Public Law 480. So the food crisis has resulted in a shift from heavy industries to agriculture. They say, whenever you are hit really hard, you realize what went wrong. So we thought that, Arre Baba, industrial sector is important, but I think we are giving too much of importance to industrial sector. So it is very important that we actually give priority to agricultural sector as well. So what we did was, we actually started prioritizing your agricultural sector as well. Right? So next started our Green Revolution. What did it start? What did we start with? We started our Green Revolution. So what happened, students? We did realize that something went wrong with our policy and we thought that agriculture must be given importance. And there comes our Green Revolution. What has come into picture? Our green revolution. In our green revolution, what are the important points that you have to remember? The high yielding variety seeds, which increase the agricultural productivity, the intensive use of water, that is, we have actually adopted more modern techniques of irrigation process, fertilizers and pesticides. So all these three things has resulted in the green revolution and increasing the productivity of the Indian agriculture. Next, so in 1969, government nationalized 14 banks. So here comes an end to our green revolution. The next thing that you have to notice is the nationalization of the banks in India. That is, two times it has happened. That is in 1969 and in 1980. In 1969, 14 banks were nationalized. In 1980, 6 banks was nationalized. So, madam, what is the requirement for nationalization of these banks? So, what is the meaning of nationalization? First of all, nationalization is nothing but they're taking them under government control. So, what is the need that has come that the banks had to be, nationalized or taken under government control? The reason behind that was financial inclusion. So, what is the reason behind the, nationalization of the banks? It was financial inclusion. You all knew that after independence, it was very important to create savings habit among the people, and rural people were not actually habituated these banking habits. And you know that private people always stay in places where they can get more profits, so they will not go to the rural areas where they see no profitability. So it is the role of the government to go to the rural backgrounds and inculcate savings habit and make banks very adaptive for the rural people, or rather they must inculcate a saving habit, right? So for that very reason, we saw bank nationalization in two periods, that is 1969, 1980. In 1969, how many banks were nationalized? 14 banks. In 1980, 6 banks. Actually, this was a positive thing that has happened because nationalization of these banks has led to increase in savings by the people. Okay, more people started adopting, the services that are rendered by the banks, and they became a part of the financial system. So the next thing that we are going to notice here is the economic performance of India from the period 1965 to 1981. Okay. So we are going to analyze what went wrong, what are the reasons for negative growth in this period. So let us understand what are the reasons for negative growth. So this period is also called the worst period in independent India's history. The reasons are, we fought 3 wars, that is, in one is 1962, 1965 and 1971. In 1971, we helped the East Pakistan get liberated now, which is your Bangladesh, right? So in 1962, there was wars with 1962-65, there were wars with China and Pakistan. And next is your license Raj. One very bad thing that happened was the license Raj led to the downfall of the industrial growth of India, because private people were very much discouraged during the license Raj. They have to expand their production, they need to take a license. They have to increase their capacity, they need to take a license. They want to venture into some other product, they have to take a license. They want to diversify, they have to take a license. They want to set up another branch, they have to take a license. So this license Raj system has actually caused a downfall to the industrial growth of India. Next, we already studied about this. We saw two major droughts, that is 1967, which caused the food crisis. And coming to the next point is your oil shocks in 1973 and 79. So what happened here was, all these oil shocks that you saw during this period, the reason behind that was OPEC, the Organization for Petroleum Exporting Countries. It is a group of 12 countries. Okay, you have all the Arab countries present there. So what happens here was, during the period of 1967, around that, Israel and Arab have a war. Okay, and Israel wins over, and during the period of 1972-73, the OPEC is not really satisfied with the amount of oil prices, it is oil revenue that is getting. So it plans to cut down the supply of oil and impose sanctions on all those people who had good relations with Israel. Okay, so what is the conclusion of the entire story is, there was a shortage of supply of oil during this period because OPEC purposefully cut the oil supply, because whenever there is a decrease in supply of something, what will happen to the prices? You see an increase in the prices. So whenever there is an increase in the prices, you see an increase in the revenue for the people who are selling such good, and oil having an elastic demand, because any country who is going through an industrialization process or who is indulging in manufacturing activities, oil is a must. So even though the price of the oil is increasing, we will not stop importing oil, right? So I have already told you that 80% of our oil needs are being imported. And during this period, you will be quite astonished because the barrel price has increased 350%. The barrel price has increased 350%. And another reason for the negative growth was, I already told you, India was a closed economy, that we were not very encouraging with regard to the foreign investments because we saw a backlash during your British era. So we didn't want to take the risk and we were a very closed economy, right? Next, majority of the government policies aimed at equitable distribution of income and wealth. See, it is not wrong that you focus on equitable distribution of income and wealth, but first you also have to look for growth, right? The problem with India was we were majorly driven to be a welfare state, but we should have also focused on the growth, for which we could have, promoted the private participation, which could have helped us, increase our growth. Next is your MRTP Act 1969. So this act, what it did was, it actually discouraged many large firms from expanding, from increasing their capacity, from producing. See, the reason behind the MRTP Act was it was Monopoly Restrictive Trade Practices Act. This was actually introduced to, protect people from exploitation. But it actually proved to be a negative impact on the development of the large industries that were present. Next, in 1967, the policy of reservation of many products exclusively for the manufacture of small-scale sector. So, some products were actually reserved for the production only by the small-scale industries, and large-scale industries were not allowed to enter into the production of such goods. That is one reason, because you are actually discouraging whom? You were discouraging the large-scale enterprises. For the sake of promotion of the small-scale industries, you discourage the large-scale industries. And were these small-scale industries very competitive? Not at all. So, this policy did not yield a very good result. That was one issue that led to the negative growth rate. So students, let us continue with the era of reforms. So as you can see, the annual growth rate of GDP that was observed during 6th plan and 7th plan are written here for you. So during 6th plan, the period was from 1980 to 1985, and the growth rate, the annual growth rate that was observed was 5.7%. And during the 7th plan, that is during 1985 to 1990, the growth rate that was observed was 5.8%. Do you remember in the beginning we only saw 3.5% of growth rate, which is also referred to as the Hindu rate of growth? Yes. So I hope you remember that as well, because it is very, very important from your exam perspective, right? So the early reforms of 1980, what they have focused on? They mainly focused on three aspects, which are your industrial development, the development of trade, and to make the taxation way more easy. See, whenever you are easily complying with the tax requirements, more people will be coming into the tax bracket, right? As more people are coming into the tax bracket, your tax revenue, your government revenue will go on increasing, right? So what is the first point that you see here? The prominent industrial policy initiatives are, so in the year 1985, delicensing of 25 broad categories of industries were done. See, what do you mean by delicensing? Earlier we have discussed about license Raj system, right? So for every small thing, you need to take the license from the government. So what the government has done was, they have delicensed almost 25 broad categories of industries. That is, you don't have to require to take permissions, right? Next, firms in engineering industries were allowed to change their product mix. Let us take a small example for this. Earlier, if the private people wanted to expand or they wanted to diversify, they had to take a license. For example, Tata is more ventured into trucks. In the beginning, Tata was only ventured into trucks. Now, Tata also wants to make cars. So, if Tata wanted to make cars, in the beginning, they had to take a separate license for that. Now, as the broad banding is allowed, what do you mean by broad banding? That is, you are allowing the firms to expand their product mix. That is, for making cars, you don't have to separately take a license, right, everybody? So, firms in engineering industries were allowed to change their product mix, which is also called as what? Which is also called as broad banding. Next comes your Monopoly Restrictive Trade Practices Act, and your MRTP Act 1969, in the beginning what they did was, so anybody coming under the limit of 20 crores, huge restrictions were imposed on them with regard to the expansion, diversification or setting up a branch and so on. So that limit was increased to 100 crores, providing a relief for many companies as such. Okay, next is your multi-point excise duty replaced by mod VAT. See, what do you mean by value added tax? See, this value added tax were introduced for the basic thing that You should not face any sort of double taxation. What is it? Multi-point excise duty was replaced by mod VAT. This is very, very important. So what do you mean under this? You are not trying to cause a double taxation, because whenever you're involved in a manufacturing process, you buy many raw materials, and there is a possibility that the people who made those raw materials have already paid certain taxes. Okay. So when you are purchasing that raw material and when you are using that in your production process, what you do is you kind of deduct whatever tax that has already been paid on the inputs. Okay. So what do you mean by value added tax? It is value of output minus value of input tax, right? Output tax minus input tax. You try to claim the credit on the tax that has already been paid so that you avoid double taxation. Next, your SEBI, which is a very, very important body that regulates the capital market, which is the Securities Exchange Board of India, was set up on April 12, 1988. Next comes your OGL list. What do you mean by OGL list? Open General List. Okay. Open General Licensing List. See, whenever something falls under the ambit of the OGL list, the restrictions with regard to imports and exports are eliminated. So whatever items that you see in your OGL list, they are exempt from the restrictions, be it in the case of import or export. So OGL list was expanded, and number of capital goods. You all knew that in the beginning our focus was on industrialization, and for you to focus on industrialization, you require the capital goods. We used to import those capital goods. So what happened to those capital goods list? That has been expanded to 1329 in the year 1990. Clear, everybody? Next. So the next thing that you see here is the several export incentives were initiated. See, our country wanted to focus on trade as well. See, from trade deficit country to we wanted to go to a trade surplus country. From a trade deficit country, we wanted to move to a trade surplus country. For that to happen, you need to encourage your exports. And for encouraging your exports, many advantages or incentives were provided to the companies. And the exchange rate was set at a realistic level. What do you mean by exchange rate? It is the rate at which you are expressing one currency in terms of other currency. For example, you keep saying that $1 is equal to 83 rupees, $1 is equal to 82 rupees as such. So what are you doing? You are expressing one currency in terms of the other currency. And whenever you are indulging in imports and exports, it is very important that your exchange rate is stable. Whenever you are indulging in imports and exports, what is it required? It is very much required that your exchange rate is stable. See, too much depreciation or too much appreciation is not good for any economy. Your exchange rate has to be maintained at a moderate level. See, whenever your currency is depreciating, it is good for the exports, but it is also bad for the imports. No economy is self-sufficient. We export as well as import. So your exchange rate has to be moderate. Too much appreciation is not fine. Too much depreciation is also not fine. Next. Price and distribution control on cement and aluminium. See, in the earlier periods, the prices of cement and aluminium were controlled by the government, as they are very, very important in the construction process, right? So now what they did was they eliminated, or rather they abolished the control, the price and distribution control on cement and aluminium. So it is completely left to the market to determine their prices. Next, budget of the 1986. What policies it introduced were, they have introduced policies with regard to cutting of taxes. Madam, why do you have to cut taxes? People, whenever you cut the taxes, it kinds of provides an incentive for the people to indulge in more activity, economic activities, liberalization of the imports and reducing the tariffs. So you also know that whenever your focus was also on the trade, right? In your 1980 reforms, we focused on three areas, right? You focused on your taxes, you focused on trade, and you focused on industry. So for the development of the country, for liberalization of the trade, it is very, very important that you reduce the restrictions, right? Or your tariffs. Your tariffs are nothing but the restrictions. Next, based on your REER, in your exchange rate chapter, you studied about REER, right? What is the REER? It is real effective exchange rate. So based on that, what did we do? We devalued rupee by 30%. See, whenever you are following a fixed exchange rate regime, whenever your exchange rate is controlled by the government, whenever the government tries to increase the value of the currency, it is called as revaluation. Whenever the government tries to decrease the value of the currency, it is called as devaluation. So the term that is used here is your devaluation. That indicates what? You are in a regime that is fixed exchange rate regime. And by how much was your rupee devalued? Your rupee was devalued by 30%. Your rupee was devalued by 30%. Now, next comes your economic reforms of the 1991, our most awaited reforms, your LPG reforms, that is liberalization, privatization and globalization. So, these 1991 reforms were introduced under the Narasimha Rao government. So what is the reason behind these 1991 economic reforms? Why did they have to come up with these 1991 economic reforms? The first thing that you notice is your high fiscal deficit. What do you mean by fiscal deficit? It is the excess of expenditure over revenue. And whenever you are calculating the revenue, you need to exclude the revenue part that you are accruing from borrowings. Okay. So fiscal deficit clearly tells you how much of money you have borrowed when your expenditure crosses your revenue. What happens if there is high fiscal deficit? Your interest burden will go on increasing, right? And the debt, it stopped becoming sustainable. You're unable to pay back the debt. So it kind of acted as a huge burden for you. Next, the Gulf War of the 1990. So what happened was, in the 1990, due to the Gulf War, what the OPEC did was they decreased the oil supply. Whenever the oil supply is decreased, what will happen to the price of the oil? It will increase. And you know that crude oil is very crucial for all the economies, right? So whenever there is a surge in the crude oil prices, you see a surge in all the prices. So food inflation, or rather all types of articles, their prices goes on increasing, because in transportation your crude oil plays a vital role. Next, depletion of the foreign exchange reserves. And how much foreign exchange reserves are you left with? You are left with $1.2 billion, and this could only be used for a matter of 2 weeks, right? This could only be used for a period of 2 weeks. Next, high degree of restriction was imposed due to the BOP crisis. What restriction are we talking about? As I told you that we were running in deficit. And whenever a country is in deficit, the government will try to restrict the imports. But in the beginning, when you were indulging in the manufacturing process, most of the capital goods were imported from outside. Now, because of the restrictions that have been put, you are unable to import the capital goods. If you are unable to import the capital goods, most of the industries were affected as their production kind of decreased. When there is a decrease in the production, what will happen to the employment opportunities? That will also decrease. You started to address one issue, and you were the reason for another issue to crop up, right? Next thing is the dependence on IMF. See, whenever a country witnesses balance of payment crisis, it kinds of go to IMF, the International Monetary Fund. Whenever a country witnesses what crisis? Balance of payment crisis. Whom does it go to? It goes to IMF. But IMF helps on certain conditions, and the conditions set by IMF are very, very stringent. So high dependence on IMF was also one of the reasons for the 1991 economic reforms. And a fragile political situation. If the political stability is missing, then also there is a high possibility that your country might go into crisis, right? Next. So if we talk about your LPG reforms, L stands for liberalization, P stands for privatization, G stands for globalization, right? So what do you mean by liberalization? You wanted to reduce the rules and regulations, you wanted to remove the rules and regulations that were earlier there, and you wanted to increase the ease of doing business in India. What do you mean by privatization? You actually reserved most of your industry for government sector. Now you started to allow private people to participate in that. So foreign investments are also walking in. Globalization. So in the case of globalization, what did you see happening? Use of foreign investment was allowed, and many people were willing to, have contact with India and do investments in India. Right? So what are the objectives of the LPG reforms? There are two main objectives that you see here. To formulate a market-friendly policy. So, madam, what was the earlier policy? See, earlier, before the 1991 economic reforms, you were a planned economy. Even though you called yourself a mixed economy, but you are highly driven by socialistic pattern of society. You were a command economy where all the prices were administered. They were not market determined, but most of them were fixed by the government. So, now what you are trying to do is you are going to approach in a manner that is more market friendly. That is, you are letting the operation of price mechanism or demand and supply forces to determine the prices. Now, what is this macroeconomic stability by reducing the fiscal deficit? I already told you what fiscal deficit is, and whenever the fiscal deficit of a country is increasing, its debt burden is increasing. Whenever the debt burden is increasing, the interest expenditure will increase. So whatever you are earning, you are spending all the amount to pay the interest, which is a revenue expenditure. Interest expenditure is not generating you any additional revenue. Always remember, students, your expenditure is of two types, capital expenditure and revenue expenditure. If you increase your capital expenditure, that will help you generate further revenue. But if you are increasing your revenue expenditure, it is of no use. So we are trying to achieve the macroeconomic stability by trying to reduce the fiscal deficit. And we also promised to bring down the fiscal deficit to zero by 1997-98, but promises, they are meant to be broken. That is always said, so that could not be achieved. Next. measures taken to reduce the fiscal deficit. I told you, right? The major problem that India was facing was huge amount of fiscal deficit. And to solve that fiscal deficit, what is that we have done? So the first thing that we have done was introduction of a stable and transparent tax structure. Like I told you, right? Many people, if they are coming under the tax bracket, if you are making the payment of tax easily if it is easily, the compliance procedures are very, very easy. So most people will come inside the tax bracket. So what will happen to the government revenue? It will increase. Ensuring better tax compliance, thrust on controlling the government expenditure. So what do you mean by thrust on controlling the government expenditure? Yes, one side you are trying to limit your fiscal deficit. That is, you are trying to bring down the fiscal deficit. That can only happen if you are putting a control on what is your expenditure. If you kind of are increasing your revenue expenditure, that is of no use. Like, you know that India is a welfare state and most expenditure is incurred with regard to your subsidies. You know, you have heard about transfer payments, right? That has to be brought down. I'm not telling everything is useless, but most of the expenditure that does not yield you much return had to be brought down. Next, reduction in subsidies, disinvestment. What do you mean by disinvestment? You selling off your loss-making public sector undertakings to the private people is nothing but disinvestment, right? Next, private sector participation encouraged. Obviously, earlier everything was government control. Now, what you did was, by allowing disinvestment, by loosening up the policies, you know, by eliminating the restrictions, you are allowing more amount of private people to participate now. So, in order to bring fiscal deficit, it was essential to do away with the temptation to finance deficit through the easy path of money creation. So what do you mean by this? So whenever the government was facing a deficit, it used to go to the RBI asking to print additional money, See, whenever you do that, no, that is nothing but, you know, you're creating money and then you're, you know, easing off your debt. When you do that, what happens is the value of the money decreases. When you do that, the value of the money decreases as the prices kind of increase. So what the government did was, it entered into a historic agreement with the Reserve Bank of India in which year? In the year 1994, to bring down the fiscal deficit in a phased manner, but not through monetization of the deficit, So these are some of your points. And the next thing that you notice here is your monetary and financial sector reforms. So we have also, first we have talked about what the government is planning to do to reduce the fiscal deficit. So the next topic that we are proceeding with is the monetary and financial sector reforms. So the first thing that you see here is focus was on reducing the NPAs. So what do you mean by NPAs? Non-performing assets. So whenever the banks gives out loans, the loans are the assets for the banks and the deposits that it is receiving is the liability for the bank, right? So whenever banks gives out a loan, it kind of receives the principal and the interest payments. For example, if the bank is not receiving for straight 90 days, either the principal or the interest payments, then that loan is categorized as non-performing asset. That loan is categorized as non-performing assets. So what is our goal? Our goal was to bring down the non-performing assets in the government banks. Next, deregulation of the interest rates. It is very, very simple, students. Earlier, the RBI used to tell the banks how much should be the lending rate, how much should be the deposit rate, etc., etc. Now, what the RBI did was, it let the banks decide what should be the interest rate. That is, it has deregulated the interest rates. That is, reduction of control by the reserve banks on the banks with respect to the interest rate chargeable on the loans. Next is, you have allowed private sector banks to enter as well. I told you, right? Privatization. Under privatization, you are allowing the private people to enter. Your public sector banks will also be there, but you're also encouraging the private sector participation. And you are trying to reduce the CRR and SLR. So what do you mean by CRR and SLR? CRR indicates the cash reserve ratio. SLR indicates the statutory liquidity ratio. So these two ratios are set by the Reserve Bank of India, which must be maintained by the commercial banks, or to be more specific, scheduled commercial banks. So these reserves have to be kept aside and they should not be lent. For example, a bank receive rupees 100 rupees of deposit. For example, a bank is receiving rupees 100 as deposit. In that 100, the RBI stated that 4% is to be CRR, 18% has to be SLR. So what is CRR? So, 4% of the deposits that the bank receive have to be kept with the Reserve Bank of India, and 18% has to be maintained in the form of gold, government securities or cash. So, to be more, brief, it has to be maintained as liquid assets. So 18% of the deposits have to be maintained as liquid assets. So in a total of 22 rupees have to be kept aside and the remaining money can be lent. So what they have done was they reduced the CRR and SLR requirements. Madam, what will happen if the CRR and SLR is reduced? See, if the CRR and SLR is reduced, you are able to lend more amount of money to the people. You are able to create more money. You are able to create more economic activity which will increase the industrial growth of the country. Yes. So the next thing is liberalization of bank branch. Earlier, whenever a bank wants to set up a new branch, for that also license has to be taken, but that has been eliminated. Next. The books of commercial banks must reflect accurate and a truthful picture. That is, you must not hide anything from the Reserve Bank of India. Whenever you are preparing the accounts, they must be accurate on dot. Because why is it so important, madam? Why is the financial position of the bank so important? It is very important for the Reserve Bank of India to know the financial position of the banks, because the financial sector of the economy, if it is shaken, it results in the downfall of the entire economy, right? So the next thing is the reforms in the capital market. Right now, we have discussed about money market, which is regulated by the Reserve Bank of India. Now we are going to talk about the capital market, which is regulated by the Securities Exchange Board of India. Earlier also we have studied that Securities Exchange Board of India was set up when? In the year 1988. But the statutory powers to Securities Exchange Board of India was given only in the year 1992 after the Harshad Mehta scam, the famous Harshad Mehta scam. All of you students might be aware of. So what has resulted in giving SEBI statutory powers? That huge scam that has resulted in giving SEBI statutory powers. And which year it was given? In the year 1992. Clear, everybody? Next. The new industrial policy was announced by the government on July 24, 1991. So what is this called as? The new industrial policy, new economic policy, the policy of the 1991. So what happened during these 1991 economic reforms? The era of license Raj was ended. What ended? The era of license Raj was ended. For everything you need to take a license. That thing has been done with. Okay, done away with. So what is that you see here? End of license Raj except 8 industries or 8 sectors. So in 8 cases you required license. Barring that, in the remaining cases you don't have to take any license. So consequently 80% of the industries were out of the license Raj except 5. So that 8 has been reduced to 5. And what are those 5, may I know? They are your brewing, narcotics, atomic energy, arms and ammunitions, hazardous chemicals. What are those 5, students? Brewing, narcotics, atomic energy, arms and ammunitions, hazardous chemicals. So public sector was actually limited to only 8 sectors based on the strategic grounds, that is based on the importance or rather the relevance of the public sector. So 8 sectors were actually limited to only public sector. Okay, and next what happened? Subsequently, it was reduced to 2. In the beginning, 8 sectors was registered for public sector, and later that number was reduced to 2. Okay, so what are those 2 things? Railway operations and atomics. Railway operation and atomic, right? Next is your MRTP Act. So MRTP full form is Monopoly Restrictive Trade Practices Act. It was restructured. Why it has to be restructured? Because MRTP Act actually acted as a barrier for people to enter. Okay, it actually did not promote growth but restricted the growth in many aspects. So it required restructuring. So in related to mergers, amalgamations, takeovers were repealed. Okay, repealed is removed. Next. Many goods produced by small scale industries. This we have already studied, okay. So what we learned was many goods were actually reserved only for the small scale industries to be produced and large scale enterprises were restricted to enter, okay. So what happened here? The small scale industries, were they able to do a good job? They were not able to do a good job. So what they did was they eliminated this as well. They said, "Arre Baba, enough of this reservation, we will do away with this also." Next. Foreign investment has been liberalized. FDI is prohibited in retail trade, atomic, lottery and gambling. So FDI has been liberalized, the foreign direct investment, that is foreigners can invest in India, but restrictions are there with respect to your retail trade, atomic energy, lottery and gambling, betting, all that you know, right? So in that FDI is prohibited. So in the year 1990-91, the highest tariff was, remember this, it was 355%. So what is the highest amount of tariff that you saw during 1990 and 91? It was 355%, and which was brought down to by how much? It was brought down to 85% in the year 1993 to 94, and later it was brought down to 50%. Later it was brought down to 10% in the year 2007 and 8. As you can see, we also focused on trade liberalization, right? So if you want trade liberalization to happen, you have to reduce the tariffs which act as barriers to trade, right? Next, rupee was devalued by 18%. What do you mean by devaluation? When a government authority does or it reduces the value of its currency, it is called as devaluation. When you are leaving it to the market and it has, then you use the word called as depreciation. So when a government authority does it, it is called as devaluation. When you are leaving it to the market and your currency is losing value, then it is called as depreciation. So why this devaluation happened was, we wanted to increase our exports. So whenever the currency is losing its value, the exports are promoted, imports are restricted. The next thing is your disinvestment, that is sale of public sector undertakings which were not profitable. Next comes your trade policy reforms. So we have completed your reforms till here. The next reforms that you're going to see is trade policy reforms. So what is that? You see the first thing here, dismantling the quantitative restriction on imports and exports. See, whenever you want to bring reforms in your trade, or you want to liberalize your trade, the first thing that you have to do is you have to do away with the restrictions. You have to eliminate the tariff and the non-tariff barriers. So in the instruments of trade policy, you have already studied about your tariff measures and non-tariff measures, right? So all the tax related measures are your tariff measures. All the non-tax related measures, that is the quantitative restrictions, are your non-tariff measures. Next, simplification of the tariff. Don't go for a complex tax structure confusing people. Go for a simplified one. Removal of the license requirement. So what is that? Removal of the licensing requirement. Earlier, whenever you wanted to import certain goods, you had to take a license for that. So those import licenses have also been reduced. So till 1991, what kind of exchange rate regime did India follow? India followed a fixed exchange rate regime. Till the 1991 period, India followed a fixed exchange rate regime, and from 1993, you followed a managed float. This managed float is also called as dirty float. It is a combination of fixed and floating. It is a combination of fixed exchange rate regime and also floating exchange rate regime. So, changes India witnessed in the last 31 years. So, in the last 31 years, what is that India has witnessed? So, we integrated our economy with the world economy. That is, we became a part of the globalization. We moved from a planned economy to a market economy. That is, we are letting the price mechanism or the market mechanism to operate. We have seen a growth of the private sector. Earlier, it was only the public sector, right? Now, we are seeing a growth of the private sector. Next, high level of international competition in which sectors? In telecommunication, in information technology, in pharmaceuticals. You see high level of competition is there. And ease in trade controls provided access to foreign technology. See, we allowed the foreigners to enter our country. So, obviously, they will not come empty-handed, right? They will come with their own technology. So, we got upgraded technology as well. Next, stable FDI and FPI. So, for any country to grow, see, you do domestic savings, that is all fine. With that, investments will happen, that is all fine. So, but what happens is that our domestic savings are itself not sufficient for us to, develop. So, you need foreign investments to happen, and that has been on surge during this period. And largest holding of the international reserve, and what is it close to? Close to 8 months of the import. So do you remember the earlier during the balance of payment crisis, you were only left with $1.2 billion of reserves, which was sufficient hardly for 2 weeks. Now you have money that is sufficient for 8 months of import. If something goes wrong, then you have a surplus that is sufficient for 8 months of your import. Next, robust demand for IT and financial services. Our IT and financial services received the greatest amount of investments, and they have a huge demand in the international market. So pressure on rupee is also reduced. See, your rupee was highly volatile, okay, and that pressure has also been reduced. So what happened due to all of this? There was increase in the income, there was increase in the aggregate demand, so which resulted in a sustained economy. And what also you saw was your poverty was reduced substantially. What happened? There was a reduction in the poverty. Your private sector bank participation increased, and there was also a growth in the agricultural sector. So in the last 31 years, whatever you have seen right now, all the positive points you have seen. But what are the negative aspects as well? See, whenever there is positive aspect, there is also a negative, right? There are two sides of a coin, right? So what are the negative aspects are? High degree of fiscal deficit. So one negative aspect that you saw was there was high amount of fiscal deficit and your debt was higher than 64.5% of the GDP as of 2022 as per your International Monetary Fund. That is not a very good sign. Okay, so we have to drastically reduce our fiscal deficit, which is very, very important. Madam, why is it such a huge figure? So in 2020, as you all know, we got the pandemic. Our economy was, almost dipping into recession. So to save the economy, heavy government expenditure was incurred. So to incur that heavy government expenditure, we had to borrow. So that resulted in an increase in the fiscal deficit as well, right? So what we will do in the next part is we are going to talk about Niti Aayog. We are going to talk about the primary sector, secondary sector, and the tertiary sector. I'm going to tell you important points with regard to Niti Aayog. And when it comes to your primary, secondary, and tertiary sector, trust me, people, it is filled with data. It is filled with data. You only have to memorize that data. That is all you have to do. Okay. So up to Niti Aayog, you have to remember the concept. Later on, you have to memorize whatever you see in your primary sector, secondary sector, and tertiary sector. So students, what we will do is we'll continue with the Niti Aayog. Okay. So as you can see, Planning Commission of India, it existed for how many years, students? It existed for 64 years. But with the market orientation and shrinking roles of the government, it was replaced by Niti Aayog. So Planning Commission existed for 60 years and it was replaced by Niti Aayog. So what do you mean by Niti? What is the full form of Niti? Niti means National Institute for Transforming India. Niti indicates National Institute for Transforming India. Why did they have to replace your Planning Commission with the Niti Aayog? Because of the reducing role of the government. Okay, students. So what is your Niti Aayog? It is a think tank. Okay, it is considered as a think tank. So a group of experts from all over have been called upon to give suggestions. What is it? It is a think tank where this think tank includes all the experts from all the regions. So madam, what is the difference between your Planning Commission and your Niti Aayog? Niti Aayog actually followed a decentralized approach. Niti Aayog more of followed a decentralized approach by including the state's participation as well. So madam, was Niti Aayog a success? See, Niti Aayog was a think tank, it was a group of experts, it followed decentralized approach, all that is fine. But people pointed out the negative aspects of Niti Aayog because your Niti Aayog was set up in 2015 and they're saying we are not seeing any sort of improvement as such. And one more thing that to note about Niti Aayog is the people present here are only giving suggestions, okay? It is not a mandate that whatever they are telling has to be implemented, has to be taken into consideration the budget making process. So who is given more powers here? Your Ministry of Finance is given more powers here. You have followed a decentralized approach, but whatever you are deciding under Niti Aayog, are they really being implemented at the central level? No, not at all. You are giving suggestions. They can be taken or they cannot be taken. So who is given more powers? The Ministry of Finance has been given more powers. Next. So these are the different objectives. So what are the objectives of Niti Aayog? It goes for a share division. That is, I told you, right? You go for a decentralized approach. Not only at the central level, you are also involving states to, involve in the decision making process. Cooperative federalism, credible plans, that is you are focusing at the village level. Inclusive focus, that is address sections at the risk not benefiting from the progress. That is many government policies have been bought, but there are many sections of society who are not able to avail such benefits. So those people are taken into consideration. Next, stakeholders partnership, innovation support, issue resolution, resource center. So all these are the things or objectives of your Niti Aayog. Okay, this is all fine, but this is the most important thing. Key initiatives of Niti Aayog. Key initiative of Niti Aayog is very, very important, students. So try to focus here. You wanted to shift from a use and dispose economy. That is because in today, whatever we are using, you are not recycling that, right? So Niti Aayog wanted to, shift from use and dispose economy because we wanted to recycle more. Next, NDAP. So what it does is enhance access to the government data. See, whenever you have to take certain decisions or you want to analyze something, you need to have access to data, right? That is provided by NDAP. That is provided by NDAP. This gives access to the government data. Next, Shunya. What is this meaning of Shunya? Shunya is zero, right? Shunya is zero. So what you are trying to do under the program of Shunya is you are trying to make people get adapted to the use of electric vehicles because you want to bring down the carbon emissions, you want to bring down the pollution. So you're trying to promote electric vehicles to promote the air quality. Next, eAmrit. So eAmrit is a website where you get all the information with regard to your electric vehicles, the model, the price, everything. Okay. So you get that information where you get that in eAmrit. So Indian policy insights. What is this India policy insights? You get information with regard to the population of India, the demography of India, and many government policies are initiated, right? What is their impact on the population? What is their impact on the population? All that you get under your India policy insights. You get under your India policy insights. Next, what is this methanol economy? So the objectives of a methanol economy is you are trying to reduce your dependence on crude oil. You are trying to reduce your dependence on crude oil. You are going to blend methanol into your crude oil, which will try to reduce the pollution and also the dependence on the crude oil. Next, transforming India's gold market. You all know that recently we have imported a lot of gold causing huge trade deficit. So to remove that, we are trying to explore the mining in India, and we don't want to import so much of gold and bring a huge burden or trade deficit on our heads. So we want to invest in mining and we want to, go into a trade surplus. That is your last point, that is improvement of your gold market. Next is arguments put forth by experts about weakness of the Niti Aayog. So what is the weakness of the Niti Aayog? See, it has got a limited role. Whatever decisions you are taking under your Niti Aayog, it is not a mandate that they are included in the budget making process. Okay, so your role is limited, but who is given more powers? Ministry of Finance is given more powers. Okay, next, lacks independence, a voice of development. That is what we are saying. That is what we are telling. Even though you make lot of decisions, there is no guarantee that they will be, included in the budget making process. Right, students? So this is your Niti Aayog. This is your Niti Aayog. So next comes your primary sector. Like I have already warned you, primary sector, secondary sector and tertiary sector is all data driven. You have to remember this data. So let us start with your primary sector of India. So agriculture and its allied sectors is the largest source of livelihood in India. See, what do you mean by primary sector first of all? The meaning of primary sector is whenever you are talking about activities that are relating to nature, that is whenever you are talking about extraction of natural resources and the use of natural resources, that is primary sector. It includes many things. It includes horticulture, pisciculture, sericulture, agriculture. So many things are included. But why do you associate your primary sector with agriculture? Because agriculture is the major contributor in the primary sector. That is the reason why we call it as agriculture and its allied activities. So in its allied activities, you have your horti, pesci, seri, all that will come into consideration. Next. So till the end of 1960s, India was a food deficient nation. You remember, right? In 1960s, we approached America under PL 480 and they have refused to give us food grains. And then we started off something called as Green Revolution. Till 1960, we were a food deficient nation. Next, global leader. Current scenario of agriculture sector in India. So what is the current scenario right now? So we are considered to be a global leader. So largest producer of milk, pulses, jute and spices. Do remember this. We are the largest producer of milk, pulses, jute and spices. Second largest in what? We are the second largest in wheat, rice, cotton in terms of area. Okay, this is in terms of area. Area in the sense like what is the amount of area that we have sown with respect to wheat, rice and cotton. We are the second largest with respect to that. Next, sixth largest in cattle herd, major producer of milk, eggs and meat. Sixth largest in food and grocery retail market. Next, cash crops. What do you mean by cash crops? Cash crops are nothing but commercial crops. So what are your commercial crops? Cotton, jute, sugarcane, prominent. Okay. So in your cash crops, which is more prominent, it is cotton, jute and sugarcane is very, very prominent. Next, GDP share declining in percentage. Listen to me carefully. In your absolute terms, you have increased your production. Okay. From 1991 till 2024, if you see the data, the amount of food production has increased in absolute terms. But as a share of your GDP, if you observe, The share of agriculture as a portion of your GDP has reduced. Madam, why did it reduce? Due to the increasing share of your manufacturing and service sector. Due to the increasing share of your manufacturing and service sector, the share of agriculture in the GDP has reduced. But in absolute terms, in terms of food production, you have increased. Right? So population dependence, how many people rely on agriculture? 47% of the population directly rely on agriculture. And when it comes to production, food grains reached 315 million tons in when 2021-22. And in the case of investment, private investment increased to 9.3% in 2020-21. And you see a robust growth. You see a robust growth that is of 3.5% in 22-23 due to Rabi sowing and allied activities. See, Rabi, or rather you have the Kharif crop, you have the Rabi crop. So Rabi is your winter crop. Rabi is your winter crop. So I hope you all know that during the pandemic also there is only one sector that saw positive growth, which is your agricultural sector. Remaining all the sectors saw a negative growth. But it was your agricultural sector that saw a positive growth during your COVID pandemic. Next, better performance of agriculture and allied sectors, measures taken by the government. So what are the measures that were taken by the government? Augment is increase, okay, students, augment is increase crop and livestock productivity, also crop diversification. So what do you mean by crop diversification? In the land, whatever you are having, don't depend on only one crop. See, go for 2-3 crops, diversify, or rather you indulge in 2 or more crops, then you will actually protect yourself from the risk. Next, certainty of returns. So government introduced something called as minimum support price. That is, it promises the farmer, if nobody is procuring their crop, the government will procure the crop at what price? 1.5 times of the cost of production. So if any private player also want to procure something from the farmer, they have to pay at least the minimum support price or more than the minimum support price. They cannot drop below the minimum support price. Improve the market infrastructure through farm producer organizations. See, what is that we require for the development of the farmers? We require the development of the infrastructure. We require the development of infrastructural facilities, transport facilities, storage facilities. That is when the middlemen can stop exploiting the farmers. Promotion of investment in infrastructure facilities through AIF, Agriculture Infrastructure Fund. So a fund is set up to promote the agricultural infrastructure, which is Agricultural Infrastructure Fund. India's shift from a food deficient and import dependent nation to a food exporting nation. What happened? In the 1960s, you were food deficient and you were importing food grains. Now you are in a situation where the world is looking at you and you are exporting the food grains. Next, India is among the top 10 exporters of agricultural products in the world. So, significant increase in the export, touch all-time peak. How much is this? Just have a look. Rupees 3,74,611 crores in the last year. Next, 25% rise in the exports of agriculture, processed food products within 6 months of financial year 22-23 compared to 21-22. So, what happened here? You saw a rise in the exports by how much? By 25%. Next, liberalization measures in primary sector adopted by the government. So what do you mean by liberalization? You have reduced the rules and restrictions. You have encouraged the private players to participate to foster to the growth of the primary sector. So 100% FDI is allowed in the food product marketing, e-commerce under automatic route. See, people, whenever a foreign investment is coming into the country, there are 2 routes for it. One is the automatic route and the other is the government route. What is it? One is the automatic route, the other is the government route. See, under automatic route, you don't have to take any permission. But under government route, you can only come when the government approves of it, right? Next, PM Kisan. So what I will do right now is, I will just go through all these things. What this thing deals with is already given in your material, okay? You just have to focus that. So PM Kisan is what? It is an income support for the farmers. Remember that, okay? What is PM Kisan? It is an income support for the farmers. MSP, minimum support price. So what does it provide? It fixed at 1.5 times of the cost of production. We have just completed now. Next, concessional institutional credit for agriculture. See, when a farmer goes to take a loan and a business person goes to take a loan, when I go to take a loan, who gets the loan at a very concessional rate? The farmer gets the loan at a very concessional rate. So, if marginal farmers are farmers of small land holdings, okay? Next, national missions for edible oils launch. So this was launched to increase the production of palm oil. This was launched to increase the production of palm oil. Pradhan Mantri Fasal Bima Yojana. Sir, Fasal Bima Yojana. What is Bima Yojana? It is insurance program. So insurance scheme for crop loss or damage. Mission for integrated development of horticulture. See, horticulture deals with fruits and vegetables. Okay. Next, provision of soil health cards. Whenever you're going to plant something, you have to analyze what is the health of the soil. That is when you are able to, understand how much of fertilizers have to be used, how much of pesticides have to be used. Next, this is Krishi Vikas Yojana. This is Paramparagat Krishi Vikas Yojana. This supports what is organic farming, soil health upgrade. So Paramparagat Krishi Vikas Yojana supports what? It supports organic farming. Next, Agri Infrastructure Fund. We have just studied that. So Agricultural Infrastructure Fund is actually maintained to promote the agricultural infrastructure, the storage facilities as such. Next, promotion of farmer producer organization ensure better income from the farmers. See, what happens is the marginal farmers are quite exploited by the middlemen. So this exploitation can come to an end if you all form into groups. If you all form into farmer organizations, this exploitation can actually come to an end. Next, per drop more crop. So what is this per drop more crop? You are trying to increase the productivity in the agriculture with lesser usage of water. We don't want to waste the water as well. We don't want to waste the water as well. So with lesser use of the water, we want to increase our productivity. So this was your points. Next is setting up a micro irrigation fund. That is, you all know that we are monsoon dependent. So to get rid of that, we are trying to set up something called as micro irrigation fund. Agricultural mechanization initiatives, ENAM. So this ENAM is kind of very interesting, okay? Electronic National Agricultural Market. So you know this mandis, right? You might have heard of this mandis who take care of the sale of the product that is bought by the farmer. We call them as APMC mandis. The Agricultural Produce Marketing Committee. What is APMC? Agricultural Produce Marketing Committee. So all over India, we are aligning these APMCs, and whatever prices all over the nationwide, whatever prices are prevailing in the market for the produce that is bought by the market is displayed. So madam, what is the use of this ENAM? Okay. So with ENAM, the farmers are able to electronically sell their goods all over, and they are getting an idea, a better idea of the prices they can claim from the people, because they have no access to the prices what they are prevailing outside. These middlemen try to exploit the farmers, but through ENAM, they are kind of acquiring knowledge with regard to the prevailing prices, and they are also able to sell their product all over the country. Next, Kisan Rail. So through this Kisan Rail, we started using railways for transporting perishable goods like your fruits, your milk, your fish, your poultry, etc. Okay, so this was your Kisan Rail. Startup ecosystem in agriculture and allied sectors. So we want to more people to start up their business in your agricultural sector. So we want to create a startup ecosystem in the agricultural sector as well, right? So now what are the major problems faced by the Indian agriculture? Let us have a look at that as well. So Indian agriculture is dominated by small and medium farmers. That is the problem, because what are small and medium farmers? They are holding a land that is less than 1 acre. So they are called marginal farmers, okay, very small farmers. So what do you mean by fragmented land holdings? See, for example, you received a land of suppose 8 acres, okay? You have children, you have some 4 children, so you will pass on the land to those 4 children equally. So that land is again divided into 2 acres. That 2 acres is again divided. So what is happening? Fragmentation of land holding is happening. That is, the land is being divided into smaller and smaller and smaller parts. If that is being done, no, what will happen? The productivity of the land will decrease. The productivity of the land will decrease, right? Lack of irrigation facilities, because we are heavily dependent on monsoons. Unscientific agricultural practices lead to desertification of the land. See, what happens is many people don't know the right amount of pesticides and fertilizers to be used. Okay. And most people, they are highly dependent on this fertilizers and pesticides, which is actually killing the life of the soil. That is one reason. Inadequate agro-processing infrastructure. What do you mean by agro-processing infrastructure? You suppose we actually produced paddy, okay? We farmed paddy, but we can't directly have paddy, right? That paddy has to be converted into rice. So we send that paddy to a rice mill. For example, there are a group of farmers who are having their own mill. So they don't have to depend on anybody else, right? So these agro-processing industries, they take the raw materials from agriculture. They take the raw materials from agriculture and then they further process that. Next, inadequate adoption of climate-resistant new farm technology. So you know that recently the soil health has been deteriorating, and then the monsoons are not very accurate. So even though the monsoons are not accurate, soil health is falling. Depending on that, we have to develop new technologies so that our productivity will not fall. Next, even though such technology is coming up, the farmers are unable to equip themselves with such technology. Inadequate post-harvest infrastructure and management practices. Like I told you, if there are mills, adequate mills, it won't be a problem. And there should also be adequate storage facilities so that there is no loss of crop. High food price volatility, because what do you mean by volatility? There is high food price fluctuations. You never know what is the price. Next, issues relating to marketing, warehouse of agricultural products, ineffective credit delivery. That is one problem. Incidence of poverty and malnutrition. So we keep saying this statement, right? Farmers are born in debt, they live in debt, and they die in debt. So what is happening is when they are stuck in poverty so deeply, so what is happening? They are unable to get the basic necessities of life as well. They're doing subsistence farming. That is, whatever is required, they're getting. More than that, they're not getting. And some farmers, they're not able to get even the food that is required. Okay, so they're suffering from malnutrition as well due to loss of nutritious food. So these are the various problems that Indian agricultural sector is encountering. So what we will do right now is we'll proceed with your secondary sector. We'll proceed with your secondary sector, and we are left only with your tertiary sector. So I am telling you again and again, students, this is all data driven. Coming to your agricultural sector, see whatever points you know what points are favorable, what points are not favorable, right? If you see the point and you feel that okay, this is increasing the agricultural productivity, it is advantageous. If you read the point and you feel like okay, this is not encouraging the production, it is disadvantageous. You are easily able to identify the points. Use some logic and answer. It is only the data that you have to remember here. That's it. Yes. So coming to your secondary sector, the same approach. So you have got some data, and then last is your tertiary sector, a very small thing that is left out. So a small portion is left out. If you are done with this, you are done with the chapter, right everybody? So what we'll do is we'll start with your secondary sector. So India's industrial sector includes manufacturing. So what do you mean by secondary sector? All the manufacturing activities come under the secondary sector. So manufacturing, heavy industries, pharmaceuticals, fertilizers, chemicals, petrochemicals, oil and natural gas, food processing, MSME, cottage industries, tourism. So all these come under your secondary sector, right? Next, development of a robust manufacturing sector is the key priority of the Indian government. See, why is the secondary sector so important for any country? The secondary sector kind of creates many employment opportunities. See, compared to your primary sector and your tertiary sector or your service sector, it is a secondary sector that generates major part of the employment opportunities. Clear, everybody? Next, the general aspects of the general aspect related to industries are in the third quarter of the financial year 2021-22. Manufacturing sector contributes 78% of the total production, 30% of the gross value added. See, let us understand what is this GVA. In your national income accounting, you studied that your GVA at market price is equal to GDP at market price. GVA, GDP both are same, you studied. Okay. GDP talks from demand side, GVA talks from supply side. What is it? GVA talks from supply side, GDP talks from demand side. So GVA tells you what is the contribution of each sector in the economy. GVA talks about what is the contribution of each sector in the economy. And as per GVA, what is the contribution of manufacturing sector? 30%. Next, in 22-23, 8 core industries. Students, it is very important for you to remember these 8 core industries. What are the 8 core industries? They are coal, crude oil, natural gas, refinery products, fertilizers, steel, cement and electricity. Please memorize these 8 core industries. Comprise how much? 40.27% of the index of the industrial production. Okay, this index of the industrial production will help you acknowledge the growth in the industrial sector. Okay, so what is the contribution of the 8 core industries? 40% is contributed by these 8 industries, right? Next, Department for Promotion of Industry and Internal Trade. Very, very important. So DPIIT, what is the full form? Department for Promotion of Industry and Internal Trade. So a question is a must from this points. Okay. It formulates and implements industrial policies for India. So what is it concerned about? Formulation of industrial policies for the development of industrial growth in the country. So GST. Unified indirect tax law replaced multiple taxes. So what happened with the advent of GST was the tax structure got simplified because many of the indirect taxes were merged and they formed under one umbrella called as GST, which is goods and service tax. Next, corporate tax reduction. Why do you have to reduce the corporate taxes? Because it will infuse more people to enter into the industrial sector. So domestic companies can pay 22% tax without exemptions. Make in India. So what is this Make in India? Recently you keep hearing vocal for local, Make in India. So when Make in India is happening, when more number of companies are coming to India, setting up their manufacturing units, producing in India, what will happen to the employment opportunities of India? Increase. What will happen to the production in India? Increase. So it will actually cause a good industrial growth for India. Ease of doing business, simplified procedures and digitization. So right now what we are trying to do is, we are trying to simplify the setting up of a company as easy as possible, because we are trying to reduce the license requirements. You going to 80-90 departments and taking permissions from them. When will you set up the company? So we are trying to, promote a single window system where every job is done. You don't have to, have the hassle of going to each and every department seeking permissions. Your job is done at one place. Next, national single window. That is what I'm talking about. So the national single window system, investor support platform. That is, your job is done in one single window. Next, PM Gati Shakti. So PM Gati Shakti is actually introduced to develop the logistics and increase the speed at which we are working. Okay. So this PM Gati Shakti was actually introduced to incorporate inter-ministerial coordination. So we wanted to generate inter-ministerial coordination, or communication between ministries is a must, because when communication between ministries is not happening, there is a high possibility that you're going to waste the resources of the people. Next, national logistics policy. So this was also established to develop the infrastructure and reduce the transportation cost. The aim of national logistics policy is, it wants to reduce the transportation cost. Madam, what will happen if we reduce the transportation cost? Is it a big deal? Yes, it is a big deal, because your transportation cost can actually cause a hindrance for you to be the most competitive product. So we have to reduce the logistics cost. India's vision of becoming Atmanirbhar. So to become Atmanirbhar Bharat, what we did was, we launched something called as the production linked incentive scheme, where we are providing benefits for these smartphone companies, laptop making companies, pharmaceutical companies. So we are trying to encourage these people to come to India and manufacture, because we are providing them incentives, be it with the land, be it with raw materials, whatever. Okay. Next, industrial corridor development program. Under this, what you do is, you create an environment that is so conducive for the people. You set up everything, okay, whatever is required for the people to do business, everything is being set, everything is set up by you. You just have to invite them to come to manufacture at your place. They will have to pay some minimal amount as rent. That's it. So you're trying to create everything that is required by the people. You're trying to create an environment that is, conducive for the business people, which will attract them to invest in our country. Next, FAME. This is actually for the promotion of electric vehicles. What is the full form of FAME? Faster adoption and manufacturing of hybrid and electric vehicles. So what do you mean by hybrid vehicles? They work on fuel as well as electric vehicle. They work on fuel as well as electricity. So you know that India has to still develop with the charging stations. So whenever there is a hindrance, they can immediately shift and then they can go for fuel. So we are trying to make more people adapt to electric vehicles. Next, Udyami Bharat. So this Udyami Bharat is for MSME, micro, small, medium scale enterprises. PM Mitra is for textile infrastructure. It is for textile sector. FDI reforms to attract global investments. 100% FDI under automatic route allowed for what? Coal sale and insurance intermediaries. So what is this? 100% FDI is allowed for whom? Insurance intermediaries and for coal sale. Next, this FIPB, this is very, very important. In your international capital movements, we encountered this term called FIPB, that is Foreign Investment Promotion Board. Okay. This was abolished when? In May 2017, and replaced by whom? It is replaced by Foreign Investment Facilitation Portal. So FIPB is abolished, and in the place of FIPB, what did you get? You got the Foreign Investment Facilitation Portal for simplified FDI approval. See, I told you that in some cases you don't have to go for the government route. You can go for the automatic route, but we have to know who is coming and who is coming into the country, who is investing and all. So you come through this FI portal, okay, FIF portal, that is Foreign Investment Facilitation Portal. So earlier what it used to be, it was called the FIPB portal. It was abolished when? It was abolished in the year 2017. Next, you have something called as RODTEP, which is nothing but remission of duties and taxes on export products. People try to understand, our country want to be in trade surplus. If your country wants to be in trade surplus, it has to increase exports and it has to reduce your imports. So whenever you're trying to export more, what the country does is it gives you some benefits. It gives you some benefits. Like whatever duties you have paid earlier, they will be given back to you. They will be given back to you. So that comes under this remission of duties and taxes on export products. It is replaced by whom? Merchandise exports from India scheme. Okay, it is replaced by whom? Merchandise exports from India scheme. It gives rebates on export duties and taxes. So whenever you are exporting something, to promote those exports, it will give some incentives for you. Next, innovation incentives, innovation initiatives, sorry, incubation, funding, and industrial property rights strengthening. So whenever people want to invest in your country, they see the security of their investments. So under industrial property rights, you are trying to secure the foreign investors. You are trying to inculcate confidence in the foreign investors that your properties are safe in India. Next, Startup India. You must have heard about the Startup India, right? It has become quite famous. Facilitate innovation, improved India's rank. This is important. This will be your bit. Global Innovation Index from 81st to 40th in 2022. So what is our rank, people? It is from 81st to 40th in the year 2022. Public procurement, that is, under public procurement, what the government does is it gives advantage to Indian made products. It gives advantage to Indian companies. So recently the government has given an order stating that whatever defense procurement the Ministry of Defense does, they must be made from Indian origin companies. Next, the next is your emergency credit line guarantee scheme. This is also for MSMEs. This is also for MSMEs. Who is it for? Micro, small, medium scale enterprises. So this is bought by for the MSMEs to give them loans without any collateral. So they are called the unsecured loans. Okay, they are called the unsecured loans. Next comes your Industry 4.0. What is the next topic? Industry 4.0, also called the fourth industrial revolution. So why was it, what is its relevance? To integrate new technologies like cloud computing, machine learning, artificial intelligence in manufacturing. National manufacturing policy aims, this is important. So please try to remember the percentage. Under the national manufacturing policy, you want the manufacturing sector share in GDP to be 25% by when? By 2025. That is, by the next year, you want the share of the manufacturing sector in your GDP to be 25%. So over the last few years, FDI equity inflows are rising in India's manufacturing sector. So many people are showing interest to invest in India, right? Next, what are the challenges faced by the India's industrial sector? What are the various challenges faced by the India's industrial sector? Let us have a look at that as well. So one is your infrastructure shortage. To improve that only, we are, bringing out these programs like Sagarmala, Bharatmala, all these have been brought out, no? To address that gap, because in India there is a high, this saying that the infrastructure is not up to the mark yet. Next, import reliance. So we heavily rely on imports till date. So recently we also received a data saying that even though we tried to ban many things from China, we are still running in trade deficit with China. Next, MSME credit constraints, that is, small businesses struggle with credit availability. Even though we have bought out many schemes, but these MSMEs are struggling for credit. Next, unsustainable cost structures, that is, poorly located industrial sites. So due to these infrastructure, inadequacies and bottlenecks, what happens is the transportation cost really, skyrockets sometimes, which can cause a burden for the industrial sector. Next, public sector challenges are inefficiencies, strained labor relations. Any manufacturing sector, if it has to do well, its industrial relations have to be best. That is, the employee-employer relation have to be best. If the workers go on strike, you know what happens next, right? So the employer needs to earn confidence of the employees. Next, export competitiveness, need to overcome the barriers. So what is here? To increase your export competitiveness, your products have to be, cost efficient, right? So you have to bring down many costs yet. So that you have to achieve. We are still on the path. We are still on the path. Recently, China also was saying that India is not as competitive as China, but we will become one for sure. Next, Supply chain disruptions. What are supply chain disruptions? So supply chain bottlenecks are nothing but your supply chain disruptions. So global uncertainties, they may also act as a hindrance for us. Russia and Ukraine are fighting. That war is impacting the crude oil prices. So what is happening? Here Russia and Ukraine are fighting, but how is it impacting India? The crude oil prices are increasing, right? It is posing an impact for the India. Next, inflation and demand, economic fluctuations after costs and demand. So inflation is one factor that is causing an impact. Next, monetary policy tightening. So what do you mean by monetary policy tightening? You are decreasing the amount of money supply. So for example, there is inflation persisting in the economy. To control the inflation, what do you do is you decrease the money supply. You increase the rate of interest. Whenever the rate of interest is increasing, people will not feel like borrowing as the cost of borrowing is really high. So that can act as a hindrance for the investment. Fuel prices and informal sector. So you have two types of sectors, formal sector and informal sector. Formal sector, the data is available. But what about in the informal sector? Okay. So challenges faced by the informal businesses, high and increasing fuel prices. We already discussed about this crude oil prices. So somewhere something is happening that will have an impact on the crude oil prices because it is influenced by the international scenario. It is not depend on what is happening internally in India, but the external factors have a great impact on the crude oil prices. So these are few things with regard to your industrial sector or your secondary sector. So the final sector that you can see is your tertiary sector. So tertiary sector is also called your service sector, right? So this service sector, whatever you're seeing here is considered the growth engine of the country because major contribution of the GDP is coming from the service sector. But talking about employment, major people are employed in the agricultural sector. So service sector, even though it is generating huge chunk of revenue for you, but it is not creating huge amount of employment opportunities. That is the reason why India wants to increase its manufacturing sector so that more employment opportunities are created. Next. So post-reform Indian economy, what we did was from agrarian economy, we suddenly shifted to a tertiary sector. So in between secondary sector was bypassed. Okay. We bypassed secondary sector and we have gone to tertiary sector. Activities covered. So what are the various activities covered here? So let us have a look. Wholesale and retail trade, transportation, accommodation, information communication, financial services, real estate activities, professional scientific. So education, arts, entertainment, all these are the various activities that are included in the service sector, right? So self-use, this is also taken into consideration. You know this, right? So whatever you are doing for self, that is self-production is also, self-consumption is also taken into consideration. Next, growth of the service sector in India, both domestic and global factors impact. So let us just take a look at the data here. Service sector dominance in 2021. The service sector accounted for how much? 53.89% of the India's GVA. So what is GVA? Sector-wise contribution is told by your GVA, that is gross value added. So what was it? 53.89% at the current prices, which is 96 lakh crores. How much is it? 96 lakh crores. Next, fastest growing sector with high labor productivity, knowledge-based services contributes to service sector growth. So you all know that you require skilled labor here, okay? You require high amount of skilled labor. Information intensive activities like computing. So here these activities require high degree of information. So they are your computing, accounting, legal services succeeded due to technology adoption. So as we have upgraded ourselves with the, recent technologies that led to the growth in these sectors. Next, resilient exports. So compared to all the sectors, our exports from the service sector are really, really high. Our IT services and financial services are very much demanded in the international market. Next, India's service sector attracts over 60% of the FDI. How much FDI is it attracting? 60% of the FDI. Please do note that down. And under the World Investment Report, India is the 7th largest recipient of FDI in the top 20 host countries. So India is the 7th largest recipient. Next, complementing your manufacturing sector. So what is it? Service growth complements the manufacturing sector. How is it done? Let us take your retail sector for example. The construction of the houses come under your secondary sector. So after the construction of houses is done, after the construction of hotels are done, hotels actually become a part of your tourism, right? And tourism is your service sector. So these both are complementing each other. These both are complementing each other. Remarkable startup growth, mostly in the service sector. So most of the startups that you see are in your service sector. Resilient exports. Despite the challenges, India's service exports remained strong during the pandemic. So, service sector, what you saw was there was digital demand. See, take your financial services, for example. You don't have to cross the border to give financial services, right? You can do that wherever you are sitting. Your IT services, everything. They were on huge rise during your pandemic as well, because there were no restrictions. There were no restrictions because they had what demand? They had digital demand. FDI, 100% FDI is allowed in what sector? Telecom sector. In insurance sector, 74% is allowed, and that was earlier 49%. That has increased to how much? That is increased to 74%. Next, government initiatives, National Single Window System facilitated investment. So what is this? To encourage the investments, you are trying to reduce the restrictions as much as possible. You are trying to make the job easy for the investors. You don't want them to, go for large amount of compliances, making them feel that, is it even worthy to invest here? There are a lot of, compliance requirements. So you're trying to make it as easy as possible to inculcate interest in them. Right. So the next thing is India Development Update of the World Bank published in 2022 November. So India Development Update is published by whom? World Bank. So what does it say? Despite the external challenges like the Russia-Ukraine war. So what is happening outside? You know that outside your Israel and Palestine are fighting, Russia and Ukraine are fighting, rising oil prices. So whenever a war breaks out, the impact of the war will immediately fall on your crude oil prices. Supply disruptions. India's real GDP grew by how much? 6.3% in Q2 2022-23, and recent data in 23-24, the GDP growth rate of India was 8.2%. When the entire global economy was going through recession, we saw a growth rate of 8.2%, that is greater than what we have projected. Next, due to strong private consumption and investment. You know that your aggregate demand is C plus I plus G, right? So in that, your consumption portion and your investment portion contribute a huge amount. Next, India's economy is less affected and more resilient. See, what do you mean by resilient? Even though externally many things are happening, but we are not affected so much by it. We are not affected so much by it because the fundamentals of the economy are really good by the global spillovers and trade flows compared to other emerging markets. See, there are other developing nations as well. Compared to them, we are affected less. Compared to them, we are affected less. So this is your chapter. This is your chapter of Indian economy. Students, I hope you understood. Coming to your primary, secondary, tertiary, it is only the data that you have to memorize. The remaining things, the concepts, we made them clear for you. If you go through this, this will do the job for you for the exam as well. Thank you so much. I hope you enjoyed the session. Happy learning.